Good morning, everyone. So, in our previous session, we have discussed about exemptions, and few exemptions are completed. So, you can look into page number 44. So, renting, including leasing, licensing. So, this is renting of movable property and renting of immobile property. Already we discussed the provisions pertaining to renting of movable property. So what is it we have seen? So total 4 exemptions are there. So hiring of a means of transport that can carry more than 12 passengers to a state road transport undertaking is exempted. Then hiring of a means of transport of goods to a goods transport agency, hiring of electrical vehicle that can carry more than 12 passengers to local authority, but it should be electric vehicle. And then hiring of bus to a person who in turn provides transportation service to educational institution up to 12th standard or equivalent. So in these cases it is exempted for movable property. For immobile property also we discussed, so that building, so when immobile property, building residential property for residential purpose to an unregistered person is exempted. And related to land also there is one exemption, that is whenever there is a long term lease of land. And what type of land it is a land for industrial use. So either it is industrial plots or plots for development of infrastructure for finance business. And who should own that plots? That plot should be owned by state government industrial development corporation. Now they are giving it on a lease. That to what type of lease? Long term lease for a period more than or equals to 30 years. And now they will collect some upfront charges in every lease transaction. So there will be upfront charges and the annual charges. Upfront charges means initially whatever is paid is called as upfront charges. Annual charges means, so thereafter every time which is paid is known as annual charges. So upfront charges is exempted, that is with respect to this. Then next, renting of precincts of a religious place meant for general public registered as a trust under Income Tax Act. So that is, there is a religious place, that religious place is meant for general public, but it should be registered as a trust. Now the precincts means surrounding of that religious place is given on rent. For what purpose? For accommodation. Then it will be exempted if per day it is less than 1000 rupees. Suppose if it is greater than or equals to 1000 rupees, entirely it will be taxable. Whereas if it is for halls also it will be exempted if per day it is less than 10,000 rupees. Suppose if it is greater than or equals to 10,000 rupees per day, entirely taxable. Whereas in case of shops also it will be exempted if per month it is less than 10,000. Here it is per day, accommodation per day 1000, and here hall also per day 10,000, but shops is per month. If it is less than 10,000 exempted, otherwise entirely it will be taxable. And motor vehicles, wherever it is taxable, who will pay GST? If 3 conditions are satisfied, it will come under RCM. What are the 3 conditions? Supplier should be other than body corporate, recipient should be body corporate, rate of GST should be 5%. Then it will come under RCM. Then related to sports services, so recognized sports body or unrecognized sports body, the difference already I have explained to you. There are 6 recognized sports bodies. What are they? That is National Sports Federation, Inter-University Sports Board, then Paralympic Committee, Central Civil Services Cultural and Sports Board, and Panchayat Sports Board. So these are all some recognized sports bodies. If they receive any sponsorship money, that will be exempted. Suppose if it is other than recognized sports body, if they receive sponsorship money, that will be taxable. But who will pay GST? Again it depends. If the recipient is body corporate or firm, it will come under RCM, otherwise it will be FCM. Then we have another exemption with respect to sports related services, that is services provided by an individual as a player, referee, umpire, coach, team manager. So player, referee, umpire, coach, team manager, these 5 cases it will be exempted. And that too they should be providing service to recognized sports body. If they provide service to unrecognized sports body, then it will be taxable. Say for example, Virat Kohli paying for BCCI, money received will be exempted. Suppose if he is playing for RCB and getting money, so that will be exempted or taxable? Taxable. So only recognized sports body, it will be exempted. And other people, even though providing it to recognized sports body, will be always taxable. Who are others? Like commentators, selectors, pitch curators, technical experts, etc. If they provide service to recognized sports body or unrecognized sports body, it will always be taxable. So the exemption is what? Individual as a player, referee, umpire, coach and team manager. And one more point also, services provided by one recognized sports body to another recognized sports body. That is, so there is a inter-university sports match tournament that is happening. So they are asking BCCI to provide the services for conducting the game in international standards. So for which BCCI provided the service to inter-university sports board. So one recognized sports body to another recognized sports body. So that services provided will be exempted. So this is sports related services. Then there is an unincorporated association or a non-profit entity. So that unincorporated association or a non-profit entity, they are providing services to their members and the money collected will be exempted. Suppose if that unincorporated association is a trade union. So trade union means what? Association of traders. So all similar traders will form an association, like all gold merchants will form a gold merchant association. So that association will have members who are traders. They will be paying some membership fees. That membership fees collected by the association will be exempted, whatever may be the amount. Suppose if it is for providing exempted services, so that is generally that service itself is exempted. Even if it is provided by an association to its members is also exempted. Then a resident welfare association. Resident welfare association means apartment owners association. So they will be collecting membership fees or charges, maintenance charges from the flat owners, that will be exempted if it does not exceed 7,500 per month per member. Then an industrial or agricultural labor association. So that is, instead of trade union, it is a labor union. So usually these industries and all will have some labor unions. So that labor unions will have members of the labor, members as the labor. So these laborers will pay some membership fees to join in that union. So that membership fees collected by the industrial labor union or agricultural labor union is exempted. Then finally, any other entity or any other association or club, etc. will be exempted if per annum, not per month, per annum the consideration charge does not exceed 1,000 rupees. If it exceeds 1,000 rupees, entirely it will be taxable. Same way here also, if it exceeds 7,500, entire amount will be taxable. In exemptions, you remember, wherever the limits are given, if you cross that limits, entirely it will be taxable. Then transportation of passengers. So in case of transportation of passengers, railways other than first class or any AC coach is exempted. So which means, so AC coach will be taxable. Let it be first class, second class, etc. taxable. Even first class non-AC, like local trains we'll see, that is also taxable. But others means sleeper, general, second class reservations, etc. that will be exempted. Same way, metro, mono and tramway, whatever it may be, like AC, non-AC, etc. and all is irrelevant. So this will be always exempted. So then airways. In case of airways, so if the starting point or ending point of the passenger is in northeastern states. Northeastern states means we have certain states listed as northeastern states. MMTN ASAM. You need to remember that. MMTN ASAM. So MMTN is what? Manipur, Mizoram, Tripura, Nagaland, Assam, Sikkim, Arunachal Pradesh and Meghalaya. These are the northeastern states. If the starting point or ending point of the journey is in northeastern states, and that too they should be traveling in economy class, then the money collected will be exempted. Or if the starting point or ending point of the passenger is in Bagdogra, West Bengal, okay, Bagdogra, West Bengal, even then the travel ticket will be exempted. For example, a passenger is going from Chennai to US. So Chennai to a place in this place, like northeastern states or Bagdogra, the ticket is exempted because ending point is in this place. Again, a connecting flight from there to US is also exempted because starting point is in that place. However, this exemption is available only in case of economy class, not in case of business class and all. Then next, consideration as viability gap funding for a period of 3 years. So there are some regional connectivity airports. So they will be receiving some money from government towards viability gap funding because they will be offering tickets at a lesser rate. So this money which is received from the government by the airlines is exempted for a period of 3 years, and thereafter it will be taxable. But thereafter also they will receive money, but that will be taxable. Next, waterways. In case of waterways, we have only two exemptions. Inland waterways is exempted, and coastal waters is also exempted if it is like within India. Coastal waters within India means what? One port in India to another port in India. Okay, but for what purpose? For other than tourism purpose. So means for public transportation, like Chennai to Andaman and Nicobar, one port in India to another port in India, and that is for public transportation. So money collected will be exempted. Then roadways. In case of roadways, non-AC stage carriage is exempted. So what is the difference between a stage carriage and a contract carriage? Stage carriage means which stops at every stage of its journey, like share autos or local bus, etc. will be coming under stage carriage. Non-AC stage carriage is exempted, whereas non-AC contract carriage other than for hire or tourism. So non-AC contract carriage is like point to point travel, bus, intercity bus will be there na, that will be called as contract carriage. Contract carriage again divided into two, AC, non-AC, but which one is exempted? Non-AC contract carriage. But for what purpose they should be using that non-AC contract carriage? Public transportation other than tourism or hire, then it will be exempted. Then metered cab or auto rickshaw, like normal autos are there na, that, and metered cab, that is a car where the meter will be fixed on that car, that metered cab or auto rickshaw is also exempted. But these three, if it is through an e-commerce operator, it will become taxable. Generally these three are exempted, but whenever it is provided through an e-commerce operator, it will become taxable. So that is an amendment with effect from 1/1/2022. Then transportation of goods. This is transportation of passengers, whereas in case of transportation of goods, so transportation of goods by railways as well as waterways in coastal waters within India. So these two cases, the specified goods are exempted. So what are the specified goods which we already discussed in GTA services? In GTA we have seen 6 specified goods. What are they? Agricultural produce, food grains including flours, pulses, milk and salt, organic manure, newspapers and magazines, relief materials for natural or man-made disasters, then defense and military equipment. So those 6 specified goods, if it is transported through goods transport agency, it is exempted. Even if it is transported through railways, it is exempted. Even if it is transported through waterways, coastal waters means sea between places in India is also exempted. 3 places. Whether these notified goods transported by airways will be taxable or exempted? Taxable. Next, airways. In case of airways, from India to outside India is exempted up to 39/2022. So therefore, with effect from 1/10/2023, 22, it will become taxable. Now, for your exam, they may test the date also here. So you need to remember the date. What is that exemption? So transportation of goods by airways from India to outside India is exempted up to when? 39/2022. With effect from 1/10/2022, it became taxable. Then outside India to India is always exempted. So airways within India will be taxable. Outside India to India will be exempted always. India to outside India is exempted up to 39/2022, and thereafter it became taxable. But waterways, you see, inland waterways always exempted. Inland waterways means what? That is rivers. Within the land there is a river, through the transportation is done, that will be exempted. Even in case of passengers also, inland waterways is exempted. So passenger transportation by inland waterways as well as goods transportation by inland waterways is exempted. Whereas goods transportation by coastal waters from India to outside India is also exempted up to 39/2022. So transportation of goods by airways and waterways from India to outside India is exempted up to 39/2022, and thereafter it became taxable. Then roadways, GTA and courier agency is only exempted, but taxable. GTA and courier agency is only taxable, but all other cases it is exempted. So if you see the balancing figure for roadways, transportation of passengers by roadways, balancing figure means what? Other than these three will be taxable, because these three are only exempted. Whereas in case of goods, transportation of goods by roadways, only GTA or courier agency is taxable. All other cases it will be exempted. Now normal lorry we will book and they will be transporting goods from one place to another place. So for which we pay some freight, that freight will be exempted, normal lorry. If it is a GTA, what's the difference between a normal lorry and a GTA? So in case of GTA, they will be transporting goods by road and issues a consignment note by whatever name called, then they will be coming under goods transport agency. But normal lorries, Tata Ace, etc. and all is there na, so that will come under others. So therefore that will be exempted. We don't have to pay any GST on that. In case of GTA, already we discussed what are the exemptions. Do you remember that exemptions? 3 exemptions. Notified goods, if the recipient is government, registered only to deduct TDS, and if the recipient is so individual or HUF or AJP, so not registered and not having a factory, that point already we have discussed. Then next one, we have construction services. So one important point is there that we have already completed discussion, that is inward supplies of TDR, FSI and long-term lease. To what extent it is exempted? To the extent of residential units booked before completion certificate divided by total number of units. To that extent it is exempted. Then look into the first point, construction of an individual house irrespective of the floor area, not as a part of complex. Not as a part of complex means what? There should be only one kitchen. That is only called as individual house. So house occupied by a single family means only one kitchen. It may be 3 floors, 4 floors also, but only one kitchen should be there. That is only called as individual house. For construction of that individual house, if any consideration is received by the contractor, that money received by the contractor is exempted. However, this exemption is applicable only in case of construction service, not for repair service. So only in case of construction of an individual house, not for repair. Whether repairs of individual house will be taxable or exempted? Repairs of individual house will be taxable. Then second one, construction, repair, alteration, renovation, etc. of following projects is exempted. Housing for All Mission and Pradhan Mantri Awas Yojana. Housing for All Mission and Pradhan Mantri Awas Yojana are government projects. For that government projects, if there is a contractor who is providing construction service or repair service, the consideration received will be exempted. That is second. Then third point is that whenever we buy a flat, we will buy the flat, already I told you, so including the UDS. But GST is not payable on the UDS, undivided share of land. So therefore 1/3 will be reduced towards the undivided share of land, and remaining 2/3 only will be chargeable to GST. So take the gross amount of the flat. For example, we discussed 75 lakhs is the value of the flat. 1/3 will be taken out towards UDS. So remaining 50 lakhs only will be chargeable to GST. Got it? Next. So this is the illustration which we have seen in RCM. So we have an inward supply of TDR and FSI 10 lakhs excluding GST at 18%. GST payable on inward supply is 1,80,000. And floor area of residential flats booked before completion certificate 28,000 square feet. Total floor area of the project 50,000 square feet. So how much will be exempted? What is the value of inward supply? So 10 lakhs. 10 lakhs into 18%, 1,80,000. 1,80,000 into what by what is exempted? 28,000 square feet divided by 50,000 square feet is exempted. So 1,80,000 into 28 divided by 50, that will be 1,800,000 will be exempted. So remaining will be GST payable. Understood? Then we have certain exemptions under IGST Act. So sector wise exemptions we have completed. Now we are looking into exemptions under IGST Act. That is, if both supplier of service and recipient of service located outside India all services are exempted except transportation of goods by vessel from outside India to India. So there is a shipping company which is located outside India, which is providing transportation service to an exporter who is also located outside India, but the goods are transported from outside India to India. So they are telling the transaction will be chargeable to GST, but that freight, import freight, anyhow will be included in the value under customs for payment of customs duty. So which means that there will be a double taxation. To avoid the double taxation only, Supreme Court is telling that this freight which is chargeable to GST is not constitutional. So Supreme Court decision is that, so we should not pay GST on that. But as per law, we have to pay GST. As per Supreme Court decision, we don't have to pay GST. Now when you get a question in exam for CMA final, when you get a question on this, you write that the said activity is taxable, not exempted under GST. However, on account of Supreme Court decision, GST is not payable on that freight for transportation of goods from outside India to India. Understood? Clear? So because of the Supreme Court decision. And then, so at this point, you just write down in your book transportation of goods by vessel. Vessel means ship from outside India to India, outside India to India. Always taxable. Always taxable. Okay. Now, divide that into two. If shipping company and recipient, if shipping company and recipient are outside India, then who will pay GST? They are telling that, so importer of such goods shall pay GST. Importer of such goods shall pay GST under RCM. But this omitted by Supreme Court, omitted by Supreme Court, as there is double taxation, as the same freight is also included in value under customs. So means anyhow we are paying customs duty on that. So that's the reason why they are telling that. So we don't have to pay any GST on that. This is omitted by Supreme Court. Okay. Whereas other cases, so who will pay GST? FCM. Supplier shall pay GST. It is taxable. See, always it is taxable. But who will pay GST is the confusion. If both are located outside India, then law says that importer of such goods should pay GST. But that is held unconstitutional by Supreme Court and they have omitted it. Whereas in all other cases, normal. Supplier only will pay GST. That is with respect to this transportation of goods by vessel. So, generally all services are exempted if both supplier and recipient are located outside India, and this is an exception to that. But that also now omitted by Supreme Court. Then service provided by a tour operator to a foreign tourist. where the tour operator is located in India, and they are providing tour operator service to a foreign tourist in relation to the tour wholly conducted outside India, then this Indian tour operator gets some money that will be fully exempted. Okay, so but what if the tour operator is providing services to a foreign tourist in relation to tour conducted in India? Taxable. Tour conducted outside India, exempted. Tour conducted in India, taxable. What if, so the tour is partly in India and partly outside India, so then proportionately it is exempted. What is that proportionate? They have given. So we need to take total consideration into number of days the tour is conducted outside India divided by total number of days, or total consideration into 50%, whichever is less. Say for example, if 3 days the tour is conducted outside India, okay, and 2 days the tour is conducted in India, so what is the ratio? 3/5. So, and if the total amount is 1 lakh, so 1 lakh into 3/5, so 1 lakh into 3 divided by 5, that is 60,000, or 1 lakh into 50%, that is 50,000, whichever is lower is only exempted, so 50,000 will be exempted. Understood? Now, what if the tour takes place for less than or equals to 12 hours? Less than or equals to 12 hours in a day. See, if it is a day, okay, fine, you will take. But what if it is less than or equals to 12 hours a day? Then you need to take it as, so half a day. Okay, and greater than or equals to 12 hours will be taken as full day. Understood? So, tour conducted for less than or equal to 12 hours considered as half a day. However, greater than 12 hours considered as full day. So, tour conducted for less than or equals to 12 hours considered as half day, greater than 12 hours is considered as full day. Next, number 4, services provided by an intermediary when location of both supplier and recipient is outside India. So, what is the difference between point number 1 and point number 4? In point number 1, supplier of service outside India, recipient of service outside India, exempted. But this is what, there is a supplier of goods outside India, recipient of goods also outside India, and these two people are connected by intermediary in India. That intermediary will get a commission, and that commission is exempted. That is this point. Okay. Then next, miscellaneous exempted services, transfer of a going concern as a whole or independent part thereof. So means business, I have a business and that business is transferred as such, lock, stock, barrel, fully I have transferred that business, merger, acquisition, etc. On transfer of business, there is no GST. Slump sale like that you would have heard in income tax. So that will be exempted, no need to pay GST. Then services associated with transit cargo to Nepal and Bhutan. Nepal and Bhutan are landlocked countries, and goods will be imported into India, and thereafter by seaways, thereafter it will go to Nepal and Bhutan through land route. So for this is known as transit cargo. If you are providing any service in relation to the transit cargo like loading, unloading, transportation, etc., that service will be exempted. Not only to Nepal and Bhutan, there is an amendment that even from Nepal and Bhutan, this side also, both ways. So India to Nepal and Bhutan, Nepal, Bhutan to India, both are transit cargo, that will be exempted. Then service by way of collecting or providing news by independent journalists. Independent journalists will not be working for a particular newspaper or news channel. They are freelancers. They will be gathering the news and selling the news to the newspapers and news channels, and they get some money, that is exempted. Then Press Trust of India and United News of India are like broadcasting agencies. So like if you want to give some news to be telecasted everywhere, you need to go to Press Trust of India or United News of India, pay some money, and that news will be telecasted to all the newspapers and news channels. So that is known as Press Trust of India, United News of India. They collect some money now for broadcasting that news. So that money received will be exempted. Then service of public libraries. So public libraries, so people will go and take books on rent, and they will be paying some lending fees. That lending fee will be exempted. What if it is a private library? For example, you take CMA Institute. CMA Institute, there is a library. Yes, it is there, I have seen. Okay, so there is a library, and in that library, so like for students, if you show the ID card and all, so they will be allowing you to sit and read there and take the books also. But I don't know whether there is rental charges or not, because I never borrowed any book over there. Suppose if we take that book, and if there is rental charges, whether that rental charges like lending charges, like some 100 rupees or 50 rupees, etc., will that be taxable or exempted? It's a private library, not allowed for all. Can outsider go and read? Can CA student go? No, only CMA student can go. CMA student can go to CA Institute. No, not possible. They cannot show the ID card of CMA Institute. CA, common, cost accountant, chartered accountant. Really, you know that, na? So, Institute of Chartered Accountants of India, Institute of Cost Accountants of India, and short form for both is ICI. Now people are telling I am CA. Okay, so it's okay, fine. So, but they will not allow. Means it's a private library. Private library means what? Allowed only for specified people, that people only. Now, even then it is exempted. Why? Service provided by an educational institution to its students, faculty and staff, under that category it will be exempted. Are you understanding this? Then next one. Suppose if it is a British Council library, there is one library, British Council library, like that it is there. So that library will be taxable, because it's not an educational institution, it's a private library. You have to take membership. The membership itself will be somewhere like 20,000, 25,000, like that membership fees, and you need to take that lifetime membership fees only, and there we can go and we can sit and we can refer to the books and all, but that is a private library and that will be taxable. Okay, not an educational institution. Service by an organizer to any person in relation to business exhibition held outside India. So there is a business exhibition provider, that is organizer of a business exhibition located in India. They are exhibiting where? Outside India. Now they are providing services to a person in India by way of exhibiting the products of the person in India outside India. So therefore, for which they collect some money, this will indirectly lead to exports, because if a product is displayed in an exhibition outside India, that will lead to exports. That's the reason why they are giving this exemption. What if the business exhibition is held in India? Taxable. Then service by way of public conveniences, that lavatories, urinal, toilets, etc., we pay 1 rupee and use. 1 rupee, 2 rupees we pay, na? That will be exempted. Sir, where it will cross threshold limit and all? So it will not cross 20 lakhs. So that we have to think about taxability. So it is exempted. Then toll charges is exempted. Services by way of access to road or bridge on payment of toll charges. So toll charges is exempted, and reason being, toll charges is nothing but recovery of investment. So first they will invest on constructing the road, and the money what they have invested they need to recover only by way of toll charges. That's the reason why they have given exemption. Even the toll charges payable by way of annuity is also exempted. Toll charges payable by way of annuity means what? Rather than paying it every time, yearly we will pay some amount, that is also exempted. Then overloading charges. Overloading charges means, so some trucks and all will take heavy goods in the highways. So they have to pay overloading charges apart from normal toll charges, that is also exempted. And then extra charges for not having FASTag. So because if you are not having FASTag, you have to pay some extra charges. So that extra charges for not having FASTag is also exempted. Okay. So overloading charges or toll plaza is exempted. Higher toll charges for not having FASTag is also exempted. Then services by a performance artist. Who is a performance artist? One who performs before the audience. In folk or classical art form of music, dance or theatre. So in what genre? Either folk or classical. Okay. And art form of music, dance or theatre. So music or dance or theatre. Theatre here refers to drama, stage show, etc. Say there is a Bharatanatyam dancer and performing in a stage show, and the consideration for that performance does not exceed 1,50,000, it is exempted. Okay. Then services, what if they are acting as a brand ambassador? It will be taxable even if it does not exceed 1,50,000. Services by way of training or coaching and recreational activities relating to arts or culture, but that arts already we discussed this arts or culture should be by an individual. If it is sports, that should be by a charitable trust. Then satellite launch services supplied by ISRO, Indian Space Research Organization, Antrix Corporation and New Space India Limited. These are the three people who provide satellite launch service in India. So money collected by them will be exempted. Then we have three circulars. So that is guest anchors. So like this Big Boss, etc. and all. So they will be bringing celebrities as the guest anchors, correct? So cinema actors as guest anchors, and they will be paid some money. Whether that will be taxable or exempted. Taxable. Why it is exempted? We don't have any exemption on that. It will be taxable. Then only renting of motor vehicles to body corporate is covered under RCM, but transportation of passenger service to body corporate is not covered under RCM, because transportation of passengers to body corporate, nowhere we have come across Sir CG got salads. Only renting of motor vehicles we have come across. Then transportation of passengers from one port in India to another port in India, coastal waters, is exempted if it is for public transportation. What if it is done by private ferries like India to Andaman, that is Chennai to Andaman? So government operated ferry is also there, private operated ferry is also there. In that they are transporting the people, public transportation. Both are exempted? Yes. Public transportation here does not mean only government doing transportation is exempted. Let it be government or private, it will be exempted. So private ferries used for passenger transportation in coastal waters between places in India is exempted. Even if it is used for tourism only, it will be taxable, because we studied now. So between places in India other than for tourism purposes. For example, Kanyakumari to Vivekananda Rock, Kanyakumari shore to Vivekananda Rock, okay, and Thiruvalluvar Rock. So that will be coming under tourism, coastal waters only. Between place in India, will it come under tourism or not? Yes. Therefore, that will become taxable. Why? Because coastal waters between places in India, but other than tourism purpose. If it is for tourism purpose, that will become taxable. Okay. So these are the exemptions that we have with respect to GST, and we will do one MCQ test. Okay, so you see this. Take vivox.app 188-839-847. 188-839-847. Can I start? Kesar Maharaj, a registered supplier, gave a classical dance performance in an auditorium. The consideration charged for the said performance is 1,60,000. Such performance is not for promotion of any product or service. Rate of CGST and SGST on such service is 9% each. Assuming the service supplied by him to be intra-state supplies, which of the following statements are true? Okay, so what will be taken here? 1,60,000. 1,60,000 is more than 1,50,000. Therefore, it will be taxable, entirely taxable, entirely taxable. So, therefore, 1,60,000 into, and it is CGST, SGST within the state. So, therefore, 14,400 and 14,400. So, option B is the correct answer. Then next one. Which of the following services provided by Good Health Care Nursing Home are not exempt? Reiki healing treatment, plastic surgery conducted to repair cleft lip of a newborn baby, air ambulance service to transport critically ill patients from distant location to medical center, palliative care for terminal ill patients. Usually that palliative care will be provided at the patient's home only. So rather than in the hospital, it will be provided in the patient's home, and mainly for those people who are like having life-threatening diseases, for them they will do that. And alternative medical treatment by way of Ayurveda. So you have 30 seconds. Yes. Okay. So the answer for this, Reiki healing treatment is not exempt, taxable. But plastic surgery, generally plastic surgery is also not healthcare service, but when it is carried out to restore the anatomy of body parts affected due to congenital defects, it will become exempted. So second one is exempted. Air ambulance, let it be air ambulance or road ambulance, all ambulance is exempted. So third also exempted. Palliative care, see I told you healthcare does not mean only treatment, it includes even care, exempted. Then alternative medical treatment by way of Ayurveda, Siddha, Unani and homeopathy, everything will be considered as recognized system of medicine. But Reiki healing treatment is not a recognized system of medicine. So only one is the correct answer. Okay. Then next one. Open area in the precincts of a temple has been rented for a marriage for a day. In which of the following cases such renting is exempt from GST? Okay. So renting of precincts of a temple for marriage means hall, less than 10,000 per day, not equal to 10,000, less than 10,000. So therefore option A is the correct answer. B and C is wrong. Less than 10,000 is only exempted. Then next, which of the following activity is liable to GST? Supply of food by hospital to patients not admitted or their attendants or visitors. Transportation of passengers by non-AC railways other than first class. Service by a brand ambassador by way of folk dance performance where consideration charged is 1,40,000. Transportation of agricultural produce by air from one place to another place in India. Services by way of loading, unloading, packing, storage and warehousing of rice. Service provided by GTA where consideration charged for transportation of goods for a single carriage is 900. Choose the most appropriate option. Take your time because there are 6 cases. For these 6 cases, they are asking which of the cases it is liable to GST. Okay, we'll stop. First one is taxable. Why taxable? They are not admitted, outpatients. So first one is taxable. Second one is exempted. Why? Non-AC other than first class, exempted. Second one is exempted. So one is taxable. Third is taxable. Why? Even though it does not exceed 1,50,000, but they are brand ambassador. So third one is taxable. Fourth one, transportation of agricultural produce by air. Airways, we don't have any exemption. So airways only India to outside India to India. That to India to outside India up to 39. So, but domestic transportation is taxable. Notified goods, we don't have any exemption. So therefore, 1, 3, 4. Fifth one is exempted. Loading, unloading, packing and storage of rice is exempted. Sixth one, GTA service. Previously we had that exemption. If the single carriage freight does not exceed single consignee like that, but that is omitted now. So fully it will be taxable. So therefore the answer is option C, 1, 3, 4, 6. Then next, which of the following statements are true? Service provided by government ITIs to individual trainees are exempt from GST. And service provided by state government and private service provider by way of transportation of patients in an ambulance are exempt from GST. Service of renting of medical shops in a hospital are exempt from GST, being healthcare services. Service provided by police to PSUs are taxable. Choose the most appropriate answer. Okay. So first one is exempted, true. Service provided by government ITI. ITI, I told you, Industrial Training Institute will come under approved vocational education. So any service provided by an education institution to its students, faculty and staff is exempted. So it is exempted there. Service provided by state governments and private service provided by way of transportation of patient in an ambulance is exempted. So second one is also correct, true. Then third one, service of renting of medical shops. Renting of medical shops is how healthcare services, it's not healthcare services, so that is false. Third one is false. Fourth one, service provided by police to PSUs are taxable. True, because police and PSU are not government departments. PSU is different, public sector undertaking. So don't bring it under interdepartmental services. So therefore it will be taxable. True. So therefore 1, 2 and 4 is the correct answer, option A. Next one, Devbhoomi Rice Private Limited, a registered person under GST, is providing services of processing of milli of paddy into rice, loading, unloading, packing, storage and warehouse of rice in the state of Chhattisgarh. The company has made following supplies during the tax period of April to September: loading and unloading of rice 50 lakhs, packing and warehousing of rice 30 lakhs, processing of service of milling of paddy into rice 1 crore. Determine the amount of GST payable on the above supplies, assuming that applicable rate of tax is 5% and amount given herein are exclusive of GST. You need to determine what is the GST payable. Okay. So first one, that is loading and unloading of rice is exempted. Packing and warehousing of rice is also exempted. But milling of paddy into rice is not, because rice is not an agricultural produce. Only 4 activities related to rice is exempted. So this is not exempted, it is taxable. So 1 crore into 5% will be 5 lakhs. So 5 lakhs is the correct answer. Option C. Then next one. A municipal corporation has invited online bids for maintenance of bus stops for a period of 1 year from 1st January to 31st December. The work involves composite supply of goods and services, wherein the supply of service is the principal supply. The value of goods constitutes 25% of the total value of composite supply. Mr. Kumar, Managing Director of Kiladi Contractors Private Limited, located and registered under GST in Gujarat, wants to bid for the same. He seeks your opinion to determine the taxability of above supply to quote the best price. Choose the correct option. Okay. See, it is what we discussed one point. Services provided by a person to government is exempted. If it is a composite supply, then also it will be exempted if the value of goods does not exceed 25% of the total. So in this case, what is the value of goods? 25% of the total. It's a composite supply and that is provided to municipal corporation. So therefore, whether it is GST payable or exempted? Exempted. So the answer is exempted. Then next. Mr. Kumar is the Managing Director of Kiladi Equipments Private Limited. The company is located and registered under GST in Mumbai, Maharashtra. Mr. Kumar has decided to send food grains and other relief materials worth 50 lakhs and 20 lakhs through railways and airways respectively to the cyclone hit victims in Kerala in the month of November. The company has contacted Super Airlines and Indian Railways to transport the materials from Mumbai to Kerala, and price for the same has been determined as 10 lakhs by air and 50,000 by railways, excluding taxes. Mr. Kumar seeks your help to determine the amount of GST payable in respect of services procured from Super Airlines and Indian Railways. If the applicable GST is 18% and amount given are exclusive of GST. So two activities are there: transportation of goods by airlines as well as railways. So if it is taxable or exempted, accordingly you determine an answer. I am starting the timer. Okay, so first transportation of food grains through railways is exempted, correct? So 50,000 is exempted. Railways how much? 50,000 is exempted. So 10 lakhs is for what? Airways. For airways we have any exemption? No. So therefore that will be taxable. So 10 lakhs into 18%, 1 lakh 80,000, and railways nil is the correct answer. So option A is the correct answer. State which of the following statements is incorrect. So false statement. Services by an artist by way of performance in folk or classical art form of music, dance or theatre as a brand ambassador if the consideration charged for such performance is not more than 1,50,000 is exempted. Service of life insurance business under life micro insurance product as approved by Insurance Regulatory and Development Authority having minimum amount of cover of 2 lakhs is exempted. Service by an acquiring bank to any person in relation to settlement of an amount up to 2,500 in a single transaction transacted through credit card, debit card, charge card or other payment card service is exempted. Service provided by GTA by way of transport in a goods carriage of goods where gross amount charged for transportation is 2,250 is exempted. Choose the most appropriate option. Which of these statements are incorrect is the question. Okay. All 4 are incorrect statements. Why first one is incorrect? Sir, brand ambassador will be taxable. They are giving exempted. So false. Second one, see maximum 2 lakhs. That's not minimum 2 lakhs. Micro life insurance is exempted if the maximum sum assured is 2 lakhs. But they are giving minimum 2 lakhs. So that is also false. Why third one is wrong? Because it is 2,000 rupees in a single transaction. Processing fee is exempted under GST if the transaction amount does not exceed 2,000. But here 2,500 is wrong. Then fourth one is wrong because we don't have that exemption now. So it will be taxable. So all 4 statements are incorrect. Option D is the answer. Last one. The Resident Welfare Association of Kutum Housing Society is registered under GST in the state of Maharashtra. There are 103 BHK flats and 104 BHK flats in the society. It received or paid the following amounts excluding GST wherever applicable in the months of January and February. Determine the net GST liability to be paid for the months of January and February assuming that the GST rate is 18% on all inward and outward supplies. So this, I think that image is visible to you. Now you need to compute. You take your time, it's an illustration. I want you to compute and tell me, select the proper answer. Okay. Okay, see this. We'll stop. First, for the month of January, you see, we discuss one point: services provided by a resident welfare association to their members is exempted if per month it does not exceed 7,500 rupees. So, first case, maintenance charges per flat received from all 3 BHK flat owners 7,000 is exempted, and maintenance charges per flat received from all 4 BHK flat owners is taxable. So, the 10,000 will be taxable. And how many 4 BHK flats are there? 100 4 BHK flats. So, 100 into 10,000, that will be 110 lakhs into 18%, that will be 1,80,000. Now, generator purchased for power backup of 4 BHK flats is not in January, February. And taps, pipes and other sanitary fittings purchased for 3 BHK flats is in January, and that is, no, we pay GST, but we cannot take ITC. Why we cannot take ITC? Why we cannot take ITC? See, if our outward supply is exempted, we cannot take ITC on inward supply. 3 BHK flats maintenance charges is exempted now, so we cannot take ITC with respect to the inward supply of that. Whereas 1,80,000 is the answer for January. February you take. February also 1,80,000 only, but we get the ITC. Why we get ITC? For 4 BHK flats we purchased a generator. That generator we can take ITC. Why we can take ITC? Because 4 BHK flats outward supply is taxable. So on inward supply we can take ITC. So 1 lakh into 18%, 18,000. So 1,80,000 minus 18,000, that will be 1,62,000. So therefore the answer is 1,80,000 and 1,62,000. And only one student has answered 9 out of 10 correctly. Girish. Who is Girish? Good, Girish. Already yesterday also one test you answered correct, no? First, super. By any chance you are CA intermediate student? You qualified CA and you are doing CMA. Why are? So why you came for this class then? For revision purpose. Where you attended CA final? More than a year. Okay. Huh? Okay. No issue. So see this, charge under IGST Act, the next area. See, now we are looking into various sections under IGST Act. Section 5, already we discussed the taxable event. Section 9 of CGST Act is similar to Section 5 of IGST Act. And Section 7 and 8 deals with meaning of interstate supply and meaning of intrastate supply. Section 9, supply in territorial waters. And 10 to 14 deals with place of supply. Section 10 to 14. Section 15 and 16. 15 is tourist refund scheme, which is not effective at present, and 16 is zero rated supplies. Okay. Now I am starting with section 7. See, these are the IGST Act sections that we have in syllabus. Okay. In syllabus, what you have is these sections only. In this, 5 already we completed along with 9. Same, whatever is there in 9, the same is there in 5 also. Now 7, meaning of interstate supply. So what is interstate supply? If location of supplier and place of supply is in 2 different states or 2 different union territories, or a state and a union territory, then it will be known as interstate supply. So 7 subsection 1 and 7 subsection 3 says that with respect to goods and services, if location of supplier and place of supply is in 2 different states, 2 different union territories, a state and a union territory, it is interstate supply. And as per 7 subsection 2 and 7 subsection 4, import of goods and import of services is also always treated as interstate supply. Then 7 subsection 5 clause A says, if location of supplier is in India and place of supply is outside India, that transaction is also interstate supply. Supplier is India and the place of supply should be outside India. But sir, it will become export of goods or services. Just because these two conditions are satisfied, it will not become export of service, because yesterday we have seen total 5 conditions should be satisfied in order to become export of service. Supplier in India, recipient outside India, place of supply outside India, consideration is in convertible foreign exchange. In case of Nepal and Bhutan, it can be in Indian rupees. Supplier and recipient are not establishments of the same person. But here only 2 conditions are given: supplier in India, place of supply outside India. Yes, it is export of goods, export of services satisfies this. If other conditions are satisfied, it will become export of goods or services. So that is also deemed interstate supply chargeable to IGST. Then 7.5b says supply to SEZ and supply by SEZ. So whenever we are making supplies to special economic zone or supplies are made by the special economic zone, that is also interstate supply chargeable to IGST. Last one, supply in taxable territory, not intrastate and not elsewhere specified. So that is, they are telling, whenever transactions are not intrastate supply and but the place of supply is in India, then it will be coming under deemed interstate supply. So from this, what are the transactions that you can identify as deemed interstate supply? That is import of goods, import of services, supply to SEZ, supply by SEZ, then location of supplier in India, place of supply outside India, supply in the taxable territory but not elsewhere specified. Okay, what is this supply in taxable territory not elsewhere specified? You can see there next. So this is baseline of India, and if the supply takes place within this landmass, it will be either interstate or intrastate. So depending upon section 7 or section 8. Okay, and so if the supply takes place within territorial waters, if the supply takes place within territorial waters, then again it will be either intra or inter, that will be determined in terms of section 9, not yet discussed. Then suppose if the supply takes place beyond 12 nautical miles and 200 nautical miles, so then it will be coming under supply in the taxable territory. Why? Because for the purpose of GST, India is up to 200 nautical miles from the baseline. Usually 1 nautical mile is approximately, like 2 kilometers, 1.8532 exact. So approximately 2 kilometers. Up to 12 nautical miles from baseline is known as territorial waters. Up to 200 nautical miles from the baseline is known as exclusive economic zone. So therefore, exclusive economic zone is considered as India. So up to territorial waters means we can determine intra or inter. But beyond territorial waters, if the supply takes place in the sea within this area, we don't know what it is, but it is supply in taxable territory, India, but not elsewhere specified. So it will come under deemed interstate supply. That is the 7.5c point. Supply in taxable territory, not an intrastate supply, and not elsewhere specified in this section will come under deemed interstate supply. Then what about outside this 200 nautical miles is known as high seas. There if the supply is happening, will it come under deemed interstate? Yes. Which category? So 7.5a, location of supplier in India and place of supply outside India. Because what is India for the purpose of GST? Up to 200 nautical miles. Beyond 200 nautical miles is known as outside India. So therefore that is also deemed interstate supply. Then next one, as per section 12, we determine the place of supply in case of services if both supplier and recipient are located in India. If any one in India and the other is outside India, we determine the place of supply in terms of section 13. Now, if the place of supply is determined under section 13 and if that is in India, it will always be deemed interstate supply as per section 7.5c, last point. Okay. For example, you see this. Mr. Santosh is an architect who is located in Tamil Nadu, and there is a property which is in Tamil Nadu, and this Santosh is providing architect services to Mr. Sheikh of Dubai. Okay. Now, the place of supply is determined under section 12 or section 13. I told you, If both supplier of service and recipient of service are located in India, then place of supply is determined under section 12. If any one in India and the other outside India, then the place of supply is determined under section 13. So there are only two sections to determine the place of supply in case of services, that is 12 and 13. So that again you can see in the index here. So section 10, 11, 12, 13 and 14. In that 12 and 13 deals with place of supply in case of services. 12 and 13 is place of supply in case of services. In that when 12 will be applicable and when 13 will be applicable, if both supplier and recipient in India, then it is 12. If either supplier or recipient in India and the other outside India, then it will be section 13. Now, so here supplier is Tamil Nadu and recipient is in Dubai. So therefore it will be coming under section 13. As per section 13, in case of any service in relation to immobile property, the location of immobile property will be taken as the place of supply. So where is the immobile property located? Tamil Nadu. Immobile property is in Tamil Nadu. So therefore, it will be coming under Tamil Nadu as the place of supply. Now, whether we determine the place of supply under 12 or 13, 13, and it will always be deemed interstate supply. But if you apply the logic, supplier is in Tamil Nadu, place of supply also Tamil Nadu, but it is not intra. Why it is not intra? Once we determine the place of supply under section 13, it will not come under intrastate supply, it will always be deemed interstate supply. Don't see there location of supplier and place of supply. Generally, what is the difference between intrastate supply and interstate supply? If location of supplier and place of supply is in the same state or same union territory, it is intrastate. Suppose if location of supplier and place of supply is in two different states or two different union territories, or a state and a union territory, it is interstate. So here, logically speaking, supplier in Tamil Nadu and place of supply also Tamil Nadu, but it will not be treated as intrastate because section 7.5c says once the place of supply is determined under section 13, it will be deemed interstate. So now tell me, what are the deemed interstate supplies? Import of goods, import of services, supply to SEZ, supply by SEZ, location of supplier in India and place of supply outside India, then supply beyond 12 nautical miles and up to 200 nautical miles, and place of supply determined under section 13, and that is in India, it will be taken as deemed interstate supply. Got it? Then look into section 8. So this is about section 7. Section 8, meaning of intrastate supply. Already we know the general meaning of intrastate supply. What is intrastate supply? If location of supplier and place of supply is in the same state or same union territory, it is intrastate supply. And we have proviso to section 8.1 which says that following are not at all treated as intrastate. Why? Because it is treated as interstate. Supply to SEZ and supply to by SEZ is treated as deemed interstate, correct? That's why it will never come under intrastate. Import of goods also deemed interstate, that's why it will not come under intrastate. Supply to tourist under section 15. Actually, it is not effective at present. So we have a tourist refund scheme. Whenever there is a foreign tourist who is coming to India, making any purchase of goods, when he takes those goods along with him when he is leaving India, so whatever GST that he paid in India, he will get it as a refund. That is called as tourist refund scheme. But the tourist refund scheme is not yet made effective. So, but we have a provision related to that which says that so supply made to a tourist should be treated as a deemed interstate supply and IGST payable. Why? Then tourist will be easily able to get the refund. Otherwise, you need to get two refunds, one from central government, another from the state government. It will be difficult. That's the reason why supply to a tourist will be treated as deemed interstate. But for theoretical purpose, you remember that. Okay. So one more addition. Total 7 points we remember as deemed interstate. Now one more addition. What is that? So supply to a tourist is deemed interstate. Then even supply to SEZ or supply by SEZ services not treated as intrastate. Okay. And I have given below that what are considered as deemed interstate supplies. You can see there. Supply of goods or services to SEZ. Supply of goods or services by SEZ. Supply of goods to a tourist. Import of goods. Import of services. Export of goods and export of services. Then supply in taxable territory not elsewhere specified. So that already I told you. What is that? Beyond 12 nautical miles and up to 200 nautical miles, or place of supply determined under section 13. Then security lending services under SEBI. So first one we discussed now, sir, CG got solid. In that security lending is there na? That security lending will be through stock exchange. So the supplier, lender of securities don't know who is the borrower of securities. The borrower of securities don't know who is lender of securities. That's the reason why it will be coming under deemed interstate. Even so, priority sector lending certificates, trading in priority sector lending certificates. So we discussed now priority sector lending certificates, the same example, hope you remember. So that trading in priority sector lending certificate is also deemed interstate, understood? So these are the deemed interstate supplies which can be tested as a short note question, or even in MCQs also it can be tested. What are considered as deemed interstate supplies under GST? So these 10 points you need to remember, pa. So can you tell me at least out of these 10 points, some 5 points? Supply to SEZ, by SEZ, import of goods, import of services, export of goods, export of services. Awesome, super. Then supply to a tourist. Next, 3 more. Not elsewhere specified. What is that? Beyond 12 nautical miles and up to 200 nautical miles, or place of supply determined under section 13. 2 more. Security lending, priority sector lending certificates. Okay. So these are the activities which are deemed interstate supply, always chargeable to IGST. Then, so you can see some explanations here. Establishment of a person in India and establishment of a person outside India are treated as distinct persons. Means they are, like, for example, so Infosys Limited you take. Infosys is having a branch in India and they have a overseas branch also. Now Indian branch to overseas branch will be treated as distinct persons. Okay. So we already know registration in a state to a registration in another state is distinct person. One registration to another registration is distinct person within India. But outside India also, a branch in India and a branch outside India will also be treated as distinct persons. Then what is the meaning of establishment? That it is not necessarily a branch, that can be a representative office also. Either agent or branch or representative office will be treated as establishment outside India. Okay. Now we have tourist refund scheme. So this is not effective at present, but it is there in the syllabus. It is there in the syllabus. Practically it is not effective. So there is a supplier who is located in Karnataka, and there is a tourist who is a foreign tourist who is coming to India, and his stay will not be for a period more than 6 months. Logic simple. In income tax, who is a non-resident, his stay in India is for a period not more than 182 days. 182 days literally if you convert into months, approximately 6 months. So in income tax 182 days, in GST it will be 6 months. So foreign national visiting India for non-immigrant purpose and stay in India is for a period less than or equals to 6 months will be called as a tourist. So this tourist is supplying some goods from a supplier in Karnataka, and for which, and it is a deemed interstate supply. So therefore what GST will be charged by the supplier in Karnataka? IGST, even though tourist is in Karnataka, because the moment the tourist gives the passport, because if he need to get the refund, he need to say that I am a tourist, he need to give his passport. So therefore under the strength of that passport, supplier will not charge any GST to the tourist, or he will charge. He will charge with GST, he will charge IGST, he will not charge CGST, SGST. So therefore he will charge IGST and tourist will pay price plus IGST. Now these goods are taken to international airport in India, and from there the goods are taken outside India. Now whatever GST that this tourist has paid, IGST, he will get it as a refund. Okay. So only with respect to goods taken outside India. What if those goods are consumed in India? He will not get. For services he will get refund? No. Only for goods which are taken outside India, for that only IGST paid he will get. Means he need to produce the bill in the international airport and in that whatever IGST is mentioned, that he will get as a refund. A very good scheme. I don't know why they have made it effective. This scheme is popular in Singapore, Malaysia and all. So any person who visits Singapore, Malaysia will buy a lot of electronic gadgets and all. They will buy, they will pay GST. In the international airport, they will get refund of that. Okay, and that gadgets and all they will bring to India. India, they will not pay baggage duty also. They will escape from baggage duty, and electronics and all cheaply will come into India. That's where, you know, for example, many iPhones, iPads and all will be available in India at a cheaper rate because of this reason. Okay, then. So next, deemed interstate supply already we have seen. Now we are moving on to section 9, supply in territorial waters. Section 7, inter. Section 8, intra. Section 9 is supply in territorial waters. What is that? So whenever supply takes place in the territorial waters, the nearest coastal state or union territory should be taken as the place of supply. For example, there is a consulting engineer in Tamil Nadu, and this consulting engineer in Tamil Nadu is providing repairs to a vessel. Where is that vessel? Which is in Bay of Bengal, 10 nautical miles from India. Means with this vessel is within territorial waters. Now this consulting engineer will go to that ship and he will provide the repair services. The place of supply is location where services are actually performed. So therefore, it will be territorial waters. But what should be taken as the place of supply in this case? Nearest coastal state shall be deemed to be place of supply. If the nearest coastal state is Tamil Nadu, then location of supply of Tamil Nadu, place of supply Tamil Nadu, it will become intra. If the nearest coastal state is Andhra Pradesh, then it will become interstate supply. So in case of territorial waters, what should be taken as a place of supply? The nearest coastal state or union territory will be taken as the place of supply. Then we are moving on to the next area. So we completed IGST Act, these sections. So then what about section 10 to 14 that we will be learning in place of supply chapter? And 15 we studied. 16 zero rated supply we will study in refunds chapter. Okay, we have a separate module on refunds. So there we will be studying refunds and zero rated supply there. Then this section 10 to 14 we will learn in place of supply, and remaining sections we have completed in this. Okay. Then look into composition scheme. Composition scheme is a simplified scheme for payment of GST. Rather than paying GST at the regular rates, a person opting for composition scheme will pay GST at the reduced rates rather than regular rates. So to understand this composition scheme, we need to see the cost benefit analysis. So what are the benefits associated with the composition scheme? So let's see an illustration to understand the difference between this. So you can make note of this. There is a person, is an illustration, background illustration on composition scheme. So I am taking two dealers here, dealer A and dealer B. Dealer A and dealer B. Dealer A is opting for normal scheme. Dealer A is opting for normal scheme and dealer B is opting for composition scheme. Dealer A is opting for normal scheme and dealer B is opting for composition scheme. Now, for purchase price, they both are purchasing from the same person. So purchase price is so 1000 and on that GST at 12%, so total is so 120,000. Whereas dealer B also will make purchase 1,120, so 1,120. And what is the input tax credit? Input tax credit to dealer A 120. So GST paid on purchases can be taken as ITC. But dealer B, there is no input tax credit. So what is the disadvantage of composition scheme? A person opting for composition scheme cannot take ITC. Then what is the cost of purchase? What is the cost of purchase? So 1000, because 120 available as ITC, but here entire 1120 is the cost of purchase. Then, so the person who is purchasing has to make a sale. So sale price, they are fixing a sale price as 1500. So both cases 1500, and GST at 12%. GST at 12%, that is 180, but here not applicable. So therefore, the person opting for composition scheme will not charge GST to the recipient, because of which what will happen to the cost to consumer, cost to buyer, 1680 and here 1500. So now tell me, what is the advantage of composition scheme? Sale price decreases. Why sale price decreases? Because the person opting for composition scheme is not charging any GST to the recipient. Because of this, the sale price will decrease. And thereafter, the next one, what is the profit per unit? Profit per unit. Profit per unit. In case of normal scheme, simple. How much they are collecting from customer? 1680. Correct? And they have made a purchase 1120, and they need to pay GST 80 rupees, 60 rupees. Okay, so 1 second, I'll just put it in the next line. You add one more line above that, GST payable. Just one line, GST payable. So what is the GST payable? 180 minus input tax credit 120, that is 60. You understood how we got 60? 180 rupees is the GST on sale. On purchase we have an input tax credit 120. So GST payable will be 60. Whereas in case of dealer B who is opting for composition scheme, they should also pay GST. But they cannot collect the GST from the customer. And how much is that GST? Sale price into 1%. 1% they will pay. 1% means what? 15 rupees. So therefore, what is the difference here? A person opting for composition scheme is required to pay GST at the reduced rate, and that GST what they pay at the reduced rate cannot be recovered from the customer, and they have to pay out of their pocket. So that is the GST payable here. So 60 and 15. And what is the profit per unit? Now you update the profit per unit. So the dealer A got 1680. From that 1680, 1120 is paid on purchase, minus 60 rupees is GST. So therefore, what is the balance? 500. Whereas here they collected 1500, they paid 1120 at the time of purchase, and they have to pay GST of 15. So what is the balance? 1500 minus 1120 minus 15. So that will be 365. So this 365 rupees is the profit per unit. So what is the disadvantage of composition scheme? Profit per unit will come down. But what happens to the sales volume? You tell me. When profit per unit comes down, what happens to sales volume? Like what is the cost to buyer? Cost to buyer is 1680 in case of normal. Composition scheme 1500. So definitely buyer will make purchases from composition scheme dealer. So the sales volume will increase from normal scheme to composition scheme. Suppose here if the sales volume is 1000 units, here it will be 1500 units. Okay. Now see the total profit. See the total profit. What is the total profit? In case of, so normal scheme 1000 into 500. So that is 5 lakhs. 5 lakhs is the profit in case of normal. Whereas composition, if you see 1500 into 365, 5 lakh 47,500. So because of composition scheme, the total profit will increase. Okay, that is the advantage. So therefore, from this illustration only, we can easily understand what are the advantages and disadvantages of composition scheme. So to supplier, what is the benefit? decrease in sale price leads to increase in sales volume, correct? And then total profit will increase. Even though profit per unit is less, but the total profit will increase. Even compliance cost is reduced. Compliance cost means like return filing cost, etc. Because a person opting for normal scheme is required to file, so 12 months GSTR1, 12 months GSTR3B, but a person opting for composition scheme is required to file only quarterly return, that is 4 returns in a year they have to file. And even accounts and records, a person opting for normal scheme is required to maintain lot of accounts and records, but a composition scheme less. And tax payment also, normal scheme they have to pay tax on a monthly basis, but composition scheme they need to pay tax on a quarterly basis, so the compliance cost will come down, okay? And what is the benefit of this composition scheme to the recipient? Only one benefit. So cost is reduced because GST is not charged now, so cost is reduced. What is the losses or disadvantages of composition scheme to the supplier? For recipient there is no disadvantage, for supplier only, that is ITC cannot be availed, correct? Because ITC cannot be availed, there will be increase in purchase price, so decrease in profit per unit. And second, GST will be payable at reduced rates, but that cannot be recovered from the recipient, means because of that also the profit gets affected, okay? Then conclusion, so when we can opt for composition scheme, if sales volume increases, then if sales volume increases, to offset the reduction in profit per unit, means the total profit will increase, then it is advisable to opt for composition scheme. So this cost benefit analysis based question also may be tested in exam year. So because you know CMA final, so already they tested one such question in old syllabus. So in one past exam, they have tested about this cost benefit analysis in old syllabus. So like whatever illustration we discuss now, like that, they will give a question and they will ask, so discuss as to the person should opt for composition scheme or normal scheme, like that. So we need to do this cost benefit analysis, okay? Then next one, look into the provisions here. So during the previous year composition scheme, we have two composition schemes. One is 10 subsection 1 composition scheme, another is 10 subsection 2A composition scheme. Right now I am giving you 10 subsection 1 composition scheme. Previous year, if aggregate turnover of a person does not exceed the specified limit, what is that specified limit? 150 lakhs, and in case of 8 states, the limit will be taken as 75 lakhs. What are those 8 states? Manipur, MMTN, USAM. MMTN is what? Manipur, Mizoram, Tripura, Nagaland. U, that is Uttarakhand, and Sikkim, Arunachal Pradesh and Meghalaya, then the limit will be 75 lakhs. For other states, the limit will be 150 lakhs. Then during the current year, they can opt for composition scheme. Again, during the current year, up to what turnover they will be into composition scheme? Up to that 150 lakhs or 75 lakhs, they will be into composition scheme. After crossing that, they need to go for normal scheme. And during the time when they are under composition scheme, what is the rate at which they will pay GST? See there. So manufacturer, restaurant service provider and trader. Only these three people can opt for composition scheme 10(1). That is manufacturer, restaurant service provider and a trader, okay? And manufacturer, the rate of GST is 0.5% CGST and 0.5% SGST on 0.5 CGST, 0.5 SGST on total turnover. Whereas trader, you see 0.5% CGST, 0.5% SGST on taxable turnover, whereas restaurant service 2.5% CGST, 2.5% SGST on total turnover. Why IGST is not there? Because one of the disqualification in composition scheme is that a person who is making interstate supplies cannot opt for composition scheme. That's why only intrastate supplies will be there. And so rates you need to remember. So CGST 0.5, SGST 0.5 on total turnover for manufacturer, trader 0.5 on taxable turnover, restaurant 2.5 on total turnover. And during the time when they are under composition scheme, can they take ITC on their inward supplies? No, they cannot avail ITC on inward supplies. And the moment they cross that limit of 150 lakhs or 75 lakhs during the current year, next year on thereafter they will be into normal scheme. Even next year also they cannot opt for composition scheme. Why? Because for the next year, this year is the previous year and we are crossing 75 or 150. So next year composition scheme is not possible. And the moment when they go into normal scheme, so they can take ITC on the inward supplies because they will pay GST at the normal rates. Now section 10 subsection 1 is not applicable in some cases. you can remember that with a keyword S9 RCM. Section 9 is RCM na? Section 9 is RCM. So you remember S9 RCM. S for services other than restaurant. So a person who is providing services other than restaurant cannot opt for composition scheme. And non-taxable supplies. Non-taxable supplies means alcoholic liquor for human consumption and petroleum products. A restaurant which is serving liquor cannot, generally restaurant can opt for composition scheme, but a restaurant which is serving liquor cannot opt for composition scheme. A petrol bunk cannot opt for composition scheme because they are making non-taxable supplies. Then interstate supply of goods or services. Then non-resident taxable person, NRTP. So who is NRTP? Who come from outside India to India and is not having any physical place of business in India and making supply of goods or service. Already we discussed yesterday. So that person is NRTP, cannot opt for composition scheme. E for supply of goods or services through e-commerce operator. So a restaurant generally can opt for composition scheme, but they are making supplies through Swiggy, Zomato. Now can they opt for composition scheme? No. Because there is a restriction that a supplier of goods or service through e-commerce operator cannot opt for composition scheme. Then R for recipient liable to pay GST under 9(4). Who is recipient liable to pay GST under 9(4)? Promoter or builder who is making inward supply from an unregistered person. They cannot opt for composition scheme. C for casual taxable person. Difference between non-resident taxable person and casual taxable person is that if they come from other state to this state and is not having any physical place of business in this state, they will be called as CTP. If they come from outside India to India and is not having any physical place of business in India but making supply of goods or services, will be called as NRTP. Okay, both cannot opt for composition scheme. Then manufacture of notified goods. What are those notified goods? Ice cream, edible ice, pan masala, tobacco and tobacco products, aerated waters. Then one more, that is bricks and roofing tiles. Bricks and roofing tiles. Bricks and roofing tiles is also extra that we have. So these are the notified goods: ice cream, edible ice, pan masala, tobacco and tobacco products, aerated waters, bricks and roofing tiles. These are the notified goods. A person who is manufacturing these notified goods cannot opt for composition scheme. Now, Ibaco ice cream shop, they are engaged in sale of ice cream. Can they opt for composition scheme? Yes, because trader of notified goods can opt for composition scheme. Only manufacturer of notified goods cannot opt for composition scheme. Is it clear? Then next, we have one second proviso to section 10 subsection 1. What does it say? A person who is opting for composition scheme under 10(1) cannot render any service other than supply of food, correct? But they can render any other services up to 10% of turnover during previous year or 5 lakhs, whichever is higher. So I am a manufacturer, I am a trader, or I am a restaurant service provider, and I am opting for composition scheme. I can provide other services other than restaurant up to what extent? 10% of turnover during previous year or 5 lakhs, whichever is higher. Now on these services, what is the rate that is applicable? The rate applicable to a trader, that is 0.5% CGST and 0.5% SGST on taxable turnover. Okay, then meaning of various turnovers. Here we need to understand that we come across aggregate turnover for the purpose of registration. Again we come across aggregate turnover for the purpose of deciding the eligibility to opt for composition scheme. Then next we have turnover for computing the 10% limit, and last is turnover for computation of GST payable under composition scheme. So total 4 turnovers. We need to understand what are all the differences. So what is the first turnover? Aggregate turnover for deciding the eligibility to opt for composition scheme or registration. There are 2 aggregate turnovers and 2 turnovers. 2 aggregate turnovers and 2 turnovers. So these 2 aggregate turnovers, what is the difference? First one is to decide the eligibility for registration, and second one is to decide the eligibility to opt for composition scheme. Then next, these 2 turnovers, this turnover is for computation of 10% limit, and this turnover is for computation of payment of GST under composition scheme. Okay, now generally, what is the meaning of aggregate turnover? Aggregate turnover means, so supplies are divided into four. So taxable supplies, exempted supplies, non-taxable supplies and zero rated supplies. So zero rated supplies means export of goods or services will be zero rated supplies. Non-taxable supplies means, so alcoholic liquor for human consumption and petroleum products. Exempted supplies means notified as exempted, nil rated and non-taxable, that will be called as exempted supplies. The balancing figure is known as taxable supplies. All four will come into aggregate turnover. You just write down meaning of like various supplies. What are the various supplies under GST? Various supplies under GST. We have taxable supplies, then exempted supplies, non-taxable supplies, and we have zero rated supplies. So what are considered as non-taxable supplies? We know alcoholic liquor for human consumption, and number two, petroleum products. What are the petroleum products? So petroleum products, total 5 petroleum products we have. Crude oil, then ATF, aviation turbine fuel, petrol, motor spirit commonly known as petrol, then diesel, then natural gas. Then what are zero rated supplies? We have only two as zero rated supplies. So number one, exports, and number two, supplies to SEZ, supplies to special economic zone. These are zero rated supplies. Now what are exempted supplies? Exempted supplies are notified as exempted. So government from time to time will be notifying some supplies as exempted. So notified as exempted. Number two, nil rated. So the rate of GST is nil. And number three, non-taxable. So exempted supplies includes non-taxable supplies also. Then what are taxable supplies? Balancing figure. So if an activity is not coming under, that is if a particular transaction is not coming under exempted supplies, non-taxable supplies or zero rated supplies, that will be coming under taxable supplies on which we need to pay GST. Okay. Now all these four will come under aggregate turnover. Understood? So taxable supplies, exempted supplies, non-taxable supplies, even exports, everything will come interstate. And here taxable, exempted, non-taxable, interest on loans, advances, deposits also will come in aggregate turnover here for registration, because it is an exempted supply. And export of goods or services, interstate supplies also will come. Inward supply under RCM will not come in aggregate turnover. And GST group means CGST, SGST, UT, GST, IGST and compensation cess will not come in aggregate turnover. Now, so in literal meaning, so what is aggregate turnover? Taxable, exempted, non-taxable, zero rated. It excludes inward supply under RCM and it excludes CGST, SGST, etc. Okay. Now, this aggregate turnover is for what purpose? To decide the eligibility for registration. So we have a threshold limit for registration. As and when we cross the threshold limit for registration, we need to register and pay GST. And a threshold limit for registration not applicable because we are determining that only. And basis, aggregate turnover is always computed on a all India basis. Whereas, what is the difference between aggregate turnover generally versus aggregate turnover for the purpose of eligibility to opt for composition scheme. You check the difference. Generally, aggregate turnover will be computed for current year. But to know whether you are eligible to opt for composition scheme or not current year, you need to check the aggregate turnover of previous year, and interest on loans, advances, deposits is actually included in aggregate turnover, but for composition scheme we need to exclude it. We need to exclude it. Also, one more change is that pre-registration turnover will be included. Pre-registration turnover will be included means, so up to some limit I am not required to register. After crossing that limit I will register. Now even before registration also whatever is there that should be included. After registration also whatever is there that should be included. For example, you see the illustration here. During 2019-20, a person commenced business, and on 24/7/2019 his aggregate turnover exceeds 40 lakhs and got registered. Okay. And post registration the aggregate turnover is 130 lakhs up to 31st March 2020. Whether the person is eligible for composition scheme during 2020-21. So current year whether you are eligible to opt for composition scheme or not depends upon the aggregate turnover during the previous year. What is the previous year? 2019-20. For 19-20 what is your aggregate turnover? After registration it is 130 lakhs. And before registration it was 40 lakhs, because only when you cross 40 lakhs you need to register. So therefore whether pre-registration turnover should be added or not? Yes, we need to add. So 40 plus 130, that is 170 lakhs, which exceeds 150 lakhs. So therefore that person is not eligible to opt for composition scheme during current year. So pre-registration turnover should be included. Understood or not? Then next one pa. Then what is the turnover for computing 10% limit? So generally what you said, you need to remember aggregate turnover versus aggregate turnover for composition scheme previous year. Aggregate turnover for composition scheme we will take previous year, and interest on loans, advances will be excluded, and even pre-registration turnover we need to include. Then turnover for computing 10% limit is same as aggregate turnover for composition scheme, except that turnover will be computed state wise and aggregate turnover will be computed on all India basis. So the difference is only in this place. Remaining and all ditto, same as aggregate turnover. Same as aggregate turnover for opting composition scheme, same. Everything same. Only difference is what? Turnover will be computed state wise, not on all India basis. Okay. Now, see this illustration too. A person's aggregate turnover during previous year 2021 is 120 lakhs. Previous year 2021. And opted for composition scheme during current year. Why? Because it does not exceed 150. So they opted for composition scheme during current year. He wants to render services other than restaurant during the current year. Determine the limit up to which services can be rendered based on the following facts. Previous year, such person commenced business and threshold limit is 20 lakhs and post-registration turnover is 100 lakhs. So, whether pre-registration turnover should be included or not while computing the 10% limit for turnover? Yes. So, what is the turnover during current year? What is the turnover during current year? 20 plus 100, that is 120. And interest income during the current year, previous year. So therefore we need to take turnover during the previous year for computing 10% limit, correct or not? So therefore turnover during the previous year is 20 plus 100, 120. And interest income, interest on loans, advances, deposits is how much? 30 lakhs. So take out 30 lakhs. So 120 minus 30 lakhs is what? 90 lakhs. 90 lakhs into 10%, that is 9 lakhs or 5 lakhs, whichever is higher, to that extent they can provide services. So service up to 9 lakhs can be provided during the current year. Generally, a person opting for composition scheme cannot provide any services, but they can provide service up to 10% of turnover during previous year or 5 lakhs, whichever is higher, that limit is 9 lakhs. Got it? Then last turnover, that is turnover for payment of GST under composition scheme. What is the difference between this and the previous turnover? Generally, The turnover for computing 10% limit is taken for previous year. But for computing composition scheme, we take current year turnover. And both will be computed on a state-wise basis. Now, when you take turnover for payment of GST under composition scheme, so this non-taxable supplies, then exports and interstate supplies, if you have, you are not eligible. Previous year, because if you see S9 RCM, N is what? Non-taxable supplies. I is what? Interstate supplies. If you are having non-taxable supplies or interstate supplies, you cannot opt for composition scheme. But when? Current year, not previous year. Previous year you can have non-taxable supplies. Previous year you can have interstate supplies and all. Current year only you should not have. Current year if you have this non-taxable supplies, interstate supplies, you are disqualified from the composition scheme. But remaining and all is same. And interest, everywhere interest is not considered for the purpose of computation in composition scheme. In composition scheme, interest on loans, advances, deposits will not be taken into account. Now, let's see yet another question. Illustration 3. A person commenced business during current year 2021 and on 18/8/2020 his aggregate turnover exceeds 40 lakhs and got registered under composition scheme. He is into trading within the state and aggregate turnover during current year is 200 lakhs. Compute GST payable if applicable rate of GST is 12%. So we have got current year information only because he commenced the business during current year. So previous year is 1920, turnover 0, it does not exceed the threshold limit. So therefore that is limit of 150 lakhs or 75 lakhs. So current year they can opt for composition scheme. But current year first 40 lakhs, they are not at all required to pay GST. Why? Because they are not required to register. The threshold limit for registration is 40. Now, what is the total turnover during the current year? 200. In the 200, first 40, no need to pay GST. Okay. And what is the turnover for composition scheme? 150. So, 200 pa. You logically you understand 200. In the 200, what is covered under composition scheme? What is not covered under composition scheme? 150 is composition scheme, 50 is normal scheme. Clear? In that 150 also, 40 lakhs pre-registration. No need to pay GST. Pre-registration turnover will be excluded. Why? Because you are not registered. So, pre-registration turnover will be excluded. So, exclude 40. So, then what is remaining? 110. On 110, you pay GST under composition scheme, 0.5%, 0.5%, whereas remaining 50, you pay GST under the normal scheme, that is 6% and 6%. Understood? So, what you need to do, total turnover you divide into 2. Turnover under composition scheme, turnover under normal scheme. Turnover under normal scheme, normal rate. Turnover under composition scheme, again, minus pre-registration turnover. Remaining turnover, you will pay 0.5 CGST, 0.5 SGST. If they are trader. Okay, if they are manufacturer, service provider, restaurant service provider, the rate will change. Now look into illustration 4. A Limited opted for composition scheme during financial year 2021 and wanted to render services other than by way of supply of food. Turnover during financial year 1920 is, so previous year 1920, turnover in Tamil Nadu, Karnataka and Maharashtra 60, 30 and 40. So total is how much? 130. 130 means they have not exceeded 150. So current year can they opt for composition scheme? Yes. Determine the limit up to which services can be rendered. So what is the limit up to which services can be provided? So 10% of turnover during previous year or 5 lakhs whichever is higher. So therefore 130 lakhs into 10%, 13 lakhs. Or 5 lakhs, whichever is higher, 13 lakhs. But the answer is wrong. Because we should compute it state-wise. Turnover should be computed state-wise. So therefore, take Tamil Nadu 60 lakhs into 10%, 6 lakhs or 5 lakhs, whichever is higher, 6 lakhs. 30 lakhs into 10%, 3 lakhs or 5 lakhs, whichever is higher, 5 lakhs. 40 lakhs into 10%, 4 lakhs or 5 lakhs, whichever is higher, 5 lakhs. So total 16 lakhs. So therefore, they need to render services for 16 lakhs total and state wise is this. Suppose if in any one state they are crossing this 6 lakhs or 5 lakhs or 5 lakhs, from that date onwards they are disqualified from the composition scheme, not only in that state, in other states also, because in composition scheme you need to remember all registrations will be into composition scheme or all registrations will be into normal scheme. So all in or all out. So mix and match is not possible. Few registrations in composition scheme and few registrations in normal scheme is not possible. Done? Then that is with respect to this. Then we have next composition scheme 10 to A that we will see after a break. Okay. So after break we will complete this and I will be starting with a new chapter, that is value of supply. Okay. Fine. 10 minutes pa. After 10 minutes we'll meet. And those who want book, no, this handwritten book, you can check the admin. We have taken print of it yesterday. So we'll continue with section 10 2A. So we have already seen composition scheme under section 10 subsection 1. That's applicable for a manufacturer, trader and supplier of service, food service provider. Whereas for others in the sense, so any other service provider can opt for 10 2A. So you can see the difference between 10.1 and 10 2A. Who can opt? 10.1 is manufacturer, trader, restaurant service provider. But 10 2A is manufacturer, trader and any service provider. So extra any service provider. And when 10.1 will be applicable? If aggregate turnover during the previous year does not exceed 150 lakhs or 75 lakhs, then they can opt for composition scheme during the current year. But in case of 10 2A, if aggregate turnover during the previous year does not exceed 50 lakhs, here 150 lakhs and for few states it is 75 lakhs, here it is 50 lakhs. And what are the rates of GST? 10.1 already we know the rates. Manufacturer 0.5 on total turnover, trader 0.5 on taxable turnover, restaurant 2.5 on total turnover. But in case of 10 2A, CGST 3%, SGST 3% on total turnover. So 6% we will pay, 3% and 3% on total turnover under 10 2A. Difference in the conditions, so almost all conditions are same. S9 RCM, even for 10 2A also S9 RCM, but that S is not applicable because 10 2A any service provider can opt for a composition scheme. So manufacturer of notified goods cannot opt for composition scheme. Here also manufacturer of notified goods, but they added one more point, supplier of notified services, but that services are yet to be notified. So you remember same conditions. Then, so services other than restaurant can be rendered up to a limit, but here services can be rendered without any limit, but maximum 50 lakhs. Then current year aggregate turnover. So after crossing that, you cannot opt for composition scheme. What is that limit? 75 lakhs or 150 lakhs? Here it is 50 lakhs. When is it advisable to opt for composition scheme 10 2A? You tell me. When it is it advisable to opt for composition scheme 10 2A? Service provider other than restaurant service, because for a manufacturer 10.1 only best, rate is less, value like turnover also high, trader also rate is less, turnover limit is high, restaurant service provider also rate is less, turnover limit is high. But in case of 10 2A 50 lakhs, correct? But 10.1 150 lakhs. Whereas for service provider other than restaurant service, they cannot go for 10.1, so naturally they need to go for 10 2A. Okay. Engaged in supply of service other than restaurant service, or engaged in supply of goods and services beyond the 10% limit, because under 10.1 there is a restriction up to 10% only they can provide. If they want to provide more than the 10%, they will come into 10 2A, but they should remember that the overall limit should not exceed 50 lakhs. For example, turnover during previous year 10 lakhs, and how much services you can provide during the current year? 5 lakhs. 10 lakhs into 10% or 5 lakhs, whichever is higher, 5 lakhs. If you want to provide service more than 5 lakhs, you can go for 10 2A. Same way, 20 lakhs into 10% subject to maximum 5 lakhs, 5 lakhs. 30 lakhs into 10% maximum 5 lakhs. 50 lakhs into 10% 5 lakhs. If you want to provide more than 5 lakhs, you can go for 10 2A. But when the previous year turnover is 60 lakhs, 60 lakhs into 10%, 6 lakhs or 5 lakhs, whichever is higher, you can provide service up to 6 lakhs. But if you want to provide more than 6 lakhs, 10 2A not possible. Why 10 2A not possible? Because turnover during the previous year is exceeding 50 lakhs. So 10 2A not possible. Then how to enter into composition scheme? Entry into composition scheme. If you are already a registered person in the beginning of the current year, then you can file a form, intimation form, that is form GST CMP2 before commencement of the relevant financial year. Suppose if you are not registered in the beginning of the, you are not registered, now only you need to register and go into composition scheme. Anytime you can enter into composition scheme by making an application for registration in REG1. Got it? If you are already registered, you have to wait till the beginning of the financial year and then only you can go into the composition scheme. Suppose if you are not registered in the beginning of the financial year, so now only you are getting registered, then anytime you can enter into the composition scheme by making application for registration in REG1. Exit from the composition scheme, we need to file form GST CMP4. Entry will be CMP2, exit will be CMP4. And what is the time limit within which you need to exit from composition scheme? Suppose you breach the conditions, like your turnover exceeded the limit, or you are making interstate supply or making supplies through e-commerce operator and all. So within 7 days from the date of breach, you need to come out. Voluntarily, anytime in a financial year, you can come out of it. The moment you are coming out of the composition scheme, you can take ITC on your inputs, because up to one date you were under composition scheme. When you were under composition scheme, you would not have taken ITC on your purchases. Now, the moment you go into normal scheme, whatever is the closing stock before the date of conversion from where to where? Composition to normal scheme. Before that date, some closing stock is there now. On that closing stock, whatever GST paid, you can take as ITC. See this, avail ITC on closing stock under section 18(1)(c) as on the date before exit from the composition scheme. So as and when we migrate from composition scheme to normal scheme, there will be one closing stock on, because that closing stock only we use under normal scheme. So on that closing stock, whatever GST is paid, that can be taken as ITC. Same way, reverse. When you are going into composition scheme, right now you are under normal scheme, you go into composition scheme. When you go into composition scheme, you should not enjoy the ITC. During the time when you were under normal scheme, you made some purchases on that ITC is there, that needs to be reversed. So composition scheme to normal scheme, avail ITC on closing stock. Normal scheme to composition scheme, reverse the ITC on closing stock. So whenever you are going into composition scheme, reversal of ITC on closing stock under 18 subsection 4 as on the date before opting for composition scheme. It is simple here, don't get confused. That is, you were under composition scheme up to one date. Okay, you were under composition scheme up to one date. So during this time, when you made purchases, whether you can take ITC? No. And the moment when you are under normal scheme, can you take ITC on inward supplies? Yes. Now there is some closing stock here. Okay, there is some closing stock here. On this closing stock, which date? Before the date of conversion from composition scheme to normal scheme. On this closing stock, whether GST is paid? Yes. ITC availed at that time? No. Why? Because you were under composition scheme. But using this closing stock only, you will make supplies under normal scheme, correct or not? Which means on this closing stock, GST paid should be availed as ITC. Got it? GST paid availed as ITC. GST paid availed as ITC. Understood? Availed means taking ITC. Then suppose you are under normal scheme. You are under normal scheme and you are going into composition scheme. When you are under normal scheme, you would have enjoyed the ITC. The moment you go into composition scheme, you should not take the ITC. Okay. Now, before the date of conversion, you have got some closing stock. And on this closing stock, whether you have already availed ITC? On this closing stock, whether you have already availed ITC? Yes, because you were under normal scheme. Now, using this closing stock, you will make supplies under composition scheme. Then the moment when you go into this composition scheme, you need to reverse the ITC availed. Okay, reverse means what? Reduce. Okay, reverse ITC already availed. Reverse ITC already availed. So when you will avail ITC on closing stock, when you will reverse ITC on closing stock? When you will avail ITC and when you will reverse ITC? Composition scheme to normal scheme, avail ITC on closing stock. Normal scheme to composition scheme, reverse the ITC on closing stock. Done? Those 2 points only, I just connected it here. Whenever you are exiting from the composition scheme, you go into normal, so avail the ITC on closing stock. Whenever you go into composition scheme from normal scheme, you reverse the ITC on closing stock. Then, there are other forms also. CMP2 is for entry into composition scheme. CMP, form GST CMP. CMP refers to composition. CMP2 is for entry into composition scheme. CMP4 is for exit from composition scheme. CMP5 is whenever you have to exit from the composition scheme, but you did not exit, means you breached the condition and you still continued in the composition scheme, then officer will give a notice asking you to exit from the composition scheme. That notice is in CMP 5. 5. Notice is in CMP 5. Reply to the notice is in CMP 6. And what is the time limit within which you need to give reply? Within 15 days from the date of receipt. And thereafter CMP 7, they will pass an order either allowing you to continue in the composition scheme or denying the composition scheme within 30 days. So CMP 2, entry into composition scheme. When? Before the date of commencement of the financial year. And CMP 4, exit from the composition scheme. When? Within 7 days from the date you committed the breach. And then CMP 5, notice anytime. CMP 6, reply to the notice within 15 days from the date of notice. CMP 7, order for denying or allowing the composition scheme, that is 30 days from the date of notice. Okay, reply to the notice. And there is one more form, that is CMP 8. CMP 8 is a return which we study in returns chapter. CMP 8 is a quarterly return which is to be filed by every person opting for composition scheme by 18th of the month following every quarter, because I told you that under composition scheme the returns will be quarterly returns and quarterly payment of tax, that is a quarterly return. Now, denial of composition scheme, whether it is prospective or retrospective, what does it mean? Say for example, on 1st April 2019 a person opted for composition scheme, and so on 18 September 2019, he made supplies through e-commerce operator. When he made supplies through e-commerce operator, he breached the condition, because whenever you are making supplies through e-commerce operator, S9 RCM, you should not make. But you are making supply through e-commerce operator, means you are disqualified from the composition scheme. But you did not disclose that fact and you continued in the composition scheme till 31st March. And thereafter next financial year, officer has identified that you made a breach. So they are giving a notice. Now you are giving a reply to the notice, sir, we made only one transaction through e-commerce operator, like that. But officer passing an order for denial of the composition scheme. Now, from when he can deny the composition scheme? Either prospective. Prospective means when the order is given 29th June. From 29th June, or retrospective. Retrospective means backwards, but not before the date of breach. What is the date of breach? 18th September. So not before 18th September. So on or after 18th September, any date they can disallow, but not before 18th September. Understood? Then look into this issue number 1. A Limited is in Tamil Nadu, Andhra Pradesh and Karnataka, and Tamil Nadu and Karnataka, Andhra Pradesh and Karnataka, they want to opt for normal scheme. Tamil Nadu, they want to opt for composition scheme. Is it possible? No. All in, all out. All registrations of a person will be into normal scheme. All registrations of a person will be into composition scheme. But mix and match is not possible. Then issue number 2. A Limited is doing business in Tamil Nadu. Then limit will be 150 lakhs. They are doing business in Nagaland. Then the limit will be 75 lakhs. Now their aggregate turnover during the previous year is 80 lakhs, both in Nagaland and Tamil Nadu. So if it is 80 lakhs, in Tamil Nadu they can opt for composition scheme. In Nagaland they cannot opt for composition scheme, because for Nagaland the limit is 75 lakhs. So now in this case, as they are disqualified in Nagaland, they are also disqualified in Tamil Nadu. So therefore they cannot opt for composition scheme. So whenever we have few states with 150 lakhs limit and few states with 75 lakhs limit, which should be taken as the turnover limit for composition scheme, 75 lakhs only. So this is about composition scheme that we have completed. Okay. Now we will do one MCQ test on this. Okay. So use this ID 119481018. Just 8 MCQs only. As I am not having that much time to do the problems and solutions, that's why I am making you to do MCQs. Some practice should be there, na? One 119481018. Which of the following statement is incorrect? A trader of tobacco products can opt for composition scheme. The applicable limit for composition scheme for an authorized service center in Mizoram is 75 lakhs. Interstate supplier of goods cannot opt for composition scheme. Person having inward supplies under RCM can opt for composition scheme. One 018. Okay. A trader of tobacco products can opt for composition scheme. True, correct. Why is it incorrect? Only manufacturer of notified goods cannot opt. What are those notified goods? Pan masala, tobacco and tobacco products, ice cream, edible ice, aerated waters, bricks and roofing tiles. But only manufacturer. Trader can opt for composition scheme now. So first one is correct. The applicable limit for opting composition scheme for an authorized service center. Service center 10-2A. 10-2A limit is what? 50 lakhs. But they are telling 75 lakhs. So that is incorrect. So B is incorrect statement. Interstate supplier of goods cannot opt for composition scheme. True only. Interstate supplier of goods or services cannot opt for composition scheme. True. Person having inward supplies under RCM can opt for composition scheme. True. They can opt for composition scheme. Only thing 9 subsection 4 they cannot opt for composition scheme. We have 9.3 and 9.4. In that restriction is for whom? Only for 9.4, not for 9.3. 9.3 they can opt for composition scheme, but they need to pay GST at the normal rates. On outward supply only reduced rates, 1%, that is 0.5, 0.5, 2.5 like that. But on inward supply they need to pay GST at the normal rate, so that is also true. Only B is the incorrect statement. Which of the following statement is correct? Use the logic, odd one out, you will get. Okay. Say person opting for composition scheme can file quarterly return in GSTR 4. Incorrect. What is a quarterly return? Just now I said CMP 8. That is not GSTR 4. GSTR 4 is now an annual return. Previously it was a quarterly return. Now it is an annual return. So therefore that is not applicable. To withdraw from composition scheme, it is CMP 4, not CMP 2. CMP 2 is for entry. So that also incorrect. A person opting for composition scheme is required to maintain records. Yes, they are required to maintain records. Some records they need to maintain. Order for denying composition scheme is passed in form GST CMP 5. No, incorrect. It is in CMP 7 order. So therefore C is the correct option. Which of the following statement is incorrect? Person opting for composition scheme need to pay GST in separate heads. Person opting for composition scheme should reverse ITC on closing stock. Person opting for composition scheme can avail ITC on closing stock. Composition scheme to normal scheme is possible at any time during the financial year. Which of the following are incorrect? Okay. So person opting for composition scheme need to pay GST in separate heads is correct. Correct only. Person opting for composition scheme should reverse the ITC on closing stock. Yes, normal scheme to composition scheme, they need to reverse the ITC on closing stock. Person opting for composition scheme can avail ITC on closing stock is incorrect. They cannot avail, they have to reverse. Composition scheme to normal scheme, anytime, yes. Only normal scheme to composition scheme before commencement of the financial year. But I am under normal scheme, I need to exit from the normal scheme. I am under composition scheme, I need to exit from composition scheme, anytime I can exit. So C is the correct answer here. Next one. Which of the following person cannot opt for composition scheme? Okay. Mr. B, a garment trader having turnover of 40 lakhs during previous year and current year, he further rents out his shop and charges 70,000 per month. So trader having 40 lakhs during previous year, he further rents out his shop at 70,000 per month. 70,000 into 12 is what? 8 lakh 40,000. Okay. Previous year 40 lakhs. How much services they can provide? 40 lakhs into 10% subject to maximum 5 lakhs. But they can go for 10 to A. Under 10 to A there is no restriction. Under 10 to A 10% restriction is not there and the overall limit is 50 lakhs only. So therefore they can opt for composition scheme. First case they can opt for composition scheme. Second, manufacturer of handbags having turnover up to 60 lakhs. They can also opt for composition scheme. Why? Manufacturer is 10-1. 10-1 limit is what? 150 lakhs or 75 lakhs. So definitely they can. D, selling handbags through e-commerce portal. So any supplier of goods or services through e-commerce operator cannot opt for composition scheme. So C is the answer. Then next one. Which of the following persons can opt for composition scheme under subsection 1 and 2 of section 10 of CGST Act in the state of Delhi? Registered person whose aggregate turnover in the preceding financial year did not exceed 75 lakhs. Registered person whose aggregate turnover in the preceding financial year did not exceed 1.5 crores. Third, a person engaged in manufacture of pan masala, tobacco products. A person engaged in manufacture of ice cream, other edible ice. Person engaged exclusively in providing restaurant service. Person engaged exclusively in supply of medicines. Okay. First one pa, they can opt for composition scheme. Delhi limit is 150 lakhs. So first one composition scheme is possible. Second one also possible. Third one no. Manufacture of notified goods. Fourth also no. Fifth yes. So 1, 2, 5. 6 medicine, sale of medicine, yes. So 1, 2, 5, 6 is the correct answer. Option B. Which of the following statement is not correct for a taxpayer who has opted for composition scheme? Not correct. Okay. A registered person supplying goods under composition scheme shall issue a bill of supply. True. Instead of tax invoice, they will be giving bill of supply. Last date for payment of liability towards tax, interest, penalty is 20th of each month. No, 18th of the month following every quarter. So that is incorrect. Composition dealer shall mention the words composition taxable person on the top of bill of supply. True. Last date of payment of liability is 18th. That is also 18th day of the month following each quarter. True. So therefore, B is the incorrect one. Then Mr. Kanjus, located in Delhi, wants to opt for composition scheme for financial year 18-19. He is engaged in trading of branded flour, which is taxable at 5%, and unbranded flour, which is taxable at 0%. Turnover of branded flour is 70 lakhs, turnover of unbranded flour is 20 lakhs. He was also providing service in the previous year by way of renting of a residential unit, for which he is charging 1 lakh per month as rent. Calculate his aggregate turnover to determine his eligibility to opt for composition scheme. Okay, simple one only. So here, first we need to take 70 lakhs. Taxable turnover, exempted turnover, everything will come in aggregate turnover. So 70 plus 20, 90. Not 91 lakhs, because that 1 lakh is per month. You need to multiply by 12. So 12 in 12, 1 lakh into 12, 12 lakhs. So 12 lakhs plus 90, 1 or 2 lakhs. 1 or 2 lakhs is the correct answer. Option C, last one. Messrs. Gopi Narayanan and Company is a partnership firm of advocates registered under GST in Mumbai, Maharashtra, for providing various legal and consulting service across the country. The turnover of Gopi Narayanan and Company in the previous financial year was 50 lakhs. The firm is engaged solely in providing legal service, and it does not import or export any service from or to outside India. Which of the following statements these are correct in law? Gopi Narayan Company is eligible to opt for composition levy under subsection 1 and 2 of section 10, or not eligible to opt. Third one is eligible to opt for composition scheme under 10(2)(a). Fourth one, not eligible to opt for composition scheme under 10(2)(a). Which of the following statements are correct? Okay. So they are making services across the country, means they are making interstate supplies. If they are making interstate supplies, can they opt for composition scheme? No, they cannot opt for composition scheme. So 2 and 3 is the correct answer. They cannot opt for composition scheme and not eligible to opt for composition scheme under 10(2)A also. Why 10(2)A also not possible? Because they are providing services across the country. So therefore the answer is 2 and 4. 2 and 4. They are not eligible under 10(1). They are not eligible under 10(2)A also. Both cases, because both cases common condition na. A person who is making interstate supply of goods or services cannot opt for composition scheme. Good here. So 6 students have got good marks, 5 out of 8. 5 out of 8 the highest. Okay. So fine. And we will move on to the next area now. That is one second, just open the document. So now we are moving on to value of supply. I think it is module 4, I think. See, this module 4 is about value of supply. In this value of supply, we have section 15, only one section, but lot of rules are there. These rules related information you would not have studied at CA intermediate level if you are doing CA intermediate. So CMA final only you will be studying that. So that's an extra portion. And CA final or CMA final, both places it is there, it's common only. So value of supply as per section 15. Section 15 subsection 1 says that the value will be transaction value. What is transaction value? Price involved in the transaction, that is price actually paid or payable. And as per 15 subsection 2, there are total 5 inclusions in the transaction value. What are they? Taxes, duties and cess by whatever name called other than GST. So while computing GST, to the price, you need to add all taxes, duties and cess by whatever name called. Then next one, 15(2)B, any amount that the supplier is liable to pay but which is paid by the recipient. Actually it is a liability of the supplier but which is paid by the recipient. So it should be included in the value. Then 15(2)C, supplier is incurring some expenses and recovering it from the recipient before or at the time of delivery of goods or before at the time of supply of service. That should be included in the value. So first we need to take price, the price given in the question as the transaction value. For that we need to make 5 inclusions. In that you remember these 5 inclusions, TRSIS, TRSIS. So T for taxes, duties and cess by whatever name called other than GST. So GST don't include but other tax and duties you include. And R, recipient is incurring some expenditure. On whose behalf? Supplier's behalf. Means actually that amount supplier has to pay but recipient is paying, that's an indirect consideration to the supplier, so include it. Then supplier incurring some expenses like freight, advertisement, packing, etc. and charged it to recipient. When is it charged to recipient? Before delivery of goods or before supply of service, then include it. Then fourth one, interest, late fee or penalty for delay in receipt of consideration. So this I told you, interest is taxable under GST only in one case. Generally interest on loans, advances, deposits is exempted, but interest on account of delay in receipt of consideration will be included in the value. Okay, then like you have to pay money within 3 months, you did not pay, so I am collecting some interest from you, that should be included in the value. Then last one, subsidies. Subsidies from central government, state government, anyhow not treated as consideration. So this subsidy should be from whom? Other than central government or state government, and that should be directly linked to the price, which means the subsidy should be connected to the outward supply. So then it will be called as directly linked to the price. These are the 5 inclusions. So transaction value, then TRSIS, T for taxes, duties and cess by whatever name called other than GST, R recipient incurring expenses on behalf of supplier. Yes, supplier incurring expenses and charged it to recipient before delivery of goods or before supply of service. Then I, interest, late fee, penalty for delay in receipt of consideration. Then yes, subsidies from other than central government or state government directly linked to price. Okay. Now, exclusions, if you see, so discount is excluded, but the discount is divided into two. Discount given before or at the time of supply, discount given after supply. If discount is given before at the time of supply, it will be deductible. So, because at the time of invoice itself, we know how much discount we are giving. For example, 10,000 is the price, 2,000 is the discount, 10,000 minus 2,000, 8,000 will be taken. But if the discount is given after supply, but the terms are agreed before or at the time of supply, example, cash discount. So, first I will agree the terms today, but the discount I will give afterwards whenever you make the payment. So, discount given after supply means post supply discount, but the terms are agreed before at the time of supply, it is allowed as deduction. But invoice is already prepared. So, therefore, we need to give a credit note. Who need to give a credit note? Supplier is required to give a credit note to the recipient. Whenever supplier gives a credit note to the recipient, recipient will reverse the ITC with respect to that. So, discount given after supply, but it is known before at the time of supply to be deducted from price, credit note to be issued for that. What if discount is given after supply and the terms are not agreed before at the time of supply? Example, end of season sale discount. That is, we are not committing the discount now, but end of the season, so whenever the goods are not moving, so we are offering some discount to the wholesaler or retailer, etc. Then again, this will not be allowed as deduction because so it is not known before or at the time of supply, not deducted, and credit note cannot be issued in this case. So these are the three subsections that we have for 15, meaning, inclusions, exclusions. Now, so what we need to do while doing the problem solving is that first you need to see whether an amount is to be included or to be excluded. And in the given price, what they have done, depending upon the treatment you need to follow. So for example, packing charges. Packing charges as per 15(2)(c), it is to be included. So before delivery of goods, na packing, so it is to be included. And in the given price, it is already included. Will you include it again? No, ignore. Then second example, freight. Freight again before delivery of goods, so it is to be included. But in the given price, it is not included. So therefore, we need to add. Then third, GST. As per section 15(2)(a), taxes other than GST should be included, but GST to be excluded. In the given price, it is included. So what you need to do, you need to deduct. Then next, subsidy from central government or state government, it is to be excluded because subsidy from other than central government or state government will be included, but central government or state government will be excluded. In the given price, it is already excluded. So therefore, we need to ignore. So you remember these four principles while doing this solution. Then value of supply will be taken as transaction value, that is price paid or payable, if two conditions are satisfied. What are the two conditions? Price must be the sole consideration, supplier and recipient are not related. If price is not the sole consideration or supplier and recipient are related, then transaction value not applicable. If any one or both the conditions not satisfied, transaction value not applicable. We need to determine the value as per rules, CGST rules, that is given in 15 subsection 4. Okay, 15 subsection 4 says if you are unable to determine the transaction value as per 15(1), why you are unable to determine? Maybe they are related or maybe price is not sole consideration, then value has to be determined as per rules is given in 15(4). Then 15 subsection 5 says that there are some notified transactions which are given in the rules. With respect to that notified transactions, you need to always follow the value as per rules only, even though transaction value is applicable. For example, in case of transaction between distinct persons, anyhow transaction value applicable, but as we have rule 28 specifically for transaction between distinct person, we need to follow rule 28 only, and we should not follow transaction value. Same way, principal agent transaction. Principal agent transaction value applicable, but even then, as there is a specific rule number 29 which talks about principal agent transaction, we need to follow rule number 29 only, and we should not see. So this section 15 transaction value, that is the meaning of 15.5. With respect to notified transactions, value will be determined as per CGST rules, and we have rule 27, rule 28, rule 29 to rule 35. Rule 27 to rule 35 talks about the valuation related to GST as per rules. Okay, which rule to which rule? Rule 27 to rule 35. Rule 27 says when price is not the sole consideration, so transaction value will be applicable when price is the sole consideration. So if that condition is not satisfied, when price is not the sole consideration, then we need to determine value as per rule 27, which says you take open market value. Open market value means what? Price prevailing between two unrelated parties on the same day, like comparable uncontrolled price in transfer pricing, like that. So between two unrelated parties, whatever is the price prevailing as on today, you take that as the open market value. What if we don't have that price as on today? Then you take money received plus money value of non-monetary consideration. So that is, say for example, I am purchasing one new TV by exchanging old TV of mine. So now I paid 30,000 rupees plus I gave old TV and I got a new TV. Now what will be taken? What is the open market value of that new TV? Price is not the sole consideration now. Why price is not sole consideration? There is some other consideration in the form of old TV. So price is not sole consideration. So first we need to take open market value. And second, money received plus money value of non-monetary consideration. That is, so 30,000 rupees plus we need to take the value of old TV. What if value of old TV could not be ascertained? Then third, we need to take like, kind and quality. Means not today, but some nearest time before, some TV would have been sold at one price, this new TV. So that price we will take, like, kind and quality. What is the difference between open market value and like, kind and quality? Open market value, same date, but like, kind and quality, nearest date. Okay. Then suppose that is also not there. It is a brand new TV. We have not sold it. This is the first transaction. Then in that case, rule 30, which says cost plus 10%. So if he is a manufacturer, cost of production plus 10%. If he is a buyer, cost of acquisition plus 10%. If he is a service provider, cost of providing service plus 10%. So this will be taken. Say we are unable to determine that way also, cost also, then we need to go for residual value, rule 31, where the person, that is registered person, will determine the value and which may or may not be accepted by the officer. So this is the sequence you need to remember. Okay. So first we will see the applicability of the rules. Rule 27 is applicable when price is not sole consideration. 28 is applicable when related party transactions including transaction between distinct persons. And 29 is applicable when principal agent transaction. Now if 28, 27, 28, 29 is not applicable, then rule 30 is applicable. What does rule 30 says? Cost plus 10%. If rule 30 also not applicable, then 31, that is residual value. That is the applicability. Got it? Rule 28 to rule 31. 28, price is not sole consideration. 27, price is not sole consideration. 28, related party including distinct person. 29, principal and agent. If these three, any of these three not applicable, 30, cost plus 10%. If that is also not applicable, residual value. Now in 27, what is the first priority? Open market value. If that is not applicable, then money received plus money value of non-monetary consideration. If that is also not available, like, kind and quality. If not, rule 30 and rule 31. Then rule 28 you see. Rule 28 says that we need to take open market value. And what will be taken as the open market value? If recipient is eligible for full ITC, When recipient will be eligible for a full ITC? I am supplier. You are my recipient. When you will be eligible for full ITC? If your outward supplies are only taxable, you are eligible for full ITC. If your outward supply is partly taxable, partly exempted, are you eligible for full ITC? No. So therefore, whenever recipient is eligible for full ITC, recipient can take full ITC. So therefore, whatever is the price that I am charging to you itself is the open market value. No need to determine the open market value. Open market value is deemed to be the transaction value. If recipient is eligible for full ITC, then open market value is deemed to be transaction value. Otherwise, we need to determine the open market value. Say, we are unable to determine the open market value. Now, in the second rule, second point is missing. Which is the second point? Money received plus money value of non-monetary consideration is missing. So, like, kind and quality. And if like, kind and quality not possible, cost plus 10%. Understood? And suppose if that is also not possible, residual value. Alternatively, we don't have to follow these three: open market value, like, kind and quality, cost plus 10% or rule 31. We can go for 90% of resale price. Resale price method. I am selling to you for 100. You are selling to your buyer for 200. Now take 200 into 90% as my price. Means the assumption is what? You will be adding a profit margin of 10%. I am selling to you here, you are subsequently selling to at one price, take that subsequent sale price, resale price into 90%, means assumption is what? You are adding a profit of 10%, so therefore 90% will be my price, that is taken resale price method, but only in case of goods. Alternatively, with respect to each invoice, value of goods equals to 90% of resale price to unrelated buyer, but goods should not have been processed here. So if the goods are processed, means we will not take. So I am selling to you some goods, as such you should be selling it to subsequent person, because if you do process, how can I know what is the value addition that you are making? You got it? So then, this is about rule 28. Rule 29, third point is missing. Which one? Like, kind and quality. It is directly open market value or 90% of resale price at the option of the supplier. If that is not possible, directly cost plus 10%, if not residual value. Understood? So 27, 28, 29, 30 and 31, everything in one page. Okay. Now rule 31A. Rule 31A is applicable in case of lottery, betting and gambling, because only three are covered under supply. Actionable claims other than lottery, betting, gambling excluded from supply. Only lottery, betting, gambling is covered under supply. So therefore, what will be taken as the value? So we need to take, in case of lottery tickets, price as notified by the organizing state, or that is price printed on the ticket, or price as notified by the organizing state, whichever is higher. Whichever is higher. So usually price printed on the ticket will be taken. But sometimes because of the demand, government will increase the price of the lottery ticket. Printed 500. But they will say it will be sold at 800, because lot of demand is there for the lottery tickets. Now in that case, whichever is higher, which is higher? 800, and we will take it on an inclusive basis. So which means how to compute the GST on inclusive basis? Rule 35 says, whenever we are collecting an amount which is inclusive of GST, means GST not charged separately, then that should be considered as inclusive of GST, and the GST will be into rate divided by 100 plus rate, means 28% GST is applicable on lottery. So into 28 by 128 will be GST, into 100 by 128 will be value. So price printed or notified by organizing state, whichever is higher, into 100 by 128 will be taken as a value, means assuming that this price is inclusive of GST. You got it? So 28 by 128 is what? GST component. 100 by 128 is what? Value. Same way, in case of betting and gambling, we will take total bet value. For example, say there is a horse race and there are 5 horses, and people will place bet on all the 5 horses, but only one horse is going to win. And whether GST payable only on the bet value of winning horse? No, total bet value, means on winning horse also, losing horse also, everyone will place a bet. on entire bet value, whether you are winning or losing, government is winning. You understood or not? On the total bet value, GST will be payable. So at the rate of 28%. So into 28 by 128, and the value will be into 100 by 128. So total bet value into 100 by 128. This is rule 31A. Then rule 32. This rule 32 is a optional method applicable for 5 suppliers. So there are 5 cases where instead of following the regular transaction value, we can follow the value as per rule 32. With respect to each invoice, supplier can choose transaction value under 51 or value under rule 32. So either they can go for transaction value or they can derive the value as per this rule also. Who are those 5 people? Foreign exchange transactions including money changing, air travel agent, life insurance business, not life insurance agent, life insurance business, second hand dealer in goods, vouchers or coupons. These 5 cases, they have a simplified valuation methodology optional under rule 32. First we will see foreign exchange transactions including money changing. What is their business? Converting from one currency to another currency. Option 1, suppose if the transaction involving Indian rupees, okay, then what we need to do? We need to take whether RBI reference rate is available or not available. If RBI reference rate is available, difference between bid or ask, that is purchase currency or sold currency, and RBI reference rate into units of currency will be taken as the value. If RBI reference rate is not available, then what we need to do? Gross amount in Indian rupees into 1%. And in case of cross currency transaction, we need to take purchased currency converted into Indian rupees into 1% or sold currency converted into Indian rupees into 1%, whichever is lower. So let's see how to arrive at the computation for this. You can make note. Illustrations on Forex transactions, rule 32, sub rule 2. First, so we have a quote. So rupee per dollar 82, 84. What does it mean? 82 is bid. Bid means what buying rate? Bank dollar buying rate. Bank dollar buying rate is 82. And ask 84. What is that 84? Bank dollar selling rate. If bank is buying dollars, they will buy at 82. If they are selling dollars, so they will be selling at 84. So the difference is only called as spread, which is nothing but the gain to the bank. Okay. So in financial management, you should have studied this. Okay. And here an exporter is selling $10,000. If exporter is selling $10,000, then what bank is doing? Buying dollars. Bank purchases dollars. So what is the relevant rate? Rate is 82 rupees per dollar. Rate is rupees 82 per dollar. Now we have RBI reference rate. Okay, we have RBI reference rate. So usually RBI will not be giving this rate. They have given it now to FBIL, Financial Benchmarks India Limited. So they will be giving this rate. RBI reference rate is, say, we have 83.5 per dollar is the RBI reference rate. Now what we need to do? Value equals to, we need to take bid rate or ask rate. So which is the relevant rate? 82.82. So 82 per dollar minus RBI reference rate. What is the RBI reference rate? 83.5 per dollar. And what is the units of currency? 10,000. So total, ignore negative and all, just difference we need to take. So 82 and 83.5, 1.5. 1.5 into 10,000 is what? 15,000 rupees will be taken as the value. Understood? Purchased currency or sold currency converted into Indian rupees. Okay. So, but depending upon the rate, which rate? Either bid rate or ask rate minus RBI reference rate into units of currency. Now, second, what if RBI reference rate is not available? What if RBI reference rate not available? If RBI reference rate is not available, what we will do? We will take value as gross amount in Indian rupees. What is the gross amount in Indian rupees? How many dollars we are exchanging? $10,000. At what rate we are exchanging? 82 rupees per dollar. On that we need to multiply 1%. So 10,000 into 82 into 1%, that will be rupees 8,200 will be taken as the value. Understood? Purchased currency or sold currency converted into Indian rupees depends upon the rate, and $10,000 into 82 into 1%, gross amount in Indian rupees into 1% will be taken as the value. Then third question, here cross currency quote. Cross currency quote, see this, dollar per pound, dollar per pound. So that is 0.8 and 0.82. So $1, 1 pound, okay, sorry, 1 second. So 1 pound is $1.5, $1.8. Okay. So means if you give 1 pound, you will get $1.5 or $1.8. 1.5 is what? Bid. What bid? Bank. What buying rate? Pound buying rate. Bank pound buying rate. And 1.8 is what? Bank pound selling rate. Bank pound selling rate. Now, what happens is that a person exchanged $10,000 for pounds. Okay. Then what bank is doing? If he is selling dollars, what bank is doing? Bank is purchasing dollars. Bank is purchasing dollars. But the quote is dollar per pound. So therefore, we need to convert this quote into indirect quote. Okay, because we need dollar in the denominator. So therefore, pound per dollar equals to 1 divided by 1.8 and 1 divided by 1.5. Why like that? Because whenever we convert direct to indirect or indirect to direct, so bid will become ask, ask will become bid. So it will change. So therefore 1 divided by 1.8 is what? 1 divided by 1.8 is 0.55 and 1 divided by 1.5 is 0.67. So 0.55 is bank dollar buying rate and 0.67 is bank dollar selling rate. Bank dollar buying rate and bank dollar selling rate. Bank dollar selling rate. So what is the relevant rate here? Bank is purchasing dollars. So then the relevant rate is, therefore relevant rate. So bank is purchasing dollars. So the relevant rate is 0.55 pounds per dollar. For $1 it is 0.55 pounds. And we need to understand how many dollars is exchanged into pounds. So $10,000 exchanged to $10,000 exchanged to 10,000 into 0.55, that equals to 5,500. So 5,500 pounds. 5,500 pounds. This is the cross currency transaction. Now what we need to do is that multiply this into RBI reference rate. Multiply this into RBI reference rate. Say RBI reference rate is rupees 83.5 per dollar into 1%, and pound is rupees 143 per dollar per pound into 1%. So you see how much you get. 10,000 into 83.5 into 1%, that is 8,350. 8,350. Here 5,500 into 143 into 1%, that is 7,865. So whichever is lower. Which is lower? 7,865. So therefore value equals to 7,865 will be taken as the value. Understood? So this is in case of cross currency. Any type of question can be given in the exam related to this. So therefore this is which case? Rule 32 sub rule 2, foreign exchange transactions. That too this is option 1. There is another option also. Either you can follow this or another option is there. Option 2, that is slab rate model. What is that slab rate model? You need to see the gross amount in Indian rupees. Up to 1 lakh, the rate will be 1% of gross amount or 250, whichever is higher. If it is beyond 1 lakh, it will be minimum 1,000. Why 1,000? You are in the first slab. You are crossing the first slab. Means what? 1 lakh. 1 lakh into 1%, 1,000, or 250, whichever is higher, 1,000. So with the moment you go into second slab, 1,000 rupees plus 0.5% of the amount exceeding 1 lakh. And say if it is 8 lakhs, how much you will take? 8 lakhs means first 1 lakh, 1,000. Remaining 7 lakhs. 7 lakhs into 0.5%, 3,500. 3,500 plus 1,000 will be 4,500. Understood? Then exactly 10 lakhs. For 10 lakhs, 1 lakh it is 1,000. Remaining 9 lakhs. 9 lakhs into 0.5%, 4,500. 4,500 plus 1,000, 5,500. The moment you are going into third slab, it is 5,500 plus 0.1% of the gross amount exceeding 10 lakhs. For example, 15 lakhs you take. 15 lakhs. For first 10 lakhs, it will be 5,500. What is the remaining amount? 5 lakhs. On that 5 lakhs, what is the rate? 0.1%. So 0.1% of 5 lakhs. 5 lakhs into 0.1% will be 500. So therefore 6,000, but maximum is how much? 60,000. For example, 500 lakhs you take. For first 10 lakhs, 5,500. So remaining 490 lakhs. 490 lakhs into 0.1%, 49,000 plus 5,500. Still it is less only. Okay. So therefore maximum is 60,000. Now which option I need to choose? Either option 1 or option 2. We need to decide in the beginning of the financial year, and that will be applicable throughout the financial year. But between this rule 32 and transaction value with respect to each invoice, we can decide. That is that. Then rule 32 2B. So rule 32 sub rule 3, air travel agent. Next rule. So first one is for foreign exchange transaction. You understood option 1 and option 2. Then air travel agent. Air travel agent will take, in case of domestic bookings, whatever is the base fare, on that 5% will be taken in case of domestic bookings. International bookings double. So they will book one ticket now. In the ticket there will be base fare, fuel surcharge, other charges and taxes. In that base fare, 5% will be taken in case of domestic bookings, 10% will be taken in case of international bookings. Then in case of life insurance business, the policies are divided into 4 risk cover policies. Risk cover policies means wherein premium, entire premium will be the income to the insurance company. So therefore value equals to 100% premium. Whereas in reinvestment policies, what will happen? Whatever premium they are collecting, out of that a percentage will be invested. So remaining amount whatever they retain, that is only the value. So value equals to premium collected minus amount allocated for investment. In case of single premium annuity, there will be only one premium and they will not receive yearly any premium. So on that single premium into 10% will be taken as the value. Whereas in any other case, we need to see, is it first year premium or subsequent year premium? First year premium means what? So policies taken current year. Subsequent year premium means what? Policies already taken previous year for which they pay premium current year. On first year premium, the value will be 25%. On subsequent year premium, the value will be 12.5%, half of that. Okay. So these rates and all you need to remember and go for exam. Very, very important, because if you miss this, MCQs or even in questions, so you will be missing out. So these rates are crucial. And then second hand dealer in goods. In case of second hand dealer in goods, the value will be taken as sale price minus purchase price. So sale price means, for example, I am buying a second hand car and selling a second hand car. Okay. So now I am a second hand dealer in car. I purchase a car for 2.5 lakhs. I sell the car for 3.5 lakhs. Now should I pay GST on 3.5 lakhs? No. 3.5 lakh minus 2.5 lakh, 1 lakh only I need to pay GST. That is called as margin scheme. So value equals to sale price minus purchase price, but one condition is that they should not take ITC. Then suppose if they are repossessing a car which they have financed and which they are selling, then usually what dealers will do, some dealers, they will give finance to the car. So, and if you are not paying the installments, what they will do, they will repossess. And if they sell the car, then what will be taken as the purchase price? Sale price is actuals known, but purchase price, they are not buying it from you, they are repossessing it from you. So you do a depreciation. How to do the depreciation? See the price of the car minus 5% for every quarter or part thereof, you will do depreciation from the date of purchase till the date of sale. Okay. So purchase price in case of repossession equals to original price minus 5% for every quarter or part thereof from the date of purchase till the date of disposal. Then in case of vouchers or coupons, we take the value as redeemable value, means the price at which that voucher is redeemed. For example, you go to Domino's Pizza and you get one voucher. That voucher, if you redeem, you will get one medium pizza. Now what is the value of that medium pizza? That will be taken as the value of the voucher. Okay, that is with respect to this rule 32. So forex transactions, we have option 1, option 2. Option 1, so gross amount involves Indian rupees, then purchased or sold minus RBI reference rate into units of currency. Suppose RBI reference rate not available, into 1%. Cross currency, both currencies convert into Indian rupees into 1%, whichever is lower. And next, in case of option 2, slab rate model, first slab 1%, minimum 250. Second slab 0.5% on the amount exceeding 1 lakh. Third slab 0.1% on the amount exceeding 10 lakhs, maximum 60,000. Then air travel agent, base fare into 5%, domestic bookings, base fare into 10%, international bookings. Life insurance, risk premium, entire premium. Reinvestment, money collected minus amount allocated for investment. Single premium annuity, that premium collected into 10%. Other policies, first year premium into 25%, subsequent year premium into 12.5%. Second hand dealer, sale price minus purchase price. And last, vouchers, redeemable value. So that is with respect to rule 32. Then rule 33 says that whenever expenditure is incurred by supplier as a pure agent of the recipient. So actually it is whose liability? Recipient's liability. Incurred by the supplier as a pure agent, then that will be excluded in the value and no need to pay GST on that. Remember this example. That is, you are a cost accountant. You need to do the cost audit. Okay. And when you need to do the cost audit, so actually some charges, expenses are to be incurred as per the contract. So this travel expenditure or any other audit related expenses, you are telling that the client only should incur. Okay, client only should incur as per the contract. But you incurred it because you could not wait for the client, so you incurred it. And you are recovering it from the client. Now will it be included in the value? No, because as per contract it is whose liability? Recipient's liability. But who incurred? Supplier. As a pure agent, that will be excluded from the value. Understood or not? Then another example. You are doing customs clearances. Imported goods you are clearing. And actually customs duty who should pay? Importer should pay. But you are paying the customs duty and recovering it from him. Means Any amount that the recipient is liable to pay, but supplier is incurring and recovering it from the recipient is not included because that is a pure agent. But to become that pure agent, 4 conditions should be satisfied. Expenditure incurred by supplier as a pure agent of recipient should be excluded from value. What are the conditions? Recipient, for example, that customs duty example you take, the importer should authorize you to incur the customs duty. So, through a contract, recipient should authorize the supplier to incur that expenditure. Only the actual expenditure incurred should be recovered. Means if you are paying customs duty of 5 lakhs, you should recover only 5 lakhs. Supplier should not use it for the personal purpose. Means it should not be your customs duty which you are paying and recovering. It is recipients. And title means document. For payment of customs duty, we will get challan na. That should be in whose name? It should be in the name of the recipient. Should not be in the name of the supplier. So what are the 4 conditions? First one, contract agreement wherein recipient authorizing supplier to incur the expenditure. Supplier recovers the actual amount and it is not used for the personal purpose of the supplier and the title is not in the name of the supplier. If these 4 conditions are satisfied, supplier is a pure agent and that amount expenditure will not be included in the value. Actually, this rule 33 is exception to that 15(2)(c), because 15(2)(c) says any expenses incurred by the supplier and charged to recipient before delivery of goods should be included in the value na. So therefore rule 33 is an exception to that. Then next rule 34. So this expenditure incurred by supplier and recovered from the recipient, I am just connecting it here. So first, if it is as a pure agent, it will not be included in the value, it is excluded from the value. If it is not as a pure agent, then it is in the course of supply. If it is incidental expenses means what? Always it is required to make the supply. For example here, so AC and installation is a incidental expenses. Without installation, they cannot complete the product. So incidental expenses always to be included in the value, whereas other expenses will be included in the value only when it is charged before or at the time of supply. If it is charged after supply, it will not be included. So this is the connection and this chart is important. So you will be applying this in exam. So first you check pure agent, yes, don't include. Not a pure agent, okay, then incidental means without incurring that expense, supply cannot be made, yes, add it. No, other expenses like freight, etc. and all. Then, okay, is it before delivery of goods or after delivery of goods? Before delivery of goods, add. After delivery of goods, ignore. Okay. Next, rule 34. What will be considered as the relevant exchange rate for converting foreign currency into Indian rupees? Okay. So that is whenever the transactions are denominated in foreign currencies, invoice is in foreign currency, we need to convert it into Indian rupees for payment of GST, because GST cannot be payable in foreign currency. For that purpose, if it is goods, we need to follow the rate notified by CBIC, and if it is services, we need to follow the rate as per GAAP, that is generally accepted accounting principles. Usually as per generally accepted accounting principles, we take the average of the buying rate and selling rate for payment of GST. So today, what is the buying rate? What is the selling rate? Take the average, convert into Indian rupees, on that you pay GST. But actual realizable value may be more. Today I am taking 83 as the rate and I am paying GST. But actually when I got money, it could be 85 rupees. Then in that case, should I pay again GST on the difference? No. Ignore foreign exchange gain or foreign exchange loss. Okay. So for goods, which rate you need to take? CBIC notified rate. For services, we need to take what? GAAP rate, that is average of the buying and selling rate. Then rule 35, whenever price is inclusive of GST, how to calculate GST? Price inclusive of GST into rate of GST by 100 plus rate of GST. That's it. We completed value of supply. These are all the points that we have. Section 15, rule 27, 28, 29, 30, 31, 32 and 33 pure agent, 34 exchange rate, 35 price inclusive of GST. Okay. Then we will see one MCQ test on this. Okay. So enter this ID, join vivox.app 180 372 167 180 372 167. One 372 167. Yes. A chartered accountant issued following bill: professional fees 1 lakh, out of pocket expenses 10,000, MCA for e-filing of documents on MCA portal 5,000. His value of service for tax purposes. Okay. So we need to take 1 lakh, out of pocket expenses 10,000. Will it come? Yes. Yes. 15 to C, expenditure incurred by the supplier and charge it to recipient. It will come. But which will not come? MCA for e-filing of documents, because actually that MCA fees you should pay, recipient should pay. But who is paying? Supplier is paying. That will come under the pure agent. Understood? So therefore what will be taken as a value? Only 1 lakh 10,000. So that MCA fees, actually when you are incorporating a company, so we have to pay fees to the government. That fees who should pay? Client should pay. But you are paying and recovering it from the client, which means that's a pure agent expenditure that should not be included in the value for payment of GST. So only the remaining amount. So that is 1 lakh. And why 10,000 should be included? This is normal expenses incurred by the supplier and recovered from the recipient. So you need to include it. So 1 lakh 10,000 is the answer. Next, XY Bengaluru Karnataka furnishes the following information: 10 metric tons of inputs, stock transferred to branch located in Chennai, Tamil Nadu on 10th April. Transfer value of the input shown in the invoice is 10,000. 5 metric ton of input supplied to customer located in Chennai at 12,500 on 10th April. Cost of production of 1 metric ton of input is 750. Chennai branch is eligible for full ITC. What is the value of input stock transfer to Chennai branch? This question is based on rules. Okay. Okay, I'll stop. Open market value. See, this is rule 28. transaction between related parties or distinct persons. This is distinct persons. So we need to apply rule 28. As per rule 28, we need to take open market value. We have one point. If recipient is eligible for full ITC, the transaction value itself will be taken as an open market value. What is the transaction value? 10,000. They are charging 10,000 in the invoice and recipient is eligible for full ITC? Yes. So which means that the 10,000 itself will be taken as the open market value. That itself is the value. So 10,000 is the correct answer. Okay. Then next. What shall be GST payable in case of lottery run by the state government? Okay. So usually we need to take face value of the ticket or price notified, whichever is higher, into 100 by 128. That is C is the correct answer. Good, majority answer correctly. Next, supply between related person and recipient is not eligible to claim ITC. Transaction value of such goods is 2 lakhs, open market value is 2,50,000, cost of such goods is 1,80,000. What will be taken as value? Okay. See, rule 28. Is recipient eligible for full ITC? No. So we will not take transaction value as the open market value. Then what is the open market value? 2,50,000. So that will be taken. Why are you taking cost plus 10%? 1,80,000 plus 10%. Why are you taking? That is wrong. Option D is wrong. Only when open market value is not available, then you need to take like and quality, or that is also not available, cost plus 10%. Otherwise you should not take. So option B is the answer. Then Western Union Forex Private Limited, being a registered person under GST, purchased $2,000 from Arpit Enterprise at the rate of 70 rupees per dollar. RB reference rate on the date was 70.5 per dollar. What shall be the value of supply in this transaction? Okay. So we need to convert. RB reference rate is available, yes. And what is the relevant rate? 70. 70 minus 70.5, 0.5. 0.5 into 2000, simple, 1000. So it's a simple one only. Tata Airlines sold tickets to an agent, Mr. Ram, for transport of passengers to Vancouver, and amount charged 30 lakhs for 100 tickets, out of which 10 lakhs attributable to GST paid on transportation service. Compute the value of taxable service of Mr. Ram and GST payable. Okay. Finished? I'll stop here. Air travel agent, 5% of base fare in case of domestic bookings and 10% of base fare in case of international bookings. Is it domestic ticket or international ticket? International ticket. What is the base fare? Base fare is what? 30 minus 10. By 30 minus 10, total 30, 10 lakhs is GST. So what is the remaining? Is the base fare. What is the base fare? 20. 20 lakhs into 10% is what? 2 lakhs. On the 2 lakhs, 18% is what? 36,000. So option B is the correct answer. Bharati AXA life insurance company has collected 12,000 lakhs towards general policies, and out of which 5,000 lakhs pertains to first year premium and balance towards subsequent year premium. Calculate the value of taxable service. Direct. Should remember the rate and apply it. Okay. So the answer for this is 5,000 into 25%. 5,000 into 25% is what? 1,250. Plus remaining is what? 7,000. 7,000 into 12.5%. So 875. 875 plus 1,250, that is 2,125. Option D is the correct answer. Then next one. Messrs. Aircool Limited, a supplier of air conditioners, is registered in the state of Maharashtra. It has a policy of gift an air conditioner to their employees at the end of financial year in terms of the employment contract. The company installs such air conditioners at the residence of the employees. During the month of March, the company installed 150 air conditioners at the residence of these employees. The total open market value of such air conditioner is 52.5 lakhs. The tax rate on such air conditioner is 28%. Compute the GST liability of Aircool Limited, if any. It has got a connection to supply chapter. Okay. So in this case, actually the answer is nil. Because first, gift by an employer to employee. You are thinking that no, actually it is not a gift. See the first line. It has a policy to gift an air conditioner to its employees at the end of the financial year in terms of the employment contract. Means it is what? Perquisite. Perquisite means it is not a supply. Even when you are applying gift also, it will be nil only. Answer correct. But the way in which you applied is wrong. But actually you should not apply that gift point itself because it is coming under perquisite. Okay. Then next one here. Mr. James Bond is a registered person under GST in the state of Maharashtra who sells footwear to his customers locally within the same state. He has been appointed as an agent by Toto Shoes Limited, a company registered under GST in the state of Karnataka. During a financial year, Toto Shoes Limited sends taxable goods worth 5 crore from its Bengaluru store to James Bond, who sells such shoes for 5 crores by raising invoice using GSTN of Toto Shoes Limited. Mr. James Bond receives a commission of 60 lakhs from Toto Shoes Private Limited during the said financial year. Compute the value of supply of Toto Shoes Private Limited and James Bond, both. First see who is principal, who is agent. You will easily get what is the value in their hands. Okay. Now here if you see, who is the principal? Toto Shoes. Toto Shoes is making supply to an agent, James Bond. Is James Bond an agent acting on behalf of principal or not? Who is raising invoice in whose name? James Bond raises invoice using the GSTN of Toto Shoes. Means agent is not acting on behalf of principal. Means between principal to agent it is not a supply. Correct? Means directly the principal is raising invoice to the buyer for how much value? 5 crores. So that 5 crores will be included in the value of Toto Shoes. Then James Bond is getting commission how much? 60 lakhs. That is only his value. So therefore Toto Shoes 5 crores and James Bond 60 lakhs. Now my question to you, general knowledge question, okay? What if James Bond is raising invoice in his name? Then what will become the answer? 5.6 crores will be the value of James Bond. What is the value in the hands of Toto Shoes? No, it will be 5 crores into 90%. Why? Rule 29, you are missing. Rule 29, principal agent transaction, open market value or 90% of resale price at the option of the buyer. Let's take 5 crores as open market value, but whichever is lower only we will take value. So what is 90% of 5 crores? What is the resale price? 5 crores. 5 crores into 90% is what? 4.5 crores. So 4.5 crores in the hands of Toto Shoes and 5.6 crores in the hands of James Bond. Understood? Then last question pa. Which of the following statement is correct? Discount is always allowed as deduction whether given before supply or after supply. Discount allowed after supply is never allowed as deduction. Discount allowed after supply is allowed as deduction if terms are agreed between the parties. Direct question only. Okay. So first one is incorrect. Why? Discount is always allowed as deduction. No. Discount allowed after supply is never allowed as deduction. False. Second one is also false. Discount allowed after supply is allowed as deduction if terms are agreed between the parties anytime. No, it should be agreed before. Then last one is only correct. Discount allowed after supply is not allowed as deduction if recipient has not reversed ITC. That is only correct. Okay. So good. Two students, Girish and Loganathan. Who's Loganathan? Super. And we will do now. So we'll take break at 1:15. Okay. And we will do one small topic. We will complete that and then I'll start afternoon input tax credit. That is TDS and TCS you take. I think it is module 7. It's a small topic, but in your material and all, lot of nonsense is given. I don't know here, but somewhere your study material, they should have made it good. So lot of clutter, lot of illustrations and MCQs only they gave at the chapter end. They did not give question and answers properly. In the form of examples they gave. These examples, how it will be tested in exam. If it is always full MCQ, no problem. We can study that way. But it is not 100% MCQ. Maybe I feel they would have prepared the material with the assumption that the student will be doing online exam. I think that way. But now when it is pen paper exam, they have to change the material, but don't know, because your material is actually suitable for online exam only, in the sense like all small questions to the point, like how it will be asked in online exam, that way only. But so maybe first attempt paper when we see, we will get to know. Okay, but otherwise question paper model, if they are asking like pen paper exam, already they gave one model paper. It will be like that only. Okay, fine. So look into this TDS and TCS under GST. Tax deducted at source is given under section 51. Tax collected at source is given under section 52 of CGST Act. So when this TDS will be applicable, there is a supplier who is making supply of goods or services to a notified recipient. Who is that notified recipient? We will see. Whenever goods are supplied or services are supplied to a notified recipient, that value of the goods is say 10,000 rupees plus 1,200. Now the notified recipient will deduct a TDS. TDS rate is 2% on value excluding GST. What is value excluding GST? 10,000. So 10,000 into 2%, 200 rupees they will deduct and they will remit to government. And so how much they will be giving it to the supplier? From 10,000 they deducted 200 and remitted to government. So 10,000 will not be given, only 9,800 plus full GST of 1,200 will be given to the supplier. Now supplier has to pay GST how much? 1,200. While paying that 1,200, whatever TDS which is deducted by the recipient will be allowed as deduction, because TDS can be taken as credit. Like input tax credit, TDS can be taken as credit in cash ledger and we can adjust it against the liability. So 1,200 minus the 200. So therefore 1,000 rupees will be payable as the GST. You understood this 4 steps? Now, who is the notified recipient? The notified recipient will be government and its family members. Central government, state government, union territory, local authority, public sector undertaking, government body where government has invested greater than or equals to 51%, then government agency. These are the 4 parties who are treated as notified recipient. Whenever you are making supply of goods or services to these notified recipients, TDS will be applicable. Got it? And what is the rate of TDS? 2%. Now, what is TCS? What is TCS? Say this, tax collected at source. TCS under GST is applicable only in case supplies are made through e-commerce operator. So there is a supplier who is making supply of goods or services worth rupees 10,000 plus 1,200 through an e-commerce operator to the recipient. Now, recipient will remit 11,200 to the e-commerce operator. Step 2 you understood? Step 1 goods. Step 2 recipient will remit 11,200 to e-commerce operator. Now, e-commerce operator has to pay GST on the commission. So, e-commerce operator will get a commission. Say his commission is 1,000 rupees. So, he need to pay GST on that commission 1,000 into 18 by 118, 153. Plus, he should also pay TCS. Who? E-commerce operator. How much is the rate of TCS? 1%. And it will be computed on value. What is the value? 10,000. 10,000 into 1%, 100. So, e-commerce operator has to pay two things. GST on his commission plus TCS, which is 1% of the value. Now, he will remit how much money? So, total e-commerce operator has 11,200. In that 1,000 rupees is his commission, correct? Minus 100 rupees he will deduct towards TCS. So, what is the remaining? 10,100 he will remit to the supplier. Understood? 11,200 minus commission 1,000 minus TCS 100. So, will be remitted. Now, supplier has to pay GST. What supplier will do? Supplier will take a TCS credit of 100 and adjust it against the GST payable. Also, this e-commerce operator will raise invoice for the commission to supplier na. On that GST is how much? 153. That can be taken as input tax credit. So, what is the net liability of the supplier? 1,200 minus TCS credit how much? 100 minus input tax credit 153. So, 947 rupees will be payable. You got it? You may get question like this related to computation of GST liability in case of TDS and TCS. Now, got the logic between TDS and TCS? Both are like same TDS concept only, that one person will deduct and remit it on our behalf. We will be able to take it as credit and adjust it against our liability. And when TDS supplies to notified recipient, when TCS supplies through e-commerce operator. There are some common points related to this. So, this TDS and TCS which is deducted by that person, that is notified recipients or e-commerce operator, they have to remit it to government by 10th of the month following every month. And if there is any delay, so if they are not remitting it by 10th of the month following every month, then for the period of delay, they need to pay the interest on the TDS TCS. And what rate of interest? 18% per annum. From when to when? From the first date after due date. What is first date after due date? 11th of the month following every month till the actual date of payment. And whatever TDS TCS that is deducted by the recipient, notified recipient or e-commerce operator will be reflected in the electronic cash ledger of the supplier. There are 3 ledgers that will be maintained by GST network on behalf of every registered person. Electronic liability ledger that contains liability. Electronic credit ledger that contains the input tax credit. Electronic cash ledger that contains money deposited into the cash ledger, TDS and TCS. Now, for payment of liability, they can use credit ledger and cash ledger, but this TDS, TCS deducted will be reflected in which ledger? Electronic cash ledger. Generally, electronic credit ledger can be used only for payment of tax dues, but electronic cash ledger can be used for payment of tax dues as well as other dues. Okay. So, therefore, this cash ledger, it will come. Which one? TDS, TCS. So, it can be used for payment of tax, interest, penalty, fee, etc. For anything, we can use this. Then, distinguishing points between TDS and TCS. What is the rate that is applicable? TDS rate is what? 2% if it is IGST, and TCS is 1% if it is IGST. If it is intrastate sale, 1%, CGST, SGST, and there 0.5%, 0.5%. Non-applicability, that is important. When TDS is not applicable, supplier is unregistered, because the TDS deducted by the recipient will be taken as credit by the supplier. If the supplier is unregistered, how he can take credit? So, therefore, TDS is not applicable. Then second, if the supplies are exempted, because first of all GST itself is not there, then what's the point in collecting TDS? So, therefore, if the supplies are exempted, TDS is not applicable. If the supplies are between notified recipients, means between them, between government, public sector undertaking, then between them only, so TDS is not applicable. Then value of supply under the contract does not exceed 2.5 lakhs. Means under the contract, I agree to supply some goods or services to government. Na? So what is the value of supply under the contract? 2,50,000, no TDS. Beyond 2,50,000, so on that TDS will be applicable. And next case, recipient is liable to pay GST under RCM. Means what? The liability to pay GST is on recipient, then TDS is not applicable because they are only paying. See, the main logic of TDS TCS is to catch the supplier. When the recipient pays TDS TCS and government will know that a supplier has received this much as value. So if supplier tomorrow not paying GST, they will ask, see boss, your recipient has deducted 2% and 1%. So you are not paying, this is the value, you are declaring lower value. So mainly for that purpose only they brought in this. When supplier itself is not having liability, liability is on recipient, what's the point in having TDS? Not required. Then last one, location of recipient and place of supply not in the same state and it is an intrastate supply. What is this? See this example. So there is a supplier who is located in Tamil Nadu. There is a supplier who is located in Tamil Nadu and recipient who is located in Karnataka, and recipient has a immovable property and that immovable property is located in Tamil Nadu. Now supplier is providing some architect services, okay, architect services. Now for this, what will be taken as the location of supplier? Location of supplier Tamil Nadu. Location of recipient, place of supply Tamil Nadu, because in case of service in relation to immovable property, the location of immovable property is place of supply, so Tamil Nadu. It is what supply? Intrastate supply. When it is intrastate supply, what is the GST that is applicable? CGST and Tamil Nadu SGST. Now where the recipient is located? Karnataka. How he can deduct 1% towards Tamil Nadu SGST? He is not registered in Tamil Nadu. If he is registered in Tamil Nadu, he can deduct and remit. But where is the recipient located? In Karnataka. That's why TDS not applicable. So if it is a intrastate supply, place of supply and location of recipient is in two different states. Correct? Place of supply and location of recipient is in two different states and it is an intrastate supply. TDS is not applicable. So can you tell me when TDS is not applicable? Come on. Any four. Supplier is unregistered, okay. Exempted supply, super. Recipient liable to pay GST under RCM, then between notified, super. Then value of contract does not exceed 2,50,000. One more point. It is an intrastate supply. Place of supply and recipient are in two different states. Okay. These are the 6 cases TDS not applicable. This can be asked as a theory question also. Then TCS. So when TCS is not applicable, supplier is unregistered, same. And the supplies are exempted, same. Then third one, notified services, 9 subsection 5, HATE. Housekeeping services, accommodation service, transportation of passenger, eating food from restaurant. In all those cases, who will pay GST? E-commerce operator. So no need to catch the supplier. That's why TCS not applicable. And then payment is not collected by e-commerce operator. Payment is directly collected by the supplier. Then how e-commerce operator will deduct TCS? So therefore, in these 4 cases, TCS not applicable. Then what is the return that should be filed by a TDS deductor? GSTR 7, and that should be filed by 10th of the month. Actually tax should be, TDS TCS should be paid by 10th and they need to file return also by 10th, but return form alone will change. For TDS it is GSTR 7, for TCS it is GSTR 8. And annual return, TDS deductor is not required to file any annual return, but TCS deductor is required to file annual return. E-commerce operator GSTR 9B. By 31st December. Usual annual return time limit is 31st December of the succeeding financial year. Then late fee for delay in filing returns. So for TDS, it is a lower late fee. TDS return not filed, late fee will be 25 rupees per day subject to maximum 1000 under each act. Suppose if there is a delay by 10 days, 10 into 25, 250. 250 under CGST and 250 under SGST. Suppose if the delay is 60 days, 60 into 25. 60 into 25 is what? 1500, but maximum is what? 1000 only. So 1000 under CGST, 1000 under SGST. Whereas TCS, it will be like 25 will not be there, 100 rupees per day, subject to maximum 5000. Okay. So therefore, if the delay is 60 days, so 60 into 100, 6000, but maximum is 5000. 5000 under CGST, 5000 under SGST. Time limit for rectification of return. TDS return cannot be rectified, but TCS return can be rectified, and the time limit is 30th November of the succeeding financial year or date of filing annual return, whichever is earlier. Okay. So there are some similar time limits. In 5 cases, this similar time limit, same time limit will be applicable. You just write down in your book. In the following cases, time limit is 30th November of next financial year or date of filing annual return, whichever is earlier. So in the following cases, time limit is 30th November of next financial year or date of filing annual return, whichever is earlier. What are those situations? Number 1, time limit for availment of ITC. So time limit for taking ITC in GSTR 3B. Time limit for availment of ITC. Time limit for availment of ITC. Number 2, time limit for issuance of credit note. Time limit for issuance of credit note. And number 3, so there is a time limit by which credit note to be given, same time limit. Time limit for availing ITC, same time limit. Then time limit for rectification of GSTR 1. Time limit for rectification of GSTR 1. Fourth one, same, GSTR 3B. Time limit for rectification of GSTR 3B. GSTR 1 is a return that contains the details of outward supplies. Now 3B also can be rectified. And fifth one, time limit for rectification of GSTR 8. What is GSTR 8? TCS return. So for these 5 cases, so the time limit is 30th November of the next financial year or date of filing annual return, whichever is earlier. Okay. This can be tested because it's an amendment. This is an amendment. This can be definitely tested in the exam as MCQ, etc. Okay. So we'll take a break. We completed TTS, TCS also. We'll take a break, and post lunch we will start with input tax credit. Okay. And definitely time should permit, and we will be also discussing offences, penalties, prosecution under GST. Okay. Thank you. And I will try to complete as much as I can by Monday. If I am not able to complete, I may extend for one more day. Is that okay? But if you don't want to come also, I don't mind, because anyhow I will do it in YouTube, and you can watch it in online also if you are having any work, etc. So anyhow it is free only, don't bother about that. And even if one student is there, I have to take, at least for the sake of, so online students or someone, because it's too early for CMA final students now according to me, because exam starts from July 15 means the heat will start for them only on July 1st. Okay, so No, therefore, now many students may not be, but anyhow, I promise that I will record and keep it in YouTube. So for that, I will do that. But I just wanted to complete the portion fully. So I don't want to keep any ifs and buts and all. That's why. Okay, fine. We'll meet at 2 o'clock, 45 minutes. Yes. Okay, welcome back. Let's start with the next module, that is input tax credit. Input tax credit is very important area, because usually even every exam, whatever may be the exam, like inter level or final level, so they are asking. And even what I have observed from many attempts papers also on input tax credit, the focus is on more. Okay, so a lot of practical questions are tested from input tax credit rather than theory questions, purely practical questions only. And these are all the sections that we have related to input tax credit. Section 16, which talks about conditions for availment of ITC. All these are of CGST Act. Section 16 talks about conditions for availment of ITC. Section 17, apportionment of credit and blocked credits. Then section 18, input tax credit in special cases. So there are some special cases like we have seen in composition scheme, availment of ITC on closing stock, then reversal of ITC on closing stock, that is section 18. Then section 19 deals with, so job work, goods sent on job work and receipt from job work, what are the input tax credit implications. Then last two, section 20 and 21, which deals with the provisions of input service distributor. Now section 16 says that conditions for availment of ITC. So we have 4 subsections. 16 subsection 1 says only a registered person can take ITC, unregistered person cannot take ITC, and the inverse applies on which they want to take ITC should be used or intended to be used in the course or furtherance of business. Used means what? Used for existing. Intended to be used means what? To be used in future. In the course of business means for the existing business. In furtherance of business means for some business which we are going to start in future. So we can take ITC. So what are the 2 basic conditions? Only a registered person can avail ITC, and the inward supply should be used or intended to be used in the course or furtherance of business. Then section 16 subsection 2 gives 6 additional conditions apart from the 2 basic conditions for availment of ITC. Number 1, the person who want to avail ITC should be in possession of the tax paid document. So if he is not having the tax paid document, he cannot take the ITC. If he has already taken also, but that invoice is missing, he need to reverse that ITC, he cannot enjoy that. Then should have actually received the goods or services, that is the one who want to take ITC should have actually received the goods or service. For example, invoice is dated March and goods are received in the month of April. So when he can take ITC? Only for the month of April. So that is common for both goods and services. Then should file GSTR 3B return, because without filing 3B we cannot avail ITC, because availment of ITC, utilization of ITC and reversal of ITC will happen in 3B. What is availment of ITC? Taking the credit. Okay. Then reversal of ITC, reduction of input tax credit, and utilization of ITC means set off of ITC with the liability is known as utilization of ITC. This availment of ITC, reversal of ITC and utilization of ITC we will do in which place? In GSTR 3B. Okay. So therefore only by filing 3B we can take ITC. So then, so these 3 conditions should be fulfilled by whom? By the recipient. By the recipient. Then 4th condition, supplier should furnish invoices in GSTR 1. So supplier should file GSTR 1. Based on the supplier's GSTR 1, it will be auto populated in the GSTR 2B of the recipient, and from there, so recipient can take ITC in his 3B. Okay. So what happens is that, so first you can write down availment of ITC. This is one section which is a latest one, section 41. Availment of ITC, section 41. Actually it comes in returns under GST. So but it is connected to availment of ITC in input tax credit also. Section 41, availment of ITC as per section 41. Now there is a supplier. That supplier will be filing, supplier will make the outward supplies, and he need to declare the details of that outward supplies in one return. What is that return? GSTR 1. So step number 1, supplier will add invoice in GSTR1. GSTR1 is a return to be filed by a person mentioning the details of outward supplies. Add invoice in GSTR1 and it is filed. The moment it is filed, to the recipient, it will be shown in GSTR 2B. So, as and when supplier files GSTR 1, from there the data will be auto-populated in the recipient's GSTR 2B. So, and this work will be done by GST network. So, step number 2, ITC auto-populated in GSTR 2B. And who will do this? GST network. GST network will take care of this. Based on the ITC auto-populated in GSTR 2B, so the recipient will avail ITC in GSTR 3B. Avail ITC in GSTR 3B. So step 2 to step 3. Availment of ITC in GSTR 3B. But how much will be availed as ITC in GSTR 3B? So self-assessed ITC will be availed. What is called as self-assessed ITC? So self-assessed ITC means that ITC which is reflected in GSTR 2B plus GST under RCM. So whatever GST we paid under RCM, we can avail it as ITC. Okay, and even so, if there are any inward supplies on which ITC not availed in the earlier tax periods, so that can be availed now. And we might have reversed the ITC in the past, so that reversed ITC can be re-availed. So some reason we might revise the ITC, so for re-availment also we can do. So that is that self-assessed ITC. Little later we will see what is that self-assessed ITC, but ITC is availed in GSTR 3B. Now what happens? Supplier has to file GSTR 3B. So even without 3B, because 3B only we need to pay tax. So in GSTR 1, tax is not required to be paid. GSTR 1 contains only details of outward supplies. So supplier has to file 3B and pay the tax. But what has happened is that supplier has not filed GSTR 3B. Supplier has not filed GSTR 3B. GSTR 3B not filed by September 30th of next financial year. So what is the time limit that they are giving for the supplier to file GSTR 3B? 30th September of next financial year. So which means for this financial year, if we need to file that, so for this month, for example, July 2023. So he can file it on August, September, October, November, December, Jan, February, March, April to September. Long time is given. So that by that time they are waiting. So 3B has to be filed. So 3B not filed by September 30th of the next financial year. Now what recipient should do is that he availed ITC na. That availed ITC needs to be reversed. So step number 5. Reversal of ITC availed. Reversal of ITC availed. Why? Because GSTR 3B is not filed by the supplier by September 30th of next financial year. So reversal of ITC availed along with interest at 18% per annum. Along with interest at 18% per annum. Understood here? So supplier has filed GSTR 1. Based on that, it is auto-populated in GSTR 2B of the recipient, and GSTR 3B recipient is taking the ITC. Whenever recipient takes the ITC, so it is subject to the condition that supplier should file the GSTR 3B. And what is the time limit by which supplier should file the GSTR 3B? By September 30th of the next financial year. And by that time, if 3B is not filed by the supplier, then the recipient has to reverse the ITC. Where the ITC will be reversed? 3B only. Reversal of ITC along with the interest at 18% per annum in GSTR 3B. So availment of ITC and reversal of ITC will happen in GSTR 3B. Now what happens is that this supplier is filing GSTR 3B. After some time, supplier has filed the GSTR 3B. Then what is the treatment of that? So GSTR 3B filed after September 30th of next financial year. Then GSTR 3B filed after September 30th of the next financial year. What recipient can do? Recipient can re-avail the ITC. So this is step number 6. Step number 6. Now based on this, so recipient can re-avail the ITC. Step number 7, re-availment of ITC in GSTR 3B. Re-availment of ITC reversed earlier. Re-availment of ITC reversed earlier in GSTR 3B. But can interest be availed? No, interest is loss. First they availed credit. They reverse along with interest. Now they can re-avail only ITC, but that interest will be literally loss for them. They cannot take it. And is there any time limit applicable for this re-availment? No time limit. Generally there is a time limit for availment of ITC na. So before session we have seen 30th November of succeeding financial year or date of filing and whichever is earlier, but that is not applicable in case of re-availment. Okay, so these are the 7 steps that you need to remember for the purpose of availment of ITC, and this is given in section 41. This is an amendment. This is an amendment Wide Finance Act 2022 that is applicable for your exam. Okay. Now here what has happened? What is the meaning of self-assessed ITC? What is the meaning of self-assessed ITC? Because self-assessed ITC can be availed, that is given. So what is the meaning of self-assessed ITC? So availed in 3B. Self-assessed ITC availed in GSTR 3B. First we need to take matched ITC as per 2B. So ITC as per 2B, GSTR 2B, that is the base. But in this ITC as per 2B, we will have some inward supplies on which the recipient has to pay GST under RCM. That may not be reflected in the GSTR 2B because supplier will not file GSTR 1. Then that should be taken at GST paid under RCM. GST paid under RCM. So that should be added. Then we need to add ITC with respect to inward supplies pertaining to earlier periods. So ITC not availed in earlier tax periods. Earlier tax periods. So that also we will take now. And then re-availment of ITC reversed earlier, because we would have reversed earlier, correct? 7th point, we would have reversed earlier that we can re-avail as and when the supplier files GSTR 3B. So re-availment of ITC reversed earlier. Re-availment of ITC reversed earlier, because that will not come in 2B. These are all extra. And then you need to deduct 3 things minus blocked ITC. There are some inward supplies on which you cannot take ITC called as blocked credits. But department don't know, portal don't know whether it is a blocked credit or not for you. So therefore they will give it in GSTR 2B. But you should not be able to take that ITC. You should not take that ITC. So that deduction you need to do. It may come in 2B, but you should not take that. Minus. So inward supplies ITC with respect to non-business purpose. ITC with respect to non-business purpose. That is, you are making some purchases and you are using it for personal purpose. but it may also come in 2B because the portal don't know whether you are using it for business purpose or personal purpose, but if you are using it for personal purpose, you should take it out. Minus ITC with respect to exempted outward supplies. Exempted outward supplies. That is, you are making some inward supplies and you are using that for making exempted outward supplies. But department portal don't know that, so it will come in 2B, but you are going to use it for exempted outward supply, means you should eliminate that input tax credit. Now this is called as the ITC availed in GSTR 3B. Okay. So ITC availed in GSTR 3B. You understood here how to calculate the self-assessed ITC availed in 3B? First, what we need to do? First, we need to take the ITC as per 2B. To that ITC, we need to make 3 additions, 3 exclusions. What are the 3 additions? GST paid under RCM. So, pertaining to the earlier tax periods, re-availed, which is reversed earlier, minus blocked credits, minus ITC with respect to non-business purpose, minus ITC with respect to exempted supplies. Now that balance is called as the ITC availed in GSTR 3B. Now that's what they are telling. Supplier should have furnished the invoices in GSTR 1. Because if supplier is not furnishing invoice in GSTR 1, it will not come in 2B. Then how can you take ITC? Then supplier should have paid the GST on such supplies. Means what? He should have filed the 3B. Supplier should have paid the GST on such supplies. Means you should have filed 3B. What is the time limit? We have ample time limit. Right now you can take, but you should have filed the 3B. So by September 30th of the next financial year. And ITC should not be restricted in GSTR 2B. What is this? Like this is in last additional new condition. That is, in 2B it will come, but in 2B there are 2 columns, ITC available and ITC not available. So it should not come in ITC not available. So department will restrict inward supplies in some cases. So as per section 38, so there are some situations wherein if your supplier has not paid taxes, or if your supplier is a newly registered business, like that, some situations are there. In those situations, whenever GST is filed by the supplier, GSTR 1 is filed by the supplier, it comes in GSTR 2B also, but under 2B which category it will go to? ITC not available category. Why it will go to ITC not available category? Because of some reasons. Okay, so that is given in section 38. So that I have given in returns segment here, returns module. What is that returns module? I think yes. So in returns, I have given this information about section 38. In the following cases, even though supplier declared the details of outward supplies in GSTR 1, ITC can be restricted in GSTR 2B as per section 38. What are those cases? Supplier is a newly registered business. So you can see this if you have book in page number 121. So supplier is a newly registered business. So whenever supplier is a newly registered business, they will say that you cannot enjoy the ITC. So why? Because he might not have filed the returns yet. He is a newly registered person. Still he has not filed 3B. Still he has not regularized his transactions. So due to that reason, we will wait. Means it will be kept under ITC not available in 2B. Sir, then again in future it will come back to ITC available? Yes. Right now it is kept in GSTR 2B, but again it will come in GSTR 2B under ITC available. Right now it is under ITC not available. Okay. Then second reason, supplier has filed GSTR 1 but not filed 3B. So then, see, actually speaking, if we are availing ITC and if he is not filing 3B, we need to reverse. But here it is what? First of all, it will not come in 2B under ITC available, because supplier has defaulted in filing the 3B. So therefore, even if he files GSTR 1, it comes under 2B itself under ITC not available. Then the liability of supplier in GSTR 1 is greater than the liability in 3B. Means what he did, he is adding lot of invoices in GSTR 1, but he did not pay those taxes in GSTR 3B. Then supplier's ITC in 3B is greater than our supplier's ITC in 3B is greater than the ITC as per his 2B. Means he has taken more credit than what he is eligible. Then supplier has received demand notices and defaulted in payment of taxes, and such default continues. Okay, these are the 5 situations where even though supplier filed GSTR 1, but it will be kept in GSTR 2B under ITC not available. Okay, what are the 5 cases? This is again amendment section 38. So what are the 5 cases? Come on. Supplier is a newly registered business. Number 2, supplier has filed GSTR 1 but not filed GSTR 3B. Supplier's liability in GSTR 1 greater than liability in GSTR 3B. Supplier has availed ITC in 3B which is more than his 2B, and supplier has not paid the taxes and notices are served and the default continues. So these 5 cases, if it happens, then the portal will not give that credit in 2B pertaining to that particular suppliers. If you are making purchase, it will not be given. So if it is not given, you cannot take that ITC. You understood or not? So that is the new condition here. ITC should not be restricted in GSTR 2B. Got it? So tell me, what are the 8 conditions? Come on, total 8 conditions. Only a registered person can avail ITC. It should be used or intended to be used in the course or furtherance of business. The person availing ITC should be in possession of tax paid document, should have actually received the goods or services, and should file the GSTR 3B, and his supplier should have filed the GSTR 1, and supplier should have paid the taxes, and it should not be restricted in GSTR 2B. Okay, if these conditions are satisfied, ITC can be availed. Then as per section 16 subsection 3 says that ITC not available on capital goods if depreciation under Income Tax Act is computed on value including GST. Say you are purchasing some capital goods for 10 lakhs and the GST on that capital goods is 1,20,000. Now, while doing block of assets method under section 32 of Income Tax Act, opening WDV of the block, add purchases or additions. In that additions, how much should be taken? Only 10 lakhs. If you take 11,20,000 including GST component, means already you are claiming depreciation under Income Tax Act, you are getting the tax benefit, income tax benefit, so you cannot take ITC. Got it? That is 16.3. Then 16 subsection 4, time limit for availment of ITC. So what is the time limit for availment of ITC? It is 30th November. So it is 30th November, already we have written that. So time limit for availment of ITC 30th November of next financial year, or actual date of filing annual return, whichever is earlier. But this is not applicable in case of re-availment of ITC reversed earlier. This is about section 16, and there are some special points related to section 16. That is how the ITC will be availed in 3B. So this, but in detail I have explained that along with connection to section 41. So this I have given, and supplier will give an invoice to the recipient on 23/7/2021 for 1 lakh plus 12,000, and supplier should file return GSTR 1 for July, and the due date of GSTR 1 is what? 11th of the month following every month. So by 11th August they need to file GSTR 1. They added the invoice. As and when they added the invoice, GST network makes the purchase data available in 2B. By when 2B will be generated? By 13th midnight of the next month, 2B will be generated. Okay, so 14th only they will be able to see. So by midnight of 13th August, 2B will be generated, and ITC will be availed in 3B of July 2021. What is the time limit for filing 3B? 20th of the month following every month. So therefore by 20th August they will file GSTR 3B and they will avail ITC. Understood? And how much is the ITC availed in 3B? Matched ITC minus ineligible ITC as GST paid under RCM. Now, against a single invoice, if goods are received in lots or batches, when we can take ITC? Only upon receipt of last lot or last batch. Then what are the various tax paid documents on the basis of which ITC can be availed? Invoice given by supplier to recipient, then invoice given by recipient to supplier. Generally invoice will be given by supplier to recipient only na, but in case of RCM, so recipient will give invoice to the supplier, that is also a tax paid document. Then debit note. ISD means input service distributor, that input service distributor invoice and bill of entry. Again, this can be tested as a short note question. What are the various tax paid documents on which ITC can be availed? So 5 you need to remember: invoice given by supplier to recipient, recipient to supplier, debit note, ISD invoice and bill of entry. Bill of entry is in case of imports, customs duty along with IGST. That IGST component to take, we need to have bill of entry. Then deemed delivery. Deemed delivery is, so supplier is raising invoice to a recipient but delivering the goods to a third person. Goods are serviced to a third person. So what will happen? These transactions are known as bill to ship to transactions. So what will happen? We will place an order with the supplier to deliver the goods to our customer. So now what will happen? Rather than we collecting the goods and then we sending it to the customer, directly we will ask the supplier to deliver it to our customer. So therefore our supplier will raise invoice to us, but the goods and services are delivered to our person. So now in this case, billing address will be different, shipping address will be different. Now billing address only can take ITC, but we have a condition: goods should have been actually received, service should have been actually received. But the day on which the shipping address receives the goods or services, it is deemed that the billing address is receiving the goods or service and they can take ITC. So date of receipt of goods or services by third person deemed to be the date on which recipient has received and they can take ITC. Then recipient availed ITC based on invoice, okay, but the payment is not made by recipient to supplier. What is the time limit within which the payment should be made by recipient to supplier? 180 days from the date of invoice. Okay, suppose if the recipient is not paying within 180 days, payment not made to supplier within 180 days from the date of invoice, recipient has to reverse the ITC along with interest. Interest at what rate? 18%. Okay, and how the reversal of ITC will be done? 3B. Okay, and again, as and when the payment is made after 180 days, it can be reavailed. But interest is the loss. You understood? Interest paid is the loss. Again, I am repeating. I am supplier. You are my recipient. You did not make payment to me within 180 days from the date of invoice. Now, whatever ITC that you have already availed, you need to reverse along with interest. Again, as and when you make payment to me, you can reavail that ITC. So, but in this arrangement, what is the loss that you will be incurring? Interest. Okay. And non-applicability of this 180 days condition. In 3 cases, this 180 days condition is not applicable. That is, whenever GST is payable under RCM, you are only required to pay tax to government. So there is no condition that you should make payment to me within 180 days. Then 7(1)(c), supply without consideration. Consideration itself is not there. So where from payment will be made within 180 days. Then 15(2)(b), recipient making payment to some other person on behalf of supplier. Any amount that the supplier is liable to pay, but which is paid by the recipient is there na. So that case, payment is not received by supplier, payment is received by some other person. So this 180 days condition is not applicable there. Got it? So 3 cases, 180 days condition not applicable. What is that? RCM, supply without consideration, payment made to some other person on behalf of supplier. So this is about section 16. Okay. So section 17. In this section 16, along with section 16, we completed 2 more aspects also. Section 38, restriction for availment of ITC in 2B, and section 41, availment of ITC in 3B. Okay. Now we are moving on to section 17, that is apportionment of credit and blocked credits. So here we have 5 subsections. 17 subsection 1 says that if you have some inward supplies which are partly used for business and partly used for non-business, you can take proportionate ITC with respect to business. For example, there is a person who is running a bakery shop and he purchased 200 chocolates, 200 dairy milk chocolates he purchased. On the 200 dairy milk chocolates, he took the ITC also. In this 200 chocolates, 50 chocolates he gave it to his son's birthday. So whomsoever guests are coming to his house, So from the shop 50 chocolates of dairy milk is taken and he is giving it to his son, and his son is distributing it to the people who are coming and wishing him on his birthday. Now 150 chocolates are used for what purpose? Business purpose. The remaining 50 chocolates are used for what purpose? Personal purpose. So can he enjoy ITC with respect to entire 200 chocolates? No. Only with respect to 150 proportion he can take ITC. That is the meaning. You understood? Then second one, 17 subsection 2. Inward supplies are partly used for taxable and partly used for exempted. Whether ITC available fully? No. Only proportionate to taxable ITC available. Simple here. I am making a raw material purchase, and out of this raw material 80% is used for taxable. That is, my taxable turnover is 8 lakhs and my exempted turnover is 2 lakhs. Okay, how much proportion I can take ITC? 8 by 10, because total ITC is for both 8 lakhs and 2 lakhs. What is the proportion of taxable? 8 lakhs to total. So therefore that much ITC I can take, proportionate ITC with respect to taxable. Then 17 subsection 3 says the meaning of exempted supply. What are considered as exempted supply for the purpose of ITC? Generally we have meaning of exempted supplies which is notified as exempted, nil rated, non-taxable. But this is only for the purpose of input tax credit chapter, what will be treated as exempted supplies. Then 17 subsection 4, special provisions for bank, financial institution or NBFC. So there is a bank, financial institution or NBFC. So they will not have fully taxable supplies. Reason being, for a bank, financial institution and NBFC, they have interest income and other income. Other income is what? NEFT charges, RTGS charges, debit card, credit card charges, etc. Which will be taxable income? That other charges. But this interest income is exempted. It means partly taxable, partly exempted. How they will take ITC? That is given in 17 subsection 4. And 17 subsection 5 is blocked credits. Now, so we are looking into the meaning. So 17.1 and 17.2 you understood. What is that? Inward supply, partly business, partly non-business. You can take proportionate ITC with respect to business. Then second, inward supply, partly taxable, partly exempted. You can take proportionate ITC with respect to taxable. Then 17.3, meaning of exempted supplies. So this table you need to keep in mind. That is, there are some inward supplies, okay, so which proportionate to taxable we can take ITC. So our turnover should be properly segregated into taxable and exempted. How to segregate the turnover into taxable, exempted? So for the purpose of payment of GST, we have one type of segregation. For the purpose of availment of ITC, we have another type of segregation. So that's why, what is the meaning of exempted supplies? For the purpose of payment of GST. For payment of GST, very simple. So notified as exempted, nil rated and non-taxable. These three are only treated as exempted for the purpose of payment of GST. Understood? And these three are also treated as exempted for availment of ITC. This is nothing special. However, supply under RCM, I am making some outward supply which is covered under RCM. Actually, it is a taxable supply. Only thing, I will not pay GST. My recipient will pay GST. But for ITC purpose, it is treated as exempted. So when my outward supply is covered under RCM, for me it is exempted. So I cannot take ITC on my inward supplies. Done. So that is this. Then next, sale of land, sale of building and sale of securities. These three are actually not at all supply under GST. But for ITC purpose, they are treated as exempted supply. And what will be taken as the value? In case of land and building, we take stamp duty value. In case of securities, we take sale value into 1%. Then, next, interest or discount on loans, advances or deposits is actually an exempted supply for GST. But for ITC purpose, it will be categorized under taxable. Then, transportation of goods by vessel from India to outside India, it is exempted now up to 39/2022. So up to 39/2022 it is exempted, and thereafter it became taxable. So therefore up to 39/2022, even though it is exempted, but for ITC purpose it will be treated as taxable. And zero rated supplies, actually we get the refund, means the burden will become zero. even then for ITC purpose it should be treated as taxable. So these are the 10 points you need to remember. Apart from this 10, any other activity, if it is taxable for payment of GST, it will be taxable for ITC. If it is exempted for payment of GST, it will be exempted for ITC. If it is not a supply, then ignore it for the purpose of ITC. Okay. So now, what is the meaning of exempted supplies for the purpose of ITC? For the purpose of ITC total, no, you have to remember notified as exempted, nil rated, non-taxable, supply under RCM, sale of land, sale of building, sale of securities. That's it. These 7 are only exempted supplies for ITC. Now, there are some exempted supplies for payment of GST, but it will be treated as taxable for ITC. What are they? 2. Interest on loans, advances, deposits. The 2 for whom? Other than bank, financial institution, NBFC. For bank, financial institution, NBFC, it is exempted only for ITC. And then next, transportation of goods by vessel from India to outside India up to 39/2022. Clear here this table. And we have rule 42, manner of availment and reversal of ITC in case of inputs and input services. Okay. So this up to 17 subsection 3, it's simple. Okay. But this is where you will definitely be tested in the practical questions, that is rule 42 and rule 43. Rule 42 talks about manner of availment and reversal of ITC in case of inputs and input services, and rule 43 is manner of availment and reversal of ITC in case of capital goods. Okay. Now concentrate. First we will see rule 42. What does it say? Now you have made some purchases. Okay. So 1 second, give me 1 second. Okay, say this. So these are all the invoices. The invoices. Okay. So total invoices. How many invoices we have? So invoice number 1, invoice number 2, invoice number 3, and one more invoice also I'll take. Invoice number 4 and 5. 5 invoices we have. Okay. In these 5 invoices there is some GST. This is T. Okay. ITC with respect to total inward supplies. T. In this, I need to segregate 4. Invoice, first invoice used for exempted outward supply. Can I take ITC on this? No. So this will be put under T2. Okay. Then this invoice is blocked credit. Can I take ITC? No. So it will be kept under T3. Okay. Then this invoice is used for non-business purpose. Can I take the ITC on this? No. It will be kept under T1. T1. See there. T1. T1 is inward supplies for non-business. T2 exempted. T3 blocked credit. Now this inward supply I am using for taxable. So I will keep it under T4. Then what is this? Common, which is partly used for taxable, partly used for exempted, partly business, partly non-business. That is common credit. So tell me how to arrive at the common credit. Come on. Total ITC on all inward supplies. Total GST paid on all inward supplies. Minus T1, T2, T3, T4. What is T1, T2, T3, T4? Non-business, exempted, blocked credit, exclusively for taxable. Okay. And remaining is known as common credit. Correct? No, listen. So, T1, non-business. Can I take this credit? Why? Section 16, condition for availment of ITC. So only in the course or furtherance of business. Non-business. Can I take ITC? So I am just throwing it. I cannot take ITC. Then T2, can I take ITC? No. If inward supply is used for exempted outward supply, I cannot take ITC. Okay, I am throwing that. T3, blocked credit. I cannot take ITC, so I am throwing. What is this? T4, exclusively for taxable, common credit. These two I will avail as ITC. Got it. So what is ITC availed? Taxable plus common. In other words, T minus T1, T2, T3 is the ITC availed. So ITC availed in 3B is T minus T1 minus T2 minus T3. Got it? Now I availed ITC. Yeah? In this T4 is there na? What is the T4? Fully used for taxable. Can I enjoy fully? Yes, fully I can enjoy. But this can I enjoy fully? Why? It is used for partly taxable, partly exempted. To what extent I should not enjoy? Proportionate of exempted. So this is the exempted portion. Can I enjoy this? So what I should do? Reverse. Okay. Now still it has some more portion which is for non-business. Common, exempted we have thrown, reversed. So still we have something related to non-business. So that also we are taking out. How much? 5% of the total. Got it? This is 5%. 5% of the total. Total means common. 5% of this is common. In this 5%, this also I need to reverse. Now this plus T4 fully I can enjoy the credit. Understood? So common credit, reversal in 3B, common credit with respect to exempted supply, common credit with respect to non-business. What is common credit with respect to exempted? C2 into E by F. What is E? Exempted. What is F? Total. And D2, that is common credit with respect to non-business, C2 into 5%. If you eliminate that, then you will get net ITC. So what is net ITC? First ITC availed in GSTR 3B. What is ITC availed in 3B? T minus T1, T2, T3 minus common credit ka reversal minus reversal of ITC D1 and D2. This is the net ITC eligible for set off. Got it? Can you tell me the steps involved? T. Total ITC availed. Next. Minus T1. What is T1? Non-business. Next line. Minus T2. What is that? Exempted. Next line. Minus T3. That is block credit. Result. ITC availed in 3B. Okay. From that, again, next step. Minus T4. What is that? Taxable. Now, result is common credit. ITC availed minus D4, common credit. Again, common credit minus D1 minus D2. What is D1? Proportionate to exempted. D2, proportionate to non-business. How to calculate proportionate to exempted? So, common credit into exempted by total. How to calculate proportionate to non-business? Into 5%. Common credit into 5%. If you are able to segregate how much is for business and how much is for non-business at the initial stage itself. What is it? Initial stage, T1, T2, T3 stage itself. Then this common credit into 5% reversal will not come, because first of all it will not come under common credit. Okay. Now this computation we need to do for every month, and again we need to do it at the end of the financial year. So provisional reversal on a monthly basis, which is already reversed. Again, final reversal you need to do at the end of the financial year, annual. Now, suppose what you already reversed is greater than what you need to reverse. Means you have excess reversed, correct? So, excess reverse, what you will do? You will again re-avail it as ITC. Suppose if there is a shortfall, what you have reversed is less than what you should reverse, then you have to pay that. Okay. So by April 1st of that, by 31st March of the next same financial year, otherwise interest will be payable at 18% per annum from 1st April of the next financial year till the date of reversal. Understood? This is rule 42 pa. Then rule 43. Manner of availment and reversal of ITC in case of capital goods. So far what we have seen in rule 42 is inputs and input services. 43 is for capital goods. What does it say? If you have some capital goods which are exclusively used for exempted or non-business purpose, you cannot take ITC. Which are used only for taxable and business purpose, you can take the ITC. What if it is partly taxable, partly exempted, partly business and partly non-business? Then what you need to do, take full ITC, listen, take full ITC and then reduce the proportionate ITC for exempted over a period of 60 months. By taking the life of the capital goods as 60 months, means 5 years. Life of the capital goods is taken as 5 years, or in other words 60 months. So month 0 itself you take ITC. Every month for 60 months you need to do the reversal. Got it? Say this. ITC available. First take ITC. Monthly reversal up to 60 months. How to calculate? Total ITC divided by life. Life is 60 months into E by F of that month. E by F of that month means exempted turnover to total turnover of that month. Okay. And plus we need to pay interest also at 18% per annum from the first date after availment of ITC till the date of reversal. And suppose if you dispose of the capital goods within 60 months, then 60 months is the life of capital goods. If you dispose it of, there is one section 18 subsection 6 which says that so much of the ITC availed minus 5% or GST on sale value, whichever is higher. We discussed now disposal of capital goods. So as per that we need to follow 5% for every quarter or part thereof from the date of purchase till the date of disposal, or GST on sale value, whichever is higher. So that we need to pay. Got it? Then next, there are two special situations here. At the time of purchase of capital goods, initial purchase, you have availed the ITC and it is used for taxable. Initial purchase, you are using it for taxable. At a later point of time, you are converting it for both taxable and exempted. What is the treatment? At the time of purchase, initial purchase, you have already availed the ITC because you are using it for what purpose? Taxable. Now, as you are using it for both taxable and exempted, you need to reverse the ITC for the balance life. For example, 3 years you are using for taxable. Total life of capital goods is what? 5 years. In the 3 years you are using it for taxable. So remaining 2 years you are using for both taxable and exempted. So for remaining 2 years, 24 months, you need to do the proportionate reversal. So monthly ITC will be same, total ITC divided by 60. But the reversal that you do only for 24 months because 36 months you are using it for taxable. So ITC already availed at the time of purchase. So further availment shall not arise. Such ITC availed is treated as common credit, and such common credit undergoes reversal for the balance useful life. Whereas if initial purchase you purchase the capital goods and used exclusively for exempted, at a later point of time you are using it for both taxable and exempted, then what you need to do? So at the time when you initially purchase, you would not have taken ITC. Why you would not have taken ITC? Because it was used for exempted. Now you are using it for both taxable and exempted. Therefore, you take the ITC now. Because at the time you have not taken because it was used for exempted. So now you take the ITC, and for last 36 months, same situation. So 3 years we are using it for exempted. Remaining 2 years we are using it for both taxable and exempted. For last 36 months you are using it for exempted. Upon the proportionate you reduce. How to reduce that? 5% for every quarter or part thereof. So 3 years means how many quarters? 4 into 3, 12 quarters. So 12 into 5, 60% you take out. Why? Because that is used for exempted period. Now remaining future you are using it for both taxable and exempted. So proportionately you do the reversal for next 24 months. ITC shall be availed. GST paid on purchase, consider it as common credit. Bulk reversal. How to do bulk reversal for the past period? ITC availed into 5% into number of quarters or part thereof from the date of purchase till the date of conversion. And monthly reversal based on E by F for the future period, for the balance life. Okay. So this is about rule 43. Now you can see one example as to how we will avail the ITC and reverse it for capital goods. July 2020, you purchase some capital goods for 10 lakhs excluding GST at 12%, and it is common capital goods. Now, I availed ITC in July 2020, how much? 10 lakhs into 12%, 1 lakh 20,000. Now, what is the life of this capital goods? 60 months, 5 years. So, from July 2020 to June 2025, what you need to do every month? You need to take monthly ITC. How much is a monthly ITC? 1 lakh 20 divided by 60, that is 2000, 2000, 2000. And you need to see every month what is the exempted turnover and total turnover. So, 2000 into 40 by 120, got it? So, that is 667. This 667 along with interest you need to pay, got it? You need to reverse. Like that every month we need to do the reversal for 60 months. Means sir, 60th month we need to pay interest for entire 60 months. Yes, we need to do that, got it? So, this is about 17 subsection 1, 17 subsection 2, 17 subsection 3, read with rule 42 and rule 43. Okay. Now, let's see whether some questions are given on this in your study material. Input tax credit in the page number pa 528. No, that is GST refunds, no? They have not given any illustrations here. Input tax credit. No. Okay. Say this. This one question related to availment of ITC, section 16, illustration 67 in page number 514. XYZ Limited is engaged in manufacture of taxable goods. Compute the ITC available with XYZ Limited for the month of October 2018 from the following particulars. Inputs A, 1 lakh. One invoice on which GST payable was 10,000 is missing. Can we take ITC on the 10,000? So, remaining 90,000 we can take ITC. Why? Because a person availing ITC should be in possession of tax paid document. Then inputs B, 50,000. Inputs are to be received in 2 installments. First installment has been received in October 2018. Right now we are computing for October 2018. Only on receipt of last lot we can take ITC. So, therefore, we cannot take ITC on inputs B. In capital goods, so this 1 lakh we can take only 90,000. And this 50,000 we cannot take. 1 lakh 20, XYZ Limited has capitalized the capital goods at full invoice value inclusive of GST, as it will avail depreciation on the full invoice value. So, no, we cannot take ITC because depreciation is computed on the invoice value including GST. Input service 2 lakh 25,000. Invoice dated 21/2018 means which financial year? Financial year 2018-19. For financial year 18-19, what is the time limit for availment of ITC? 30th November of succeeding financial year or date of filing annual return. When are they filing annual return? 2021-2018 is not 18-19, it is 17-18. January 2018 means 17-18, no. So 2017-18. 17-18 means 30th November of succeeding financial year or date of filing and return 15 September 2018, whichever is earlier, that is 15 September 2018. But right now we are in October month. Can we take ITC now? No. So for this 50,000 we cannot take ITC. So therefore 1,75,000. So 90,000 plus 1,75,000. How much will be the ITC? 2,65,000. Okay, clear? So this is completely on section 16. In rule 42-43 they have not given anything. But it is there, second. Provisions are there, but provisions are not there. It is there. Okay, it's there. I was expecting this question only. See this question number 14, illustration 14 in page number 454. Illustration 14 in page number 454. Praja Industries is manufacturing company registered under GST. It manufactures two taxable products X and Y and one exempted product Z. X and Y are taxable and Z is exempted. The turnover of X, Y and Z in the month of April was 2 lakhs, 10 lakhs and 12 lakhs. That is mainly for giving the exempted to total ratio. Praja Industries is in possession of certain machineries and purchases more of them. Useful life of all machines is considered as 5 years. From the following information furnished by it, compute the amount to be credited to electronic credit ledger of Praja Industries and amount of common credit attributable towards exempted supplies, if any, for the month of April. Now, machine A purchased on 1/4 for being exclusively used for non-business purpose. Can we take ITC? Why? Non-business purpose. Machine B purchased on 1/4 for being exclusive for manufacturing zero rated supplies. Yes, because zero rated supplies are treated as taxable. So we can take ITC with respect to this. Machine C purchased on 1/4 for being used in manufacturing all the three products XYZ. We can take ITC and it will also become common ITC. Why? Because it is used for X, Y and Z. Z is exempted for that reason. Then next, machine D purchased on April 1, 2 years before for being exclusively used in manufacturing. Z means exempted. Z is exempted. Here 2 years before it was purchased and used for what? Making only exempted product. From 1/4 such machine will also be used for manufacturing products X and Y. Now it became common. Initial purchase it was used for exempted. Whether we would have taken ITC at that time? No. Now it become common. Can we take ITC? Yes. Take ITC and it will become common. And for the last 2 years you are using it for what purpose? Exempted. So 5% you reduce. What is that 5%? So total 8 quarters. 8 quarters into 5, 40% we need to reduce. So 1,92,000 into 40% is how much? 76,800 needs to be reduced for the past period, and you treat it as common also. For the remaining life, you need to do proportionate reversal. Machine E purchased on April 1, 3 years before 1/4, for being exclusive for manufacturing X and Y. So X and Y was what? Taxable. Initial purchase you are using it only for taxable, and now you are using it for Z also. Means don't take ITC, but just treat it as common. Just treat it as common. Now, what is the ITC that shall be availed? Take your calculator. 38,400 plus 96,000 plus 1,92,000. Fully you take 1,92,000 plus 2,88,000. Don't add. Sorry. 2,88,000 you reduce. Only 3. 38,400, 96,000 and 1,92,000. How much? 3 lakh. This is ITC availed minus ITC reversed. What is the bulk reversal? 76,800. Correct? And next, common ITC. Again take calculator. Take the total. 96,000. 38,400 is not common. 96,000. Take your calculator. 96,000 plus 1,92,000 plus 2,88,000. Common you take. Divided by 60. That is monthly ITC. Correct? Divided by 60. Monthly ITC. Into exempted to total. What is the exempted turnover? 12 lakhs. And what is the total turnover? 12 plus 10 plus 2, 24 lakhs. So 12 by 24. How much? 4,800 you reduce. Remaining is the ITC available for utilization. 3,26,400 minus 76,800 minus 4,800. 244,800. Now you can see so what is the common credit attributable to exempted supplies? 4,800. You understood how we got 4,800? Then how much is the ITC availed? 3,26,400. 3,26,400 is the ITC availed, and common credit attributable to exempted is 4,800. But what is the reversal for the past period? 76,800. Understood? So this is question based on rule 43, and look into question number 12. This rule will override here, because actually time limit for availment of ITC section 16 subsection 4, but here as there is a specific provision created in the law, so that's why we will prefer specific over general. So that is general time limit for availment of ITC, but in 43 specifically they are giving it, that's why we are taking it that. Look into question number 12, illustration 12, which is in page number 451. Y Limited manufactures taxable and exempted goods. Y Limited also simultaneously provides taxable as well as exempted output services. Raw material 10,000 units were purchased at 100 rupees per unit, used commonly during the month of January 2018 to produce all final products. GST paid on inputs 12%. Input services commonly used for all goods and services in the month of January 2018. Total ITC on inputs and input services taken into books of accounts in the relevant tax period is 1,74,000. Turnover for the month of January 2018. So taxable supply of goods, exempted supply of goods, taxable supply of service, exempted supply of service. You need to compute the amount of reversal of input tax credit as per rule 42. And they gave one note each unit of exempted final product needs 2 units of raw material. Okay. Now first you see, they are manufacturing both taxable and exempted output services as well as taxable and exempted goods. Raw material how much? 10,000 units. Used commonly during the month to produce all final products. Okay. And GST paid on inputs is 12%. And so 10,000 units, how much is used for taxable and how much is used for exempted? Do we have the data? No, we don't have the data. Whether units is given here? No, units is not given. And for exempted only we have got the units. What is that? 1 lakh divided by 80, we will get the units. How many units of exempted? 1250 units are exempted, correct, used for exempted, and 1250 is finished product. Then what is the raw material required for it? For each unit of finished product, 2 units of raw material is required. So this is FG. And what is the RM used in this? 2500, which means out of 10,000 units, 2500 units is used only for exempted. Okay. Then next, GST paid on input services, commonly used for all goods and services in the month of January. Total ITC on inputs and input services taken into books of accounts is 1,74,000. Now what we need to do? First T. What is T? 1,74,000. 1,74,000 minus T1. Anything non-business? No. T2 exempted. How much? 2,500 units. So calculate how much is that. So 10,000, 2,500 units into what is the price per unit? 100 rupees. And what is the GST rate? 12%. So into 12%, that is 30,000. So reduce 30,000. Okay. T2. T3 blocked credits, nothing. So we will get ITC availed in 3B. What is the ITC availed in 3B? 1,74,000 minus 30,000, 1,44,000. And exclusively for taxable, do we have information? Yes. Because out of this 10,000 units, if 2,500 is for exempted, remaining 7,500 is for what? Taxable. So 7,500 information you take. 7,500 into 100 into 12%. That is 90,000 you need to reduce. Now what is remaining? 1,44,000 minus 90,000. 54,000 is related to services. Input services actually, that is. Because inputs fully over. But input service is commonly used for both goods and services. Correct? Means it is common credit. Out of this common credit, how much is attributable to exempted? What is the exempted turnover? 1 lakh plus 50,000 divided by 4,50,000. So take out 54,000 into, calculate, 54,000 into 1,50,000 divided by 4,50,000. 54,000 into 1,50,000 divided by 4,50,000. How much? 18,000 you need to reduce. So remaining is the common credit available. So what is the ITC availed? 1,44,000. ITC availed 1,44,000. What is the ITC reverse? 18,000. What is the net ITC available for utilization? 1,44,000 minus 18,000. That is 1,26,000. Understood? So how much is the ITC exclusively for taxable? So common ITC 54. Understood? We got the common ITC 54. Out of that common ITC, how much is attributable to exempted? 18,000. Done here. So this is one question related to rule 42. So this is how the question will be. Rule 42 and rule 43. And then on meaning of exempted supplies, so this is one famous question of CMA final. They don't know in how many times they have asked this question. Illustration 10. Page number 449. Messrs. Lips Limited manufactures 4 types of nail polishes, namely Sweetie, Pretty, Beauty, Tweety. The company has taken input tax credit of 3 lakhs on the common inputs used in manufacture of nail polishes. Common inputs also used partly for non-business purpose. During the financial year, the company manufactured 1000 liters of each type of nail polishes. The company was not in a position to maintain separate set of records with regard to inputs used for final products. GST payable on final goods at 12%. Okay. So they manufactured 1000 liters of each type of nail polishes. Input tax credit is 3 lakhs. GST payable on final goods 12%. Sweetie is sold in DTA, domestic tariff area, 30 rupees for 20 ml bottle. How many liters they are making? 1000 liters. 1 liter is how much ml? 1000 ml. So 1000 ml or 100 ml? 1000 ml. So 1000 into 1000 divided by 20 ml. So we get number of bottles. Number of bottles into 30. So therefore value will be 15 lakhs. Understood? Clear? And on that 15 lakhs, it is sold in DTA, means normally we need to pay GST. What is the rate of GST? 12%. So that is 1,80,000. Got it? 15 lakhs into 12%, 1,80,000. First we are determining the GST liability. Then again, Pretty. Pretty sold to SCZ. Sale to SCZ is zero rated supplies. So in the absence of information, they are telling that, so they have not given export under bond or LUT, etc. In case of zero rated supplies, we have 2 options. Option number 1, pay IGST and get refund of IGST, or don't pay IGST and supply it under LUT or bond. But in the absence of information in the question, so we can take any assumption. So this has to be clearly given in the question. Otherwise, anyway we should be able to do the answer. But they have taken an assumption that they are not paying tax. So they are not paying tax means, so how much is the value? Value you need to arrive. So total 1000 liters into 1000 ml per liter divided by 20 into 40, that will be 20 lakhs will be taken as the value. But it is zero rated, so no GST. Okay. And then sale of A Limited to USA, exports, again no GST. So 1000 into 1000 divided by 20 into 50, that is 25 lakhs, zero rated, no GST. Sale to defense canteen, exempted from GST, no GST, but it is not zero rated, it is exempted. So therefore 1000 into 1000 divided by 20 into 60, that will be 30 lakhs will be exempted. So this is the total turnover. Clear? And for the purpose of ITC, zero rated is also treated as taxable. So what is the total ITC? 3 lakhs. So 3 lakhs into what by what we can take ITC? Taxable by total. What is the taxable turnover? Sir, 15 lakhs is taxable, 20 lakhs is taxable, 25 lakhs is also taxable. Correct? Because zero rated will be treated as taxable for the purpose of ITC. So 15 lakhs plus 20 lakhs plus 25 lakhs, that will be 60 lakhs. So 60 divided by 90. So 3 lakhs into 60 divided by 90, that will be 2 lakhs we can take as ITC. So the answer is 2 lakhs which we can take as ITC. Answer they did not give. This is which question, yeah? No, some other question they merged here. Now input tax credit eppadi pa 1 lakh, 3 lakhs only, no? Oh, okay. Fine. So 2 lakhs is the ITC available. They did the reverse. Okay, fine. That's correct. 1 lakh we need to reverse and 2 lakhs we will take ITC. Then non-business purpose is actually wrong. This is a mistake because Here none of the inward supplies is used partly for business and partly non-business is given. It is given. Common inputs are also used for non-business purpose. Then the common credit 3 lakhs into 5%, that is also to be reversed. So total 1,15,000 to be reversed. Okay. So this is with respect to, which means what is the ITC available? 3 lakhs minus 1 lakh minus 15,000. So remaining 1,85,000. Okay. Now enough. So we did the questions on Rule 42, Rule 43 and even on that 17.3, meaning of exempted supplies. Now have a look into 17 subsection 4, special provisions to bank, financial institution and NBFC. That is, they have two options. Option 1, they can take proportionate ITC. So proportionate ITC means what? So far we did Rule 42, 43, like that they will take. Or ad hoc option. Ad hoc option means total ITC 50% they can take. But what is the ITC on which they can take? Common ITC differs. So in case of Rule 42, 43, while doing the proportionate ITC, we take out common ITC as T1, T2, T3, T4. T1 is what? Non-business. T2 exempted. T3 block credit. T4 taxable. Everything we will eliminate, we get common ITC. But when we do ad hoc basis, we should eliminate only two. T minus T1 and T3. What is T1? Non-business. T3 is blocked credit, means exclusively for taxable, exclusively for exempted, is also treated as common. Got it? Exclusively for exempted and exclusively for taxable is also treated as common. And one more difference is that 100% ITC available with respect to inward supplies from distinct persons. So for example, HDFC Bank Karnataka receives service from HDFC Bank Tamil Nadu. So it's a transaction between distinct person. No need to take 50%. Full ITC they can take. But if you go for option 1, proportionate ITC will be available. And what happens to the remaining ITC? That will be lapsed. And this option, once exercised, cannot be withdrawn during remaining year. So for example, you see, bank exempted supply 20 lakhs, taxable supply 10 lakhs, common ITC 1,50,000. Under option 1, what they will do? 1,50,000 into 10 by 20 they can take. That is 50,000 they can take as credit. But in option 2, 1,50,000 into 50%, 75,000 they can take as credit. So now they need to decide in the beginning of the financial year which option they wanted to go for. But that will be applicable throughout the financial year. Then every year we can change, but within the year we cannot change. Next year we can again change it for other option. Then 17 subsection 5, blocked credits. So blocked credits we have totally into 3. Motor vehicles related blocked credit, construction related blocked credit and other blocked credits. First, motor vehicle related block credit. Motor vehicles are divided into 3. Motor vehicles for transportation of persons, vessels and aircrafts and other motor vehicles. Other motor vehicles means truck, lorry, etc. ITC always available. Whereas motor vehicles for transportation of persons, so capacity does not exceed 13. While counting capacity include the driver seat also, and it is a blocked credit. But we have exceptions. In 3 cases we can take ITC. What are those 3 cases? Further supply, or used in the business of transportation of passengers, or imparting driving skills, ITC available, and other cases ITC not available. Whereas if the capacity of the motor vehicle exceeds 13, that's not a block credit, we can take ITC. So which one is blocked credit? Only capacity does not exceed 13. But in that also we have 3 exception cases. What is that? Further supply, used in the business of transportation of passengers, driving schools, they can take ITC. Then capacity exceeds 13 is not a block credit, always ITC available. Example, buses, etc. Then vessels and aircrafts. Vessels and aircrafts again blocked credit, but we have 4 exceptions. These 3 are common. Further supply, business of transportation of passengers and imparting driving schools, imparting driving skills. Extra point is transportation of goods. If we buy some vessels and aircraft which are used for transportation of goods also, we can take ITC. And other cases ITC not available. Now listen carefully. There is a company, manufacturing company, which purchased a bus that can carry 40 people from the house of the employees to the factory and factory to the house of employees. They are using that bus for transportation. Can they take ITC? There is a company which purchased a bus for transporting its employees. Capacity of the bus is 40 and they are using it for transportation of employees from home to office, factory and factory to home. Can they take ITC? Yes. No, I am talking about ITC. Can they take ITC? Yes. Why they can take ITC? See there. Which motor vehicle? Motor vehicle for transportation of persons. And capacity exceeds 13. 40 seater I said. Capacity exceeds 13. Therefore, it is not a block credit. ITC available. Next example. There is a cost accountant who purchased a car for use in his profession. Purely for profession. For personal purpose, he is not using at all. Can he take ITC on the car purchased? Why? Capacity does not exceed 13 and used in the business of transportation of passengers, imparting driving skills, further supply, no. So blocked credit. ITC not available. Then Reliance Industries Limited purchased an aircraft for transporting its director. Can they take ITC with respect to that? Why? Vessels and aircraft block credit. Further supply, no. Used in the business of transportation of passengers, driving skills used for transportation of goods, no. So ITC not available. Then a company purchased a truck for transportation of goods. Can they take ITC? Yes. Then they purchased a road roller for laying down the roads. Can they take ITC? Yes. Because other motor vehicles, they can take ITC. Then 4 services in relation to motor vehicles. That is insurance service, repair and maintenance service, authorized service station service and hiring, renting and leasing of motor vehicles. These 4 services in relation to motor vehicles, if motor vehicle is eligible for ITC, ITC available with respect to these services. If motor vehicle purchased is not eligible for ITC, ITC not available with respect to these services. Understood or not? So, first we need to see whether motor vehicle is eligible for ITC. If yes, then this service also ITC available. For example, I will give you, there is one person who is using his car for transportation of passengers through Ola, and for that car he has taken insurance and he paid insurance premium plus GST. Can he take ITC with respect to that insurance premium? Yes. How? First, car capacity does not exceed 13 and it is used in the business of transportation of passengers, so ITC available. As car is eligible for ITC, the insurance service with respect to that is also eligible for ITC, like that. Okay. Then another example, a company taken a car on hire for transportation of its employees. Can they take ITC with respect to that? Hiring charges paid for car. First, car capacity does not exceed 13, not covered under exceptions. So it is a blocked credit. When car is a blocked credit, when you take the car on rent also, that rent will be blocked credit. Understood? So 4 services: insurance, repair and maintenance, authorized service station, hiring, renting and leasing of motor vehicles. If motor vehicle purchase is eligible for ITC, ITC available on these services. If motor vehicle purchase not eligible for ITC, ITC not available on these services. Then construction related blocked credit. There are some inward supplies, that is 3 things related to construction of an immovable property. Any goods purchased for construction of immovable property, any service received for construction of immovable property, work service received in relation to construction of immovable property. These 3 are blocked credits. So ITC not available, but we have 3 exceptions. Suppose if the construction expenditure is not capitalized but charged to P&L, they can take ITC. Construction expenditure charged to P&L, they can take ITC. Or construction of plant and machinery. So what is that? Plant and machinery, example lifts, escalators, etc. For that, if they receive any construction services, they can take ITC. However, plant and machinery excludes telecommunication towers and pipelines laid outside the factory gate. Then restriction do not apply to supplier. What does it mean? So actually this blocked credit restriction is only to the owner of the property. I am a builder. I am buying the material or I am receiving the construction service for providing construction service. Can I take ITC? Yes, because the restriction is only to the owner of the property. Then next, other blocked credits. In this other blocked credits, we have membership of a club, health and fitness center. So membership of a club, health and fitness center, so is a blocked credit. So for example, Lions Club, Rotary Club and all, or some professional clubs also membership will be taken. On that GST is paid. Even though it is used for business, ITC not available because it's a block credit. However, we have one exception. If the membership is taken by employer for employee under a statutory obligation, then they can take ITC. So maybe under a statutory obligation, so as per government order, so employer is required to take membership for the employees, one recreational membership. As it is under the statutory obligation, so the GST paid can be taken as ITC. Then travel benefits extended to employees on vacation. So employees vacation expenditure is borne by the employer, it's a blocked credit. Again here we have an exception, that is if it is under a statutory obligation, then ITC will be available. Then number 3, food and beverages, beauty treatment including cosmetic and plastic surgery, health insurance and life insurance. So total 3 related to food and beverages, related to beauty treatment, cosmetic surgery, plastic surgery, then related to insurance, health insurance and life insurance. These 3 are blocked credits. But for these 3, we have 3 exceptions. First one normal, statutory obligation. Second one is what? Inward supply, outward supply in the same category. Means what? I am into the business of catering, food and beverages. I buy the food and beverages. Can I take ITC? Yes. Then inward supply is part or component of outward supply. For example, airlines will buy food and beverages for giving it to the transportation of passengers. So inward supply is part of composite or mixed outward supply. So they can take ITC. Then next one, inward supplies of NRTP is blocked credit. So NRTP, non-resident taxable person who come from outside India to India, even though he registered, he cannot take ITC. Exception is on import of goods. Only on import of goods, whatever IGST he pays, he can take ITC. Then goods purchased for personal consumption. So because not in the course or furtherance of business, and GST paid under composition scheme also cannot be. First of all, person opting for composition scheme should not charge GST to us. Even if he charges GST to us, we cannot take ITC. Then hiring, leasing and renting of motor vehicles, already we studied one point. What is that? If motor vehicle is eligible for ITC, hiring, renting and leasing of motor vehicles is eligible for ITC. But even then we have no blocked credit. 3 cases, it is an exception, we can take ITC. What is that? If hiring, leasing and renting of motor vehicles is under a statutory obligation. I told you that employer taking a car on rent for transportation of employees, as per above point, it is block credit. What if the employer is taking it under a statutory obligation? Then ITC available, like that. And I am into the business of renting of motor vehicles. I take a motor vehicle on rent and I give it on motor vehicle on rent. I can take ITC. Then if renting of motor vehicle is part of outward supply. For example, I am having one wildlife sanctuary. In this wildlife sanctuary, if you want to visit this, you have to pay the entry ticket. Also, you need to take one jeep on rent. You cannot go by walk. You go by walk, you will not come out. Okay. So only your dead body will come out. So because wildlife sanctuary, animals and all will be wandering. So therefore, a proper jeep needs to be taken on rent. So I am providing 2 things. That is entry to park and hiring of jeep. Now I will take the jeep on hire. So can I take ITC? Yes. Inward supply, part of the outward supply. So I can take ITC. Then goods purchased or lost, stolen, written off, destroyed or given as gifts or free samples. Is there any exception to this? Yes. Suppose if the outward supply, if the gifts or samples becomes supply under 71C, then we can take ITC with respect to that. Okay. Even if insurance compensation is received, ITC not available. Got it? So this can be tested in MCQ that goods are lost and insurance compensation received. ITC available or not? No. See, ITC not available because purchased goods are lost. Whether you receive compensation or not receive compensation, that do not have any impact on that. So this is about blocked credits, 17 subsection 5. And so you can see your study material. that some questions were given. $472. Not this part. Like this you will get questions in exam. Illustration 44, page number 475. Determine, but no, I got a very good idea about your study material now. So like some questions, if we take and properly put it, that itself the students will be able to find it easy. Now the questions like that below that concept itself, if we do know this question should be solved like that. If someone gives it, it will be better. So if time permits, I will do it for you. Like this section, what are all the questions that you need to solve? So that that questions at least you can see from the study material and go for exam. Okay. So say this, determine the amount of input tax credit available with Arihant Manufacturing Limited in respect of the following items procured by them in the month of January 2023. Raw materials 72,000. Can we take credit? Anywhere in the block credit? No. Used in the course or furtherance of business? Yes. So we can take ITC with respect to this. Food and beverages and catering service are used in the guest house primarily for the stay of newly recruited employees. First, food and beverages and catering is blocked credit. Exception number 1, statutory obligation? No. Exception number 2, inward supply, outward supply in same category? No. Inward supply part of outward supply? No. So therefore it's a blocked credit, ITC not available. Inputs used for making structures for support of plant and machinery. Generally immovable property ITC not available, but plant and machinery is an exception, it is available. Capital goods used as parts and components for use in the manufacture of final product. Yes, we can take ITC with respect to this. So therefore except this 40,000, in all other cases we can take ITC. Then one more illustration. ABC India Limited is engaged in manufacture of some taxable goods. It purchased the following goods in the month of October 2022. So raw material used for production of final product. Can we take ITC with respect to this? Yes. Goods used for generation of electricity for captive consumption. So is it used in the course or furtherance of business? Yes, we can take ITC. Goods used for providing free warranty and value of such free warranty is included in the price of final product. Yes, we don't have any restriction, used in the course or furtherance of business. Light diesel oil. So first of all on diesel, so whether we are paying GST? Yes. So on high speed diesel only we don't have GST, but on light diesel oil we have GST. So 5,000 we can take ITC, used in the course or furtherance of business, and we don't have any restriction. So therefore 1 lakh, 20, 10 and 5. So all these things. And they also purchased high speed diesel oil. On high speed diesel oil can they take ITC? No. Because first of all GST is not there. That is only excise duty, and that cannot be taken as input tax credit under GST. Okay. So that is with respect to these questions. Then one more. Okay, say this. Mr. X 39. Mr. X, page number 473. Mr. X being a contractor undertaken construction work of an individual residential unit otherwise than as a part of residential complex. You are required to answer Mr. X is liable to pay GST whether he undertaken pure labor contract, where he undertaken pure labor contract, taxable or exempted. So Mr. X being a contractor undertaken construction work of an individual house otherwise than as a part of residential complex. You are required to answer if X is liable to pay GST where he has undertaken a pure labor contract. No, exempted. We discussed in construction services. What is it we discussed? So construction of an individual unit otherwise than as a part of complex is exempted, but it should be only pure services. What if it involves both labor and material? Then it is not exempted, it will be taxable. If Mr. X is giving contract to subcontractor, can subcontractor also get exemption if it is a pure labor contract? No. So because only for construction, directly construction of a residential complex. Then can they take ITC with respect to this? Yes. Why they can take ITC with respect to that? We have now the restriction is only to the owner of the property, not to the supplier. Okay, fine. Then the next area that we are discussing is section 18. Section 18 talks about input tax credit in special cases. In that, section 18 subsection 1 is about availment of ITC on closing stock. 18 subsection 2 says what is the time limit within which the goods should have been purchased to take the ITC on closing stock. So 18.1 and 18.2 are connected. 18.1 is availment of ITC on closing stock. 18.2 time limit for purchase of that closing stock. 18.3 is transfer of ITC. So whenever the business is transferred, ITC can be transferred from one person to another person. 18.4 is reversal of ITC on closing stock. So opposite of 18.1. Okay. Then 18.5 is reference to rules. And 18.6 GST on supply of capital goods. We discussed now ITC availed minus 5% for every quarter or part thereof from the date of purchase till the date of supply, or GST on sale value, whichever is higher is the GST payable, that one. Okay. Now availment of ITC on closing stock as per 18 subsection 1. So there are total 4 clauses we have: 18.1a, 1b, 1c and 1d. 18.1a says that a person has commenced a business. With example I am just giving you for understanding. A person has commenced business on 15/5/2023. On 39/2023 he is liable to get registered, and he makes application for registration within 30 days on 20/10/2023 application for registration. Now registration certificate is granted on 25/10/2023. Before the date he is liable to get registered, he will have some closing stock now, as on 29/9/2023. What is that closing stock? Inputs as such, inputs in WIP, inputs in FG. With respect to this, whatever GST paid, he can avail as ITC. After the date, he get the registration certificate. Why? Because using this closing stock only, he will make outward supplies after 39. And on that outward supply, he need to pay GST. That's why on the purchases, they are giving ITC. But why ITC not taken at that time? Because at that time, he was an unregistered person. But to get this benefit of availment of ITC on closing stock, he should make application for registration within 30 days from the date he is liable to register. And after registration certificate, what is the time limit within which he should take ITC? So avail as ITC within 30 days or extended time after registration. Okay. This is 18.1a. So when 18.1a is applicable, there is a person who is liable to get registered and he makes application for registration within 30 days. Then 18.1b is that a person commenced business on 15/5. On 39/2023, he voluntarily made application for registration and he got the registration certificate on 10/10. So from 10/10/2023, he is liable to pay GST. Now before that date, he would not have taken ITC because he was not registered. So that is on 9/10/2023. Whatever is the closing stock, on the closing stock, GST paid can be availed as ITC. That is inputs as such, inputs in WIP, inputs in FG. GST paid can be availed as ITC. Again, same time limit, 30 days after registration or extended time, they should take as ITC. So what is the difference between 18.1a, 1b? Both are same, but except the situation. 18.1a is liable to get registered, made application for registration within 30 days. 18.1b is voluntary registration. And even closing stock date also will change. 18.1a, before the date the person is liable to get registered. 18.1b, before the date the person got registered. 18.1c is there is a person who is exiting from the composition scheme. Today we discussed that. So a person who was under composition scheme, now he is going into normal scheme. So before that date there is some closing stock. Now what is the meaning of closing stock? Inputs as such held in stock, inputs in the form of WIP, inputs in the form of FG, even capital goods also. Even capital goods also, GST paid can be availed as ITC. And what is the time limit? Within 30 days from exit from the composition scheme, they can take this ITC. Whereas 18.1D, there is a registered person and that registered person was making exempted supply. So he would not have taken ITC at that time. Now, with effect from 15.11, he started making taxable supplies. So now, before 15.11, that is on 14.11, whatever is the closing stock, on that he can take ITC. Meaning of closing stock same as 18.1c, that is inputs as such held in stock, inputs in WIP, inputs in FG and capital goods. So GST paid can be taken as ITC within 30 days after conversion, that is 15.11. And special points and above, in case of capital goods, ITC availed under 18.1c and 18.1d is how much? Not full GST paid. So GST paid minus depreciation. What is the depreciation? We need to provide 5% for every quarter or part thereof from the date of purchase till the date of conversion. Okay. Then in all the above cases, the closing stock should have been purchased within 1 year prior. So means invoice date to the closing stock date. So means here closing stock date is 14.11 na. So invoice date to the closing stock date, it should not exceed beyond 1 year, because on obsolete stock and all they don't want to give the benefit. That's why. That is given in 18.2. And how to avail this ITC? We need to avail this ITC in GSTR 3B. No, we need to file one form, that is ITC 1, and that should be certified by CA or CMA if the claim of ITC exceeds 2 lakhs. Otherwise, such form is filed with self-declaration by registered person. Then next, section 18 subsection 3, transfer of ITC. So whenever there is a transfer of business with specific provision for transfer of liabilities, okay, means what? Transfer of business as a going concern, then the unutilized ITC shall be transferred from electronic credit ledger of transferor to electronic credit ledger of the transferring. For example, I am transferring business to you. Now when I am transferring business to you, in my electronic credit ledger some ITC will be there na, that will be transferred to your electronic credit ledger. For that, transferor should file a form in ITC 2. Again, that should be certified by CACMA that such transfer of business involves transfer of liabilities. And suppose in case of demerger, how it can be transferred, because single unit is getting split into 2. So on what ratio it will be transferred? It shall be transferred in the ratio of assets after demerger. Then 18 subsection 4 read with section 29 subsection 5, that is, this is an opposite of 18.1, availment of ITC on closing stock. Here we are doing reversal of ITC on closing stock. That is, we have when reversal of ITC on closing stock, so opposite of 18.1c 1d. What is 18.1d? You are making exempted, now you became taxable. Now opposite, you are under taxable supplies, your outward supplies became exempted, or you are opting for composition scheme, or there is cancellation of registration. In these 3 cases, so whatever is the closing stock on which ITC availed needs to be reversed. Okay. So closing stock is raw material in WIP, raw material in FG. For this, how much ever is the ITC availed, that will be reversed. Okay. Either based on invoice or based on market value as on the closing stock date. If invoice is not there, take the market value as on closing stock date, that should be certified by CA or CMA. But if it is capital goods, so what you need to do is that, so you need to take ITC avail divided by 60 months into balance useful life, because total ITC you have taken, 60 months is the life, how many months is the balance, for that many months you need to reverse the ITC. Suppose if we have disposed it off, if the capital goods is already disposed of, then we would have followed 18 subsection 6. What we will do in 18 subsection 6? ITC avail minus 5% for every quarter or part thereof, or GST on sale value, whichever is higher will be the GST payable. Okay. So this is the connection for that. disposal of capital goods on which ITC availed, then only 18.6. If ITC not availed, section 15 already we discussed. And GST payable under 18.6, if it is disposal within 5 years, then ITC availed minus percentage or value under section 15, whichever is higher. But if it is refractory bricks, molds and dies, jigs and fixtures sold as scrap, we have a special point. You don't have to take A or B, whichever is higher, just sale value into GST rate. So that ITC availed minus 5% will not come into the picture. Understood? Then what if it is disposed of beyond 5 years? A point will become 0. Why A point will become 0? 5% for every quarter or part thereof. So A will become 0. Only B, value under section 15 into GST rate. Clear here? This is about section 18. Now look into section 19. This is, and section 18, one question I have seen in your book. Yes, look into question number 51, page number 486. Question number 51, page number 486. Messrs. X Limited becomes liable to pay tax on 1st December and has obtained registration on 15 December. Whether registration is obtained within 30 days? Yes. The GST paid goods lying in the premises of X Limited on 30th November are as follows. Raw material 2 lakhs 36,000. Can we take ITC? Yes. Capital goods? No, because under 18(1)(a, a person is liable to get registered and he makes application for registration within 30 days. He cannot take ITC on capital goods. Raw material lying in work in progress? Yes. Raw material lying in finished goods? Yes. What is the eligible amount of input tax credit? 36,000 plus 54,000 plus 2,16,000. 3,06,000. 3,06,000 can be taken. What is the time limit to submit a declaration on the common portal? Which is the form? ITC 1. And that should be certified by a cost accountant or chartered accountant, and it should be submitted within 30 days or extended time after registration. Okay. Then, whether any certification is required for availing ITC? Yes. But if the claim of ITC exceeds 2 lakhs. If the claim of ITC exceeds 2 lakhs, but in this case it is 3,06,000. So definitely certification is required. Got it? Then look into 52. Mr. A applies for voluntary registration on 22nd November and obtained registration on 25th November. Mr. A has stock on the following 2 dates. So 21st November, 12,000 units, opening balance, purchased 20,000, sold 8,000. On 24th November, Mr. A purchased 5,000 units and sold 15,000 units. 24th November, A is also purchased plant and machinery for 2 lakhs plus GST 28%. Mr. A purchased goods at uniform rate throughout the year at 100 rupees per unit plus GST paid 18%. You are required to find the eligible input tax credit to Mr. A. So when he is applying for voluntary registration 22nd November, and when he got the registration on 25th November, so we need to take the closing stock as on 24th November. So what is the closing stock as on 24th November? So on 24th November, first we have got 21st November opening balance. Okay, 21st November opening balance is what? 12,000. 12,000. Purchased 20. So 12,000 plus 20,000 minus 8,000. 24,000. That is closing stock as on 21st November. Again, on 24th November, he purchased 5,000. So add 5,000 and minus 15,000. So that will be 14,000 units. Correct? And 14,000 units into 100 rupees per unit into 18%. 14,000 into 100 into 18%, 2,52,000. Okay. 2,52,000 is the input tax credit. You understood how we got this 2,52,000? That is 12,000 plus 20,000 minus 8,000. We got closing stock as on 21st November. Again, we made a purchase as 5,000 and 15,000. So, based on that, into 100 rupees into 18%. On capital goods, can they take ITZ? No. Why? 18(1)(b), voluntary registration, they cannot take credit on capital goods. They can take credit on capital goods only in case of 18(1)(c) and 1(d), that is composition scheme to normal scheme, or exempted supplies to taxable supplies. Understood here? Then look into this illustration 54, page number 487. The goods manufactured by Royal Limited have been exempt from GST with effect from 15 November 2017. Earlier, these goods were liable to tax at 18%. So, it have been exempted. Earlier, taxable, now exempted. So, taxable to exempted. 18(4). We need to reverse the ITC. Okay. Its inputs were liable to GST at 12%. Following information is supplied on 15 November. The inputs costing 1,44,720 are lying in stock. So, on that ITC we need to reverse. But we need to know whether it is inclusive of GST or exclusive of GST. Okay. So, inputs costing 1,44,720 are lying in stock. So, the inputs were liable to GST at 12%. Anywhere it is given all the above amounts are exclusive of GST? No. So, we assume that it is inclusive of GST here, and 1,44,720 into 12 by 112. 1,44,720 into 12 divided by 112 is what? 15,506. No, they have taken exclusive of GST. Not understood. No. So, they have taken the assumption as exclusive of GST. Sorry, pa. So, therefore, into 12%. Into 12% means what? 1,44,720 into 12%. 17,366.4366. Then inputs costing 77,184 are in process. That also we need to reverse. So 77,184 into 12%, that is 9,262. Finished goods valuing 4,82,400 are in stock, and out of this 50%, the input cost is 50% of the value. Royal Limited also purchased capital goods. So, out of this 4,82,400, how much is the raw material value? Only 50%. On that you multiply 12%. That is 28,944. Then capital goods 2 lakhs by paying GST 28%. Invoice dated 10th July 2017. Okay. So, how many months we have used? July, if you have used for more than 15 days, take it 1 month. So, July, August, September, October, November. November, again 15. So, more than 15 only we should take it as. So, more than 15, we should take it as 1 month. Otherwise, we will not take it as 1 month. So, therefore, we will take it as July, August, September, October, 4 months. So, therefore, 2 lakhs into 28% divided by 60 months into what is the balance life? 56 months. So, 2 lakhs into 18% divided by 60 into 56, that will be 33,600. That needs to be reversed. So, what is the total amount to be reversed? So, they gave 33,600. 55 months they have taken. So, number of months capital goods have been in use for 4 months and 5 days. 5 months is actually wrong, pa. It should be 4 months only, because that 15 days point is there that they have missed in the study material. Maybe it's an error in study material, because as per rule it should be 15 days. More than that 15 days, then only we should be taking it as full month. Okay. So, therefore, here 33,600 we will take. This is the correct answer. 17,366 plus 9,292 plus 28,944 plus 33,600. So total 89,202. What is the balance in credit ledger? 2,79,104. So it will be adjusted and remaining will be lapsed. Okay. What if the balance in ledger is only 29,104? That much we will adjust from the credit and remaining we need to pay. You understood? So we'll take a break and thereafter we will continue with the remaining 19, 20 and 21, and after this input tax credit we will discuss, as I said, offences, penalties that we will discuss. Okay. Okay, we'll start. So look into section 19. Section 19 deals with input tax credit with respect to goods sent on job work. That is, say there is a principal who purchased some inputs. On purchase of that inputs, ITC is availed. Now that inputs are sent to the job worker. When the inputs are sent to the job worker by the principal, principal is not required to reverse any ITC. But there is a condition. What is that? That processed goods should have been returned back to the principal within 1 year, plus it can be extended for a further period of 1 year. If it is not received within the time, then it will be treated as supply and GST payable along with interest. So, what is the time limit within which the goods should be sent back by the job worker to the principal? Within 1 year plus 1 year. Suppose if the goods are not sent back within 1 year, then after expiry of this 1 year time, so it is deemed that the principal has sold the goods to the job worker before 1 year. After 1 year, you came to know that you did not clear CMA intermediate. How it will be? You are right now preparing for CMA final and CMA intermediate already completed. Now CMA Institute said there is some mistake in the evaluation and CMA intermediate, so sorry, your result is failed. So this attempt don't write CMA final, write CMA inter. Like that it is. After 1 year, it becomes supply. By the time of supply is 1 year before. Means we need to pay a huge interest. Got it? Then same way. If principal purchases capital goods on which ITC is availed and the principal is sending the capital goods to the job worker, no need to reverse at the time when it is sent to the job worker. But the job worker should return that within 3 years, plus it can be extended for a further period of 2 years. If not, then the capital goods are deemed to be sold by the principal to the job worker and they need to pay GST along with interest. But this 2 years, 3 years plus 2 years time limit is not applicable in case of 3 goods. That is molds and dies, jigs and fixtures and tools. Somewhere we discussed something of this sort where 18 subsection 6. In 18 subsection 6, refractory bricks, molds and dies, jigs and fixtures. No need to take A or B, whichever is higher, just transaction value into GST rate. Here in the 3 refractory bricks you take out. So add, we have molds and dies, jigs and fixtures and tools. And principal should furnish a statement in form GST ITZ 4. So we have ITZ 1 for availment of ITZ on closing stock, ITZ 2 for the purpose of transfer of business, and ITZ 3 for reversal of ITZ on closing stock. ITZ 4 is job work. So what is the time limit within which that statement needs to be furnished? Previously it was on a quarterly basis. Now there is an amendment. If aggregate turnover during the previous year exceeds 5 crores, 25th of the month following every half year. If aggregate turnover during the previous year does not exceed 5 crores, then 25th of the month following every year. Means previous year if their aggregate turnover does not exceed 5 crores, only one time in a year they have to file. That is for the entire financial year by 25th April of the next financial year. Suppose if their aggregate turnover exceeds 5 crores, 2 times they need to furnish. First half year, April to September by 25th of October and October to March by 25th of April. That is the point there. Then this is the logic. Section 19 read with section 143. So see this, on 20/10/2019, so inputs are sent by the principal to the job worker. Are you able to see that? And principal has purchased these inputs and paid 1 lakh plus 12,000. So therefore principal would have availed ITC 12,000. Now on 12/10/2019 when the inputs are sent to the job worker, whether principal should reverse any ITC? No. Whether the job worker will take any ITC? No. Now exactly 1 year we need to see, plus 1 year, that is 12/10/2020. So here goods, processed goods should be returned by that time, but processed goods are not returned. When the processed goods are not returned, it is deemed as supply by principal to job worker as on which date? 12/10/2019. But the fact that it is supply on 12/10/2019 is known on 12/10/2020. So therefore they need to pay GST. How much is the GST they need to pay? How much ever ITC availed, that much is the GST payable, 12,000, along with interest at 18% from 21/11/2019 till the date of payment. Got it? And they need to raise an invoice to the job worker for that 12,000. So therefore they will recover 12,000 from job worker, and job worker will take ITC of 12,000. Up to this clear? Now job worker is returning the goods after 1 year. After 1 year, so principal paid GST, ITC availed by the job worker. Now job worker is returning the goods. Now when job worker is returning the goods, it will be treated as new supply made by the job worker to the principal, and again job worker has to pay GST. But sir, double taxation, or no, he availed ITC, that much he create a liability. You got it? He availed ITC of 12,000 na. Now he creates a liability of 12,000. So processed goods is given and GST is payable to government. But the problem here is, what will be taken as the value? The value will be of processed goods. He will not pay GST, treating it as input sent. He will treat it as processed goods sent. Processed goods value is what? Say 2,50,000. On that they need to pay GST 12%. So literally what is the loss to the job worker here? 30,000 minus 12,000, 18,000. Will they pay out of their pocket? No, they will in turn recover it from the principal, and the principal will take ITC of 30,000 rupees. Got it? So this is how practically it happens, and these are the various forms. ITC 1 for availment of ITC on closing stock, 18(1). ITC 2 transfer of ITC. ITC 2A is there, that is whenever single registration of a person is getting split into multiple registration, from that single registration whatever is ITC is there, that will be transferred to the multiple registrations. For that they will file one form, that is ITC 2A, and thereafter ITC 3 is for reversal of ITC on closing stock. ITC 4 details relating to goods sent on job work, received from job work. These are the forms. Then finally we have section 20 and 21, input service distributor. Who is an input service distributor? A head office which receives the services and takes ITC and distributes that ITC to the branches is known as input service distributor. For example, MRF Limited is a tire manufacturer and they have a corporate office in Chennai, Tamil Nadu. Now, they receive service of a chartered accountant or a cost accountant, and the invoice for that is 20 lakhs excluding GST. And now, actually the audit services are provided to the factory, but the invoice is raised to the company, head office. Now the head office will take the credit. How much credit? 20 lakhs into 18%, 3,60,000, and that 3,60,000 they will distribute it to the factory, factory 1, factory 2 and factory 3. In what ratio? In their turnover ratio. See the turnover of factory 1, 2 and 3, 1,000 lakhs, 800 lakhs and 600 lakhs. So in the ratio of 5:4:3, the credit will be distributed. So 3,60,000 into 5 divided by 12. So that will be 1,50,000, 1,20,000 and 90 they will distribute it to these factories, and for that they will be preparing a ISD invoice. And now that head office will not have any outward supplies. So their job is only to just take the credit and distribute the credit. For that they need to register as a input service distributor. Okay. And special points not applicable in case of inputs and capital goods. See, this is only input service distributor, not input distributor or capital goods distributor. Only input service distributor. For example, if there is a supplier who sold goods to the factory but raised invoice to head office, can head office take credit? No. So only for input services. Then if services are provided only to factory 1 and factory 2, then what we will do? The credit will be distributed only to factory 1 and factory 2 in the ratio of 5:4. Even blocked credit cannot be can be distributed. For example, if it is a block credit, rent a cab service, etc., that can also be distributed, but only thing, the recipient cannot avail it as ITC. Even if recipient unit is exclusively engaged in exempted supplies are partly taxable, partly exempted supplies, ITC will be distributed. They will take the ITC in terms of Rule 42 and Rule 43. And ITC will be distributed only to those units which are operational during the quarter, okay, or operational during the month. And how the credit will be distributed, on a monthly basis or quarterly basis? Monthly basis. Now see this. Messrs ABC ad agency provided services to Taj group of hotels for 550 lakhs plus 9 lakhs as GST. Now this Taj group of hotels is having branches in Hyderabad, Chennai, Mumbai and Bengaluru. Mumbai branch is not operational. Then in that case, the Taj group of hotels head office will distribute the ITC of 9 lakhs only to Hyderabad, Chennai and Mumbai. Mumbai or Bangalore, but not to Mumbai. Then ITC to be distributed based on turnover ratio. What will be taken as turnover? Either previous financial year you take, that's the first priority. If you don't have previous financial year, then take the previous quarter. ITC with respect to a month should be distributed for that month only. So therefore, how the ITC will be distributed? Monthly basis or quarterly basis? Monthly basis. We cannot accumulate it for 2-3 months and distribute it. And distributed ITC cannot exceed the ITC available. Means they should not distribute more ITC. If they distribute it, it is a default ISD offense. Okay. Then how the credit will be distributed? If there is a unit in the same state, it will be distributed as CGST as CGST, SGST as SGST, IGST as IGST. But if the unit is in different state, so CGST and SGST will be distributed as IGST only. You see that service provider in Tamil Nadu, ISD in Tamil Nadu, and they have a unit in Tamil Nadu. So CGST, SGST will be distributed as CGST, SGST. But if they have a unit in Karnataka, this will be distributed as IGST. Got it? Now see this. Continuing to the above illustration, how much is the ITC that they need to give? 1,50,000, 1,20,000 and 90,000, correct? 1,50,000, 1,20,000 and 90. This is the ratio in which the credit should be distributed. But what has happened is that they distributed 1,50,000, 1,20,000 and 90 is the to be distributed. They distributed 1,20,000, 1,20,000, 1,20,000. Now what has happened here? Equally they distributed. So to factory 1, they have distributed short. So for that they need to give a ISD invoice of 30,000. And to factory 3, they distributed excess. So they need to give a ISD credit note for 30,000. Suppose if they are not doing it, then as per section 21, so GST department will recover the 30,000 excess distributed to factory 3 and it will not be made available to factory 1. Means 30,000 is loss. Got it? 30,000 excess distributed ITC to factory 3 shall be recovered by GST department from factory 3 along with interest and penalty, and 30,000 ITC shall not be made available to factory 1. That is a disadvantage. Understood? Then, in the above illustration, if invoice is raised by practicing CA to factory 1, what they can do? So, actually it is a common. So factory 1 is in Tamil Nadu, head office is also in Tamil Nadu. So factory will raise the invoice to the head office and head office will in turn distribute it to all the 3 factories. Got it? So invoice 1 is raised to factory 1 Tamil Nadu. Thereafter they will in turn raise it invoice to ISD head office. Then the head office will distribute it to all the 3. Because fully it cannot be enjoyed by factory 1 alone because the entire service is not attributable to factory 1. Then in the above illustration, if invoice is raised by practicing CA to factory 2, then they cannot enjoy the ITC fully. They can take only proportionate ITC. And what they can do is that cross charge. There is a concept of cross charge. Means one registration to another registration, they can raise the invoice. Cross charge, which is practically followed by many organizations, they can do that. And relevance of turnover. So, in case of section 17 read with rule 42, rule 43 and section 20, we take turnover, correct? Exempted to total and we take the turnover for distribution. While computing the turnover, we need to include or exclude the old indirect taxes. the old indirect taxes should not be included, it should be excluded. But generally, as per 15(2)(a), all taxes, duties and cess by whatever name called should be included, but that is not applicable here. Here we need to take, so all old indirect taxes. What are the old indirect taxes? Central excise duty, state excise duty, CST and VAT will not be taken into this. Done? Clear here? So with this, we completed input tax credit fully. Okay? And mostly on this 18, 19, 20, 21, we get even small questions possible. Okay? But 20 and all, if you get, it's a jackpot. Like, because just a calculation only, like overhead distribution is there na, like that, take the common expenses, distribute it between the branches. Okay, so that will be an easy question. Now we are moving on to the next area, that is search, seizure and confiscation under GST. So take module 15, which is page number 140. Module 15. So here we have the concept of seizure and confiscation of goods under GST. So listen, there are two situations where the seizure will happen. First, what is search? So going into the premises or stopping a vehicle and checking is known as search. And if the goods are unaccounted, unaccounted means what? So they have not paid the tax or there are no proper documents, etc. Then the goods will be seized. When the goods are seized, the possession will be taken by the department. And what is confiscation? If ownership of the goods also goes to the department, it is called as confiscation. That is the difference between search, seizure and confiscation. In two situations it will happen. Situation number 1. So officer will go to the premises of the registered person and they will conduct the search. Or officer may stop the goods which is in the transit on the road and they can do the search. Right now we are discussing about the first situation where the seizure and confiscation is from the place of business. For that we have two sections, section 67 read with section 130. So what happens is that first inspection will be carried out at the business premises of the taxable person or transporter or warehouse keeper. So GST department will go to the business premise of the taxable person or transporter who will be carrying the goods or the warehouse keeper, and they will check and verify whether goods are having like proper documents or not. If any unaccounted goods are found, such goods are liable for confiscation. Now they will pass a seizure order. Who will pass seizure order? GST department will pass a seizure order. So what they will seize, not only goods but also any documents etc. will be seized. So seizure from the place of business, order for seizure of goods or documents shall be passed. Got it? Now the person from whose possession the goods and documents were seized is having two options. Option number 1, he should pay the tax and penalty so that the goods will be released. All proceedings are complete. Okay, so pay appropriate amount and get it released. What is that? He need to pay tax and penalty under 122 subsection 1. What is that penalty under 122 subsection 1? 100% of tax. So what is the penalty under 122 subsection 1 here? 100% of tax. 100% of tax is the penalty. Okay, for example, the value of the goods is 5 lakhs. GST rate is 18%. Means 18% of 5 lakhs is 90,000. See, 90,000 tax plus penalty 90,000. So that's what. So 200% literally they will be paying. So tax also they need to pay, penalty also they need to pay. And the goods will be released. And all proceedings in this respect shall be deemed to be concluded. Now, Again, when we sell that goods, should we pay GST? No, because already we paid the GST on that goods along with penalty. So again, we don't have to pay GST. Got it? This is option 1. Suppose if the person is not having money, then there is option 2. He can execute a bond and the goods will be released on a provisional basis, and as and when he makes sale of the goods, he need to pay tax plus penalty. So then only proceedings will be dropped. Until that point of time, so there are proceedings and government is having power to recover GST from him. So provisional release of goods by executing a bond covering value of the goods. Suppose if he has not exercised both the options, so neither he paid the tax and penalty nor he executed a bond, then what will happen? So then there will be confiscation order. Confiscation means the transfer of ownership to department. Now they will pass a confiscation order plus will give a redemption option. Confiscation order plus redemption option to pay the fine. So what is extra that he need to pay now? Tax, penalty plus redemption fine. Extra he need to pay redemption fine also. What will be that redemption fine? For goods, the maximum redemption fine. See, maximum means this is not the total redemption fine. That's the maximum redemption fine. Maximum redemption fine is market value of the goods minus tax payable thereon. So that is the maximum redemption fine. But they can fix any amount as redemption fine. That is for release of goods. Suppose if goods along with conveyance is seized, then in that case the maximum redemption fine for release of conveyance is tax payable on the goods transported thereon. Okay, and tax and penalty. Penalty is payable under section 122 subsection 1 along with redemption fine. What if option is not exercised? Then the goods will be taken by the department. They will dispose of whatever money they realize, they will keep in their pocket. They will not give 1 rupee also to that person. So this is in case of seizure and confiscation, where in the premises, section 67 read with section 130. Simple pa. Officer will come, will check the premises. They find the unaccounted goods or the documents. So they will seize the unaccounted goods and documents. Two options: pay tax and penalty. Penalty 100% of tax. Goods will be released. All proceedings over. Or execute a bond. Goods will be released, but you have to pay in future tax and penalty. You did not exercise both the options. Then the goods ownership will go to the department. Still you have one option, that is redemption fine. You pay tax, penalty, redemption fine. What is that redemption fine? Market value of the goods minus GST payable thereon. That is maximum for goods. For conveyance, GST payable on the goods transported thereon. That is maximum. In that they will specify some fine. You pay that fine, penalty and tax, goods will be released. No, you did not exercise. What is the time limit? You have to exercise this 3 months. Option to redeem goods by paying fine within 3 months. So within 3 months you did not exercise this. Then what will happen? Ownership will go to the department. They will sell it. Whatever money they realize, they will keep it and they will not share with the person. Got it? This is situation 1. Now situation 2 in case of seizure. Here what happens? The seizure will be based on the search during the transit. So there is a vehicle that will be carrying the goods, and the proper officer will stop the vehicle and will check the vehicle in transit. Suppose if the transporter was found transporting goods in contravention of the provisions of the act, means goods are transported without documents or without e-way bill or wrong data in e-way bill, etc. and all, then both goods and conveyance will be liable for confiscation. So proper officer will pass a seizure order. So first they will be giving a notice. First seizure order, within 7 days from seizure order, they will give a notice for imposing the penalty, and within 7 days from the notice date, okay, they will pass the penalty order. Okay, so what will happen? First seizure order, within 7 days notice for levying penalty, and within 7 days from notice they will levy penalty. So they will levy penalty order. Got it? And penalty order within 7 days after giving opportunity of being heard. Okay. And after penalty order, within 15 days, if you pay the penalty, the goods will be released. Got it? But you don't have to pay the tax. In case of previous situation, we need to pay tax and penalty. But here, we have to pay only penalty. This is section 129. Section 68, read with section 129. We have to pay only penalty here. And suppose if you are not paying penalty within 15 days, what will happen? The goods will be taken by the department, they will dispose it off, they will adjust the penalty, and remaining amount will be returned, because there is no confiscation here. Confiscation is only in the previous case. In the previous case, confiscation they do, but here only seizure. They will not do confiscation, means they will sell, they will take their penalty, and remaining amount will be returned to the person. Understood the difference between these two situations? In situation 1, we need to pay tax plus penalty, but here we need to pay only penalty. Previous case, if we are not exercising any option, goods will be taken by the department and they will sell it, entire amount they will retain. But here, within 15 days from penalty order, if we are not paying the penalty, then the goods will be taken by the department, they will sell it, adjust the penalty, and remaining amount will be returned to that person. Got it? Now, procedure is what? First, seizure order, plus 7 days notice, plus 7 days penalty order, plus 15 days we have to pay the penalty, else the goods and conveyance will be taken over by the department. Understood? But this 15 days can be reduced in case of perishable goods. Now, what is the penalty that is payable? We need to check whether owner of the goods is coming forward or not. If owner is not coming forward, then who is coming forward? Transporter is coming forward. If owner of the goods is coming forward to claim the release, the penalty will be, if it is taxable goods, 200% of tax is the penalty. Penalty itself is 200% of tax. If it is exempted goods, 2% of the value or 25,000, whichever is lower. Sir, this is penalty under CGST Act. The same penalty will be payable under SGST Act. For example, you see this, 1 lakh is the value of the goods, and on that 1 lakh, 9% is CGST. That is what? 9,000. So 9,000 plus 9,000, 18,000 you need to pay as penalty under CGST, and 18,000 you need to pay as penalty under SGST. Are you getting this? Then, suppose if it is exempted goods. Sir, in case of exempted goods, why they will do seizure? For exempted goods also some documents are required. If there is no documents, they will seize. But maximum penalty will be what? 25,000, because it is whichever is lower. 2% of value or 25,000, whichever is lower. Okay. And for release of conveyance, this is for release of goods. But for conveyance, whatever is the penalty payable for release of goods, or 1 lakh, whichever is lower. Means therefore, what is the maximum penalty for release of conveyance? 1 lakh. Understood? This is when the owner is coming forward. When the owner is not coming forward to claim the release, for taxable goods, the penalty will be 200% of tax or 50% of value, whichever is higher. So, which means 1 lakh into 50% is what? 50,000. 9,000 plus 9,000, 18,000. Whichever is higher is 50,000. 50,000 we need to pay under CGST and 50,000 we need to pay under SGST. Sir, why penalty in case when owner is not coming forward is more than when owner is coming forward? Because department wanted to find who is the owner of the goods. If transporter is coming, they don't want transporter. They want to know who is the owner, so that we can go to the search to these premises. Situation 1. Understood? That's the reason why they created a higher penalty when transporter is coming forward. And exempted goods, what will be the penalty? 5% of value of goods or 25,000, whichever is lower. And for here it is 2% or 25,000, here 5% or 25,000. For release of conveyance, the penalty will be penalty for release of goods or 1 lakh, whichever is lower. And what will happen is that when the person transporting any goods or the owner of such goods fails to pay the amount of penalty under section 129 within 15 days from the date of receipt of copy of order, the proper officer shall proceed for sale or disposal of the goods through the auction, correct? And the set period of 15 days may be reduced in case of perishable goods. And what they will do with the money? They get the money, na? First they will adjust towards administrative cost of recovery. They will incur some auction expenses, for that they will recover. Then they will recover the penalty. And balance amount will be credited to the electronic cash ledger of owner of the goods or conveyance, if they are registered. Else it will be credited to their bank account. Suppose if they are unable to be identified, one lorry came, driver got down, ran away. Driver ran away and the goods were seized. Lorry is seized and department don't know who is the owner of the goods, who is the owner of the conveyance. Then entire money they will wait for 6 months, and after that they will be depositing that money to consumer welfare fund. Okay. So, a balance of the sale proceeds cannot be so paid within 6 months from the date of sale, it shall be deposited in consumer welfare fund. Okay. So, this is about seizure and confiscation of goods. So, I don't know whether questions are there on this. Usually on this MCQs will come definitely, and it's a page number, pa, seizure. So, they have given lots of information, but what I have given with you is the brief related to that. No, they have not given any question on that seizure and penalty. Maybe somewhere at the later point of time is it given or not, I don't know. Nothing. So, they have not given anything related to seizure. So, it's only the MCQs that are given. Okay. And you can just go through the MCQs around some, the two only 5 MCQs they have given. Right. So, these are all the, like, this is a small area, and maybe they can coin some questions on the penalty. Owner come forward, owner does not come forward. On that they can coin a question on penalty. Then we are moving on to the next area, that is module 14. In that module 14 we have offences, penalties, arrest, etc. So, that provisions we will see. In module 14 actually we have these 5 areas: assessment and audit, appeals, offence and penalties, advance ruling, demand and recovery under GST. So, these are all the topics that we have in module 14. In that I am discussing now offences and penalties under GST. So, please see that in page number 132. So, we have various offences for which the penalties are applicable. So, in this we are going to cover total 5. First we are going to see what are the offences that leads to penalties. Then second, what are the offences that leads to imprisonment. Third, what are the offences that leads to arrest. Then what are the offences that leads to cognizance of offence. Cognizance of offence means, so bailable, non-bailable, etc. And last, what are the offences which are compoundable in nature. These are the 5 aspects we are going to discuss in this chapter, offence and penalties. So first, offences that leads to penalties. Second, offences that leads to imprisonment, and offences that leads to arrest. What is the difference between arrest and imprisonment? Arrest is taking a person into custody, but imprisonment is serving a imprisonment order by the court, so therefore he need to serve the prison period. And then cognizable versus non-cognizable, bailable versus non-bailable. Cognizable means a person can be arrested without a warrant, that is cognizable offence. All cognizable offences are non-bailable offences, means the arresting officer cannot grant the bail, they need to be produced before the magistrate. Whereas non-cognizable offences. Non-cognizable offence means the person can be arrested only with a warrant and the arresting officer can grant the bail. Okay, so that. Next, offences which are compoundable. Compoundable means no need to go for prison. If we pay some fine, compounding fee, then we will get immunity from prosecution, means there won't be any imprisonment, etc. So that is known as compounding of offence. So first area we are going to discuss offences that leads to penalty, and for this we have section 122 to 125. These are the sections 122, 123, 124, 125. But in that 122 again we have subsections. So look into 120 subsection 1. There are some list of offences. So these 21 offences are there as per 122 subsection 1. These 21 offences can be remembered with a keyword bio discredits TFT. B for books of accounts default. You can see below. What are the offences under section 122 subsection 1? Books of accounts default. Books of accounts default means what? So maintaining false books of accounts or fake books of accounts or non-maintenance of books of accounts, that is B. I for invoice default. Invoice default means supply without invoice or invoice without supply or invoice with incorrect details. Then O for obstructing an officer from doing duty. One officer is coming for checking and you obstructed him, you stopped him or you kicked him, okay, that is obstructed an officer from doing duty. Dealing in goods liable for confiscation. You know that the goods are liable for confiscation, but you are storing those goods or you are purchasing those goods or selling those goods, that is dealing in goods liable for confiscation. Input service distributor default, that is you should not distribute the credit but you distributed the credit or you distributed the credit in excess, that is ISD default. Supply with GSTIN of another person. So what is that? That is, so actually I am selling the goods, but I raised invoice in some other person GSTIN. So we get the GSTIN of other person, in that person's name we raise the invoice. That is this offense. Then C, collected tax not deposited within 3 months, collected an amount as tax not deposited within 3 months. What is the difference between these two? You are supposed to collect tax, you collected it, but you did not pay within 3 months. So next, you are not supposed to collect tax, but you collected it and you did not pay within 3 months. That is these two. Then registration related default. Registration related default means you are not getting registered or giving false information for registration. Then erroneous refund. You are not supposed to get the refund, but you have claimed the refund wrongly. That is erroneous refund. Disposal of goods while detention or seizure is operational. So that is when the goods are seized, you are breaking that lock and you are selling those goods. Then ITC default, you are not supposed to take credit but you got the credit. And tampering material evidence. So whenever there is a material evidence, you are tampering it, so you are tearing it, etc. and all, that is tampering material evidence. Suppression of turnover, you cross the turnover but you suppressed it. Then TDS or TCS default. So you deducted but not remitted or not deducted. Then failure to furnish information or document. They are asking you to submit an information you did not submit, or transportation related default. So these are the various offences under 122 subsection 1. Bio discredits TFT. Just you remember what is that offence, so that in exam when you get that offence, you need to be able to write the penalty. Okay, what is the penalty for all these offences? It is 100% of the tax or 10,000, whichever is higher. Okay, and 122 subsection 1, that is this. 122 subsection 1A is a person who is a beneficiary of invoice default, ITC default, ISD default. So because of me, I am planning in such a way that so invoice default, ITC default, ISD default is happening and I am enjoying the benefit out of that. Then on me, the penalty will be same, tax evaded or ITC availed or passed on. So I created some fake suppliers, and based on that fake supplier, some ITC is given to the recipients. So on the suppliers and recipients, there will be penalty under 120 subsection 1. Invoice default on supplier, ITC default on recipient. But on me, I am the beneficiary, I am the man behind the screen. On me, the penalty will be 122 subsection 1A. How much ever is the tax evaded or ITC passed on, that much I need to pay as penalty. Then 122 subsection 2, that is, whenever the tax is not paid or ITC wrongly availed or erroneous refund is claimed, then if it is on account of fraud or other than fraud, if it is fraud, section 74, if it is other than fraud, then demand and recovery under 73. So there are 5 cases: short payment of tax, non-payment of tax, wrong availment of ITC, wrong utilization of ITC, and erroneous refund. If these 5 on account of fraud, then the demand and recovery will be in terms of section 74. If it is on account of other than fraud, error, then it will be 73. In case of 74, high penalty, that is 100% of tax or 10,000, whichever is higher. But in case of 73, it is only 10% of tax or 10,000, whichever is higher. Then in 122.1 also, 122.2 also, both cases, for the same reasons we have the penalty, because erroneous refund will come in 122.1 as well as 122.2, and non-payment of tax will come in both the places. ITC default will come in both the places. Then how we need to understand that these two are mutually exclusive. If they initiate recovery under 73 or 74, then they will be levying penalty under 120 subsection 2. If they are not initiating recovery under 73, 74, then the penalty will be as per 122 subsection 1. Okay. Then 122 subsection 3, this is on the person who is not directly doing offense but a party to the offense. For example, I am asking my driver to transport the goods without bill. So on me, transport default 122 subsection 1. On the driver, knowingly that the goods don't have bill, is transporting, on him the penalty will be 122 subsection 3. Offences where the person is not directly involved in any evasion but may be a party to evasion, or if he does not attend the summons or produce the documents, he has been summoned to come and appear, he did not appear and produce the documents, then also there will be penalty, and that is up to 25,000, small penalty only. All these penalties what we are discussing is penalty under CGST Act. The same amount of penalty will be payable under SGST Act. Then section 123, a person who fails to furnish information written. Under section 150, a person is required to file an information return. So whenever a person is in possession of the taxpayer's information, for example, you are a cost accountant, you have one client, that client's information is with you. Now GST department is asking you to disclose the information. If you are not disclosing the information, then on you there will be penalty. And what is the time limit within which you need to disclose the information? Within 90 days from the date of invoice, from the date of notice. Otherwise, penalty will be 100 rupees per day, subject to maximum 5,000 rupees. Then 124, same way like how 150, there will be information written. 151, it is data. For example, they will ask the bank manager of a bank to submit the data of all account holders whose annual gross receipts exceeds 50 lakhs. Now the bank manager, if he is not submitting the data, so then on him the penalty will be under 124. If it is normal cases up to 10,000, but repeated, so he is continuing that offense, then it will be 100 rupees per day, subject to maximum 25,000 rupees. Then whatever information that is obtained under 150 and 151 cannot be immediately used, so without giving opportunity of being heard. So they need to give opportunity of being heard, and then only they need to use that information. Then, because whatever money that is there in our bank account need not be really our sales income. So there could be some other receipts also, capital receipts also. Then section 125, general penalty. So general penalty is if there is an offense which is not specified above, for which the general penalty will be up to 25,000 rupees. Then section 126 says, whenever there is a offense for which the tax involved less than 5,000, then the penalty can be waived. Okay, no penalty for minor offenses. What is considered as minor offenses? If the tax involved is less than 5,000, that's a minor offense, or which can be easily rectifiable and made without a fraudulent intent. So for example, I have to display the name and GSTIN. I did not display GSTIN, but it is rectifiable now, we can attach it. So therefore penalty can be waived. But which penalties they are talking about this? So 122 subsection 3, 124 and 125. Wherever we have penalty up to. So 123 penalty is what? Up to 25,000. Means 0 also up to 25,000. And here also up to 10,000. And here also up to 25,000. Wherever we have that words up to that, so there only they can waive off the penalty department. Then 127, where proper officer is of the view that person is liable to pay penalty and the same is not covered under any other proceedings, he may levy penalty after giving opportunity of being heard. So only penalty also they can pass an order. Then 128. 128 is government may waive off the penalty. So what is the difference between 126 and 128? 126 is officer can waive the penalty. 128 government can waive the penalty. But which penalty can be waived by government? All penalties except 124. See the sections. 122, 123, 125. So all penalties can be waived off by them except 124. Then section 133 says that there is an officer engaged under this act, means GST officer. If he willfully discloses any information or the contents of any return otherwise than in execution of his duties. So he will have the sensitive data of the taxpayer. If he discloses the data of the taxpayer with any other person, then he is liable to pay a penalty up to 25,000 or imprisonment of 6 months or both. Okay. Now mostly this will not be tested directly in exam as case study questions etc. and all. But in MCQs we can expect this. In MCQs we can expect offense and penalty. So what you need to do is that you need to revise it once before the exam and you need to go for the exam. Okay. But if you see your study material, offense and penalties, so you can see, they gave some data, some multiple pages they gave, but that much, not required. So that's why I just made it like a crisp. So this much information is sufficient. Just 2-page information here. Page number 1, page number 2. Got it? This much you can remember and go. What is the offense? What is the penalty for that offense? Okay. Then, now the next area, that is arrest and non-bailability etc. So before that we need to know about imprisonment also. So imprisonment, offences that leads to imprisonment. What are the offences that leads to imprisonment? All the offences which we discussed in 122 subsection 1. What are they? Biodiscredits TFT. From that take out ISRD-STT, that is invoice default, then supply with GSTN of another person, then R, registration default, D, so disposal of goods while detention is operational, yes, suppression of turnover, TDS, TCS default and transportation default, you take it out. So remaining offences will lead to imprisonment. Okay, rather than remembering new list, the same old list minus ISRD-STT, you will get the offences that leads to imprisonment. And easily you can remember this imprisonment, don't write, just listen. Remember 1, 2, 4, 1, 3, 4, sorry, 1, 2, 5, 1, 3, 5, 1, 2, 5, 1, 3, 5. If it exceeds 1 crore, imprisonment is up to 1 year. If it exceeds 2 crores, imprisonment up to 3 years. If it exceeds 5 crores, imprisonment up to 5 years. Clear? 1, 2, 5, 1, 3, 5. If the tax evaded exceeds 1 crore, then up to 1 year. If it exceeds 2 years, up to 3 years. Sorry, if it exceeds 2 crores, up to 3 years. If it exceeds 5 crores, up to 5 years. This is up to. Up to. Plus fine. Plus fine. And in all these cases, there is a minimum imprisonment of 6 months. Minimum 6 months. Minimum 6 months. Okay. Clear? But this is in case of first time. Suppose if it is subsequent, always up to 5 years plus fine. Okay. So you can see the table here. So more than 1, more than 2, more than 5. 1 year, 3 years, 5 years. Minimum 6 months plus fine. This is for first time imprisonment. Subsequent imprisonment, minimum 6 months and maximum 5 years plus fine. And for books of accounts default, obstructing an officer and tampering material evidence. For this, the imprisonment will be up to 6 months or fine or both. For others only this will be applicable. Then what are the offences that leads to arrest? Remember, only 3 offences that leads to arrest. IIC. II is invoice default, ITC default, collected an amount as tax not paid within 3 months. These 3 offences only leads to arrest. That too, the amount involved should exceed 2 crores. The tax involved should exceed 2 crores. Then only there will be arrest. If it does not exceed 2 crores, no arrest. And same 3 offences, if it exceeds 5 crores, arrest without warrant. Okay, cognizable. Clear pa? If it exceeds 2 but does not exceed 5, non-cognizable. Exceeds 5, cognizable, means without warrant person can be arrested. So what are the offences which can be leading to arrest? Invoice default, ITC default, collected an amount as tax not paid within 3 months. That too, if it exceeds 2 crores, arrest can be made. If it exceeds 5 crores, it is called as cognizable plus non-bailable offence. Then next one, last area, offences that leads to compounding of offences. Compounding means what I told you, granting immunity from prosecution. Means imprisonment will not be initiated and you have to just pay a compounding fee. Section 138 deals with compounding of offences. Any offence under this act can be compounded by commissioner. Compounding can be done either before or after institution of prosecution. Compounding can be done only on payment of compounding amount. What is that compounding amount? You can see below. Compounding amount is, we don't have exactly how much is the compounding amount, but there is a minimum and maximum. Minimum 50% of tax or 10,000, whichever is higher. 3 times is maximum. 3 times is what? 150% of tax or 30,000, whichever is higher. So in this limits, they can fix any amount as the compounding fee, 50% to 150%. Okay. And there are some offences where first time compounding is not possible. That is, he has been convicted of an offence by the court, means already imprisonment order is passed by the court. Now we can't do anything. Or who has been blamed of committing an offence which is also an offence under any other law. So this is not only offence under GST, this is also offence under Income Tax Act or Customs Duty, etc. Then we cannot do the compounding. And so he is doing certain offences like obstructing an officer from doing duty, tampering material evidence, failure to supply information or supplying false information. In that case, first time compounding not possible. So what are the cases? First time compounding not possible. He has been convicted by court. And this is an offence which is also an offence under any other law. Obstructing an officer from doing duty, tampering material evidence, failure to supply information. 5 cases. And there is a restriction on subsequent compounding, means first time it is possible, but subsequent it is not possible. That is invoice default, ITC default, collected an amount as tax not paid within 3 months, IIC. Then erroneous refund, books of accounts default, or any other offence where the value is more than 1 crore. So subsequent compounding is not possible. Understood? So this is about offences and penalties that we have seen. So this actually is between your module 14 and module 15. In module 15 we have arrest related provisions. Arrest related provisions is in module 15 and module 14 we have offences. So therefore that's why I merged this fully. Okay. Next we have other topics in this module 14. Have a look into that. Assessment and audit, appeals, etc. Page number 125. If you have book, you check there, otherwise you look into the screen. These are the various interest provisions under GST. I just gave you as a summary. That is, as per section 50, whenever there is a delay in payment of tax, interest will be payable at the rate of 18% per annum from the first date after due date till the actual date of payment of tax. Okay, and there could be any delay in payment of tax. What is the due date of payment of tax? 20th of the month following every month, and from the date till the actual date of payment, interest will be payable. Then, as per section 60, in case of provisional assessment, what is a provisional assessment? Whenever we are unable to determine how much is the tax payable, we will make a request to the officer to compute the tax payable, that is known as provisional assessment. In case of provisional assessment, officer will specify some tax to be payable, and later on they will determine the final assessment amount. Now the differential amount is there na, that has to be paid along with interest at 18% per annum, that is section 60. For payment of differential amount arising on account of finalization of provisional assessment, what is the rate of interest? 18% per annum. From when to when? From the first date after due date till the date the tax is provisionally assessed and paid. That provisional assessed tax is paid. And section 16 is 180 days point we have seen. So input tax credit, recipient has to make payment to the supplier within 180 days from the date of invoice. Otherwise, recipient has to reverse the ITC along with interest at 18% per annum. So that interest. Then 42 also we have seen. We need to compute D1 and D2 at the end of the financial year, and we need to see the difference. If there is any excess, we need to pay. Otherwise, interest is payable from 1st April of the succeeding financial year till the date of payment. Then 43 also, capital goods also we have interest. So we need to reverse it over a period of 60 months at 18% per annum. Every month we need to pay interest, that one. And 56 is refund. So whenever we are getting the refund, so we need to make application for refund. We have paid tax excess. We need to get a refund. And what is the time limit within which refund should be granted? 60 days. If they are not granting refund within 60 days, from 61st day, they need to give us the interest at the rate of 6% per annum. Suppose if the refund order is passed by appellate authority or adjudication authority, one authority, okay. So appellate authority or adjudication authority, then the interest rate will be 9% instead of 6%, okay. So this is about various interest provision summary in one place. Now assessments, if you see, we have total 5 assessments: self-assessment, provisional assessment, scrutiny assessment, then best judgment assessment and summary assessment. Total 5 assessments we have under GST. In that, self-assessment is simple. So as per section 59, a registered person can compute how much tax he can pay, that is known as self-assessment, and he has to compute that and furnish the return, so by the due date, okay. We don't have any other provisions related to that. Then provisional assessment. When a registered person will resort to provisional assessment, when he is unable to compute how much is the GST payable because you don't know the rate or he don't know the value, he will make an application to the proper officer to determine the amount to be payable on a provisional basis. So say this, a taxable person is making an application where taxable person is unable to determine the value or the rate of tax. Now proper officer will do the computation and ask him to pay the provisional tax. So what is the time limit within which provisional assessment order will be passed? Within 90 days from the date of receipt of such request. And after that, so final assessment order will be passed within 6 months plus 6 months plus 4 years. By that time limit, they will pass the final assessment order. Time limit you need to remember. What is the time limit within which provisional assessment order will be passed? Provisional 90 days from the date of application. And what is the time limit within which final assessment order will be passed? 6 months plus 6 months plus 4 years from the date of provisional assessment order. What is this 6 plus 6 plus 4? First 6 months. It can be extended for a further period of 6 months. Thereafter, it can be extended for a further period of 4 years. Then, officer has to take any permission, withdrawal of order? No. What is the consequences? 3 things could happen on final assessment. What are the 3 things? Final assessment is greater than provisional assessment, or final assessment is equal to provisional assessment. They are asking us to pay provisionally 12%, but final assessment could be 18%, or final assessment also 12%, or final assessment is less than provisional assessment, means say 6%. Okay, now final assessment is greater than provisional assessment, means you need to pay the differential amount. They are asking us to pay say 1,20,000 provisionally, but we need to pay finally 1,80,000. So what is the difference? 60. That 60,000 we need to pay along with interest from the first date after due date pertaining to the month in which we are resorted to provisional assessment till the date of payment of that provisional duty. That is differential amount. And suppose if it is equal, leave it. If it is less, final amount is less than provisional amount, then we should get the refund. We will make application. They will wait for 60 days. Within 60 days, they will give refund. If not, they will be giving us an interest at the rate of 6% per annum. Understood? This is in case of what? Provisional assessment. Then scrutiny assessment. This scrutiny assessment is whenever there is a self-assessment, that self-assessment return will go to the officer for verification. Officer will take some returns on a scrutiny basis, parameter, some risk parameter basis, some returns will be taken for scrutiny. They will verify the return. If everything is proper, they will leave it. Otherwise, they will initiate the assessment. So, proper officer will do this and they will give a notice. So, mainly why they do the scrutiny assessment? In order to verify the correctness of the return. And time limit is not given, and consequences. So, when they give a notice stating that there are some lapses, within 30 days, we need to give the explanation. If not, they may proceed to conduct audit or initiate any recovery. Okay, this is in case of scrutiny assessment. Then best judgment assessment. In two cases, there will be best judgment assessment. One is best judgment assessment with respect to non-filers of return. There is a person who is required to file a return, but they did not file the return, then best judgment assessment will be done. Or there is an unregistered person who is liable to pay tax, means he crossed the threshold limit, but he is still unregistered. So then best judgment assessment will be under section 63. Got it? So now 62 best judgment assessment is by the proper officer. So one notice will be given for non-filing of returns, where registered person failed to file return within 15 days from the GSTR 3A notice, then best judgment assessment is initiated. Whereas 63, there is an unregistered person but who is liable to pay tax. The proper officer will give an opportunity of being heard and will compute the GST payable. What is the time limit within which the best judgment assessment order should be passed? 5 years from the due date of furnishing annual return. For example, current financial year you take 22-23. For 22-23, due date of annual return is what? 31st December 2023. From there, within 5 years, they can pass the best judgment assessment order. In that, the best judgment assessment order for non-filers of return can be withdrawn if you file the return within 30 days from the order. If you file returns within, why this order is passed? Because you are not filing returns. Okay, so if you file returns within 30 days, this order will be withdrawn. Then last will be summary assessment. This summary assessment is like in income tax, income escaping assessment. Whenever a person is liable to pay tax and delay in passing order, he may escape from payment of tax. Proper officer will pass the order immediately and no notice. In this case, there won't be any notice that will be given. Okay, and suppose if the person so says that, sir, please proceed for regular assessment. Can this assessment order be withdrawn? Yes, this assessment order can be withdrawn. But to initiate summary assessment, so proper officer should take permission from additional or joint commissioner because they are doing the assessment without giving a notice. That's why. So these are the key points that we have with respect to assessment. Then this audit under GST. So we have only 2 audits now. So statutory audit is not there, but in your study material, they gave GST audit done by the registered like tax, like CAR, CMA, like that and all big data they have given, but that is not applicable. So therefore, that question should not be tested because it is omitted. So in new study material as well as old study material, both places they gave GST audit. So, but that is not applicable for you, don't worry. So you have only 2 types of audits under GST, that is departmental audit and special audit. which is conducted under section 65 and 66. Who will conduct the department audit? Department will conduct. Who will conduct the special audit? CA or CMA nominated by commissioner, not selected by the registered person. And when department audit, so whenever department is of the opinion that a person, so books of accounts needs to be checked. Maybe he has not properly filed the returns, etc. some reason. Whereas special audit is whenever department wanted to identify this input tax credit lapses and valuation issues, then they will go for special audit. And departmental audit should be completed within 3 months and it can be extended for a further period of 6 months. But special audit 90 plus 90. So 6 plus 3, there it is 90 plus 90, literally 3 plus 3, but you have to remember it as 90 days plus 90 days. And audit report, in case of department audit, the audit report will be given to the registered person as well as to the department. But special audit, always the report will be given to the department officials only, they will not give it to the registered person. And expenses, both cases expenses will be borne by the department. And scope of audit, in departmental audit, so they will verify everything, all records. But in special audit, they will verify only records pertaining to valuation or ITC. And notice for audit, a 15 working days prior notice is required, where in case of departmental audit. But in case of special audit, no notice, but a direction to get the audit is required. And what if is already completed under any law? Then again, audit may be conducted under this section also. For example, income tax audit is done. Can they come and do departmental audit? Yes. GST audit can be done. And audit can be done by department even for part of a year also. And there is no statutory audit in GST, which is conducted by a CA, CMA appointed by registered person. But the registered person has to file a self-certified reconciliation statement in GSTR 9C. Whenever their aggregate turnover in a financial year exceeds 5 crores. That point you remember. Okay. So they need to file GSTR 9C whenever their aggregate turnover exceeds. Anyhow, I have given this in returns chapter. So there it is there. Okay. So we have appeals under GST. So can we complete this tomorrow, pa? Throat pain, pa. From morning I am taking, okay. So we will see this tomorrow, and agenda for tomorrow is that we will complete the remaining topics in GST. So this appeals, advance ruling, refunds, place of supply, returns, that we will complete. So it will be over. And by afternoon, I will be starting with customs, okay. And whatever remaining portion that is yet to be completed, we will carry forward it to Tuesday, and Tuesday by afternoon I will try to complete. Okay, fine. Thank you. We'll meet tomorrow. Take care. Tomorrow class timing is 10 o'clock only. Normal 10 to 5:30. Okay. Thank you.